This is annual power event. It's perhaps one of the largest gatherings of stakeholders in the power energy sector in Nigeria. This year, we are keen to create a platform that allows us to dialogue on how to move the sector forward. We have seen some changes in the period between today and when we had last year's conference. One of the things that defined the sector last year was the issue of illiquidity of the power sector and the threat that posed to the entire industry. Today, that's almost like a problem behind us. It's not that it's completely solved, but I think there is now a sense that the attempt at enthroning cost-reflective tariff is now unstoppable, and government's attempt at ensuring that its scarce revenues do not anyway get dissipated in this sector. I think that we can say that there is some success in that regard. Power is life without any question, especially for a country like Nigeria, a country of 200 million people that can boast of only maximum 5,000 megahertz of grid delivered power daily. Looking at it from what we need and where we should be, I think we all agree that there is a huge gap in that regard. But and my friend Ayo will be talking about this later, but we are seeing that there is indeed significant scope for state governments to help facilitate, the expansion and indeed the vitality of the electricity market in their states by helping to debottleneck the processes and just allow investors and others who are putting money in the sector to begin to deliver good results. We are also joined by a number of people from the renewable energy sector as well. These days, we talk about energy transition, and we can see how indeed it's sped up since the assumption of office of the US President Biden. And without any question, we can begin to see that the momentum that is helping to create just power across the world. Volkswagen announced last week that it would stop making combustion engine vehicles by 2035. I asked myself, 2035, that's probably how many years from now? About 30, 32, 33 years from now. And we're also seeing that the renewable energy people are doing great work. It was so nice the other day to have read a report about one of the companies, now boasting of, connected customers in the region of 10,000. That's huge. That's really huge. So a lot is happening in that regard, and I'm happy that our friend Adobe will be moderating one of the panels, and I'm sure that we will benefit from the great insight that she brings from her work at All On. I am happy that we hope to be joined by the Honorable Minister for Power, Engineer Saleh Maman, and we're looking forward to hearing from him. But I guess that will be all that I should be saying at this point. We have a great array of speakers and panelists, starting with the first panel on unlocking liquidity, and then, of course, and then the panel on bridging the gap with renewable energy, and then, of course, a presentation by Ayo Ekpo on how state governments can facilitate power markets in their states. And we will then transit to the third panel on innovating around challenges of building the utility of the future. And then, of course, the fourth panel on the new wave in terms of privatization and the future of IPPs. We will then end up with a panel on the good bypassing of grid solutions to commercial and industrial challenges. That will be it. I thank you all, ladies and gentlemen, and my thanks certainly must now go to our sponsors who are enablers that have made this possible, all on EN Consulting, Infra Credit, FBN Quest, Genesis, Kaduna Electric, Kano Electricity Distribution Company. It's now my pleasure to yield the floor to our friend, Woleni Esson, who's a partner at Olaniu Ajayi LP. Over to you, sir, and thank you very much.
Okay, thank you very much, Mr. Aigbogun. Ladies and gentlemen, a very good day to all of you, wherever you may have joined us from today. It's always a pleasure and privilege to be speaking to you. We are always grateful at Olaniu Ajayi for the opportunity to collaborate with Business Day on this great annual event, which continues to provide a platform for stakeholders in the Nigerian power sector to exchange ideas, knowledge, and views on critical issues facing the sector. The theme of this year's conference, Puzzle to Power, Fitting the Pieces for a Secure and Sustainable Energy Future, is indeed very fitting, and not least because there are many missing pieces which puts the country's desire for a secure and sustainable energy future at a significant risk. Without any doubt, the Nigerian power sector is broken. It is broken in many parts, and it is broken for different reasons. And if the pieces are not put together very quickly, then the energy future of the country will not be secured. To give a sense of the scale of the deficit that we are dealing with in the power space, Nigeria is currently what I would call the electricity poverty capital of the world, with about 70 million people, representing about 40% of the population of the country lacking access to grid power. And the lack of access to electricity is costing the country significantly, and it's impacting every aspect of the economy. And at about 2.5 to 6% growth rates, Nigeria has a healthy population growth. And the growth in population, we don't see that being matched by growth in access to electricity. So population growth will continue to exert significant pressure on energy demand. The projection is that by 2050, which by the way is less than 30 years away, Nigeria will have a population of about 400 million people and will be the third most populous country in the world, only behind China in second place and India in first place. I believe this begins to show the scale of what lies ahead if there is no immediate, urgent, and targeted interventions. The impact of electricity poverty on the country is clearly very significant. As we are aware, electricity is not just a commodity, it's a driver of economic growth and prosperity. And with the world shifting towards energy transition, it means that we cannot continue to rely on oil and gas, as Frank just mentioned now, as our mainstay. I must continue, I must start looking at industrialization as a way of diversifying our economy. But the critical question is, are we going to industrialize without power? Are we going to industrialize in darkness? I don't think so. So the country's electricity challenges are well documented. There's little value in rehashing them. But what is, however, clear is that we cannot allow the future of power in the country to be like the present or the immediate past. We have to look boldly into the future and move away from electricity poverty to electricity abundance. Of course, as again, Frank already mentioned, government has taken several measures to keep the power sector afloat through various interventions, especially in relation to liquidity, as they mentioned. So for instance, the CBN on behalf of the federal government has been very active in providing liquidity to the sector. I'm certain we all recall the various intervention funds put together by the CBN, like the 213 billion market stabilization fund, the 701 billion payment assurance facility, the ongoing national mass metering program, the NEMS 2, NEMS 3, as well as TCN and DISCO interface project financing, just to mention a few. Now, frustratingly, despite all these injections and interventions by government, it would seem that a brighter path to the recovery of the power sector is not very visible as yet. And this is perhaps because government fell short in linking all its interventions together in a way that addresses all the issues in a holistic manner and based on long-range planning. Of course, it is beyond doubt that the power sector of the future will not happen with the flick of a switch, and it takes years of hard work for it to evolve. That said, there are issues that we need to begin to seriously reflect on as we contemplate the future of electricity in Nigeria. One of the issues that must be tackled head-on is the issue of energy access. The on-grid energy deficit in Nigeria is inexplicable and perhaps unforgivable, not least because Nigeria is blessed with all the resources that may be used to generate electricity. The country is blessed with abundant deposits of hydrocarbons, sixth largest reserve of gas in the world, with proven reserve of over 203 trillion cubic feet. The country has excellent solar irradiation with about 19 megajoule per square meter per day, an average sunshine of about 6 hours a day. The country also has hydro sources as well as wind resources with wind speed of 4 to 7.5 meters per second at a height of 30 meters. So it therefore beggars belief that a country with access to vast energy sources will continue to wallow in energy poverty. So as part of our efforts to enhance energy access, we need to continue to mobilize energy from all sources, particularly renewables, as Frank earlier mentioned. And the potential for renewable in Nigeria is almost limitless. It's been said that the potential is about 400 gigawatts. So we therefore need to begin to design, how much we can use renewables to improve energy access and also improve the lot of Nigerians. And again, as we continue to envision the future of power in the country, we need to reassess whether the current strategy of incremental power is the right strategy for the sector. For an extended period of time, government strategy has been anchored on incremental power, which is very much like taking paracetamol for cancer. I think we need to have a bolder vision for the sector and think big. We need mega projects that can move the needle. And this has been done elsewhere. For instance, just a few years ago, Egypt increased its generation capacity by over 45% in just 18 months. I believe this was the premise for the Siemens deal, which unfortunately, like most things in this part, full of noise, but signifying not much in reality, because for all of a sudden, we are not hearing much about that again. And speaking of mega project, it's very interesting that since Azura, NBET has not been able to procure any significant additional generation capacity. And many projects like OMA IPP, QIPP, Proton IPP, Century IPP, and the 14 solar IPPs and many other projects have sadly not been able to achieve financial close despite the millions of dollars spent by the sponsors in development costs. And this is likely due to MBET's inability to commit to bankable PPA. And without any doubt, this is adversely impacting, increasing the country's stock of generation capacity. Yes, I see that a lot of effort is going into trying to improve the last mile. But again, when that is improved, we may then suddenly realize that we don't even have enough generation. So these things may need to go in parallel. Another issue that we also need to reflect on is whether there is scope to roll back on government's continuing participation as an operator in the sector. For example, the TCN, NIPP. With respect to TCN, we need to evaluate, its ownership and funding by government. The federal government has invested a lot in TCN, and it's not readily clear that the capacity of the grid has significantly improved in the last 7 years, notwithstanding the billions of dollars that has been sunk into it. Currently, the grid still does not cover every part of the country, and its maximum capacity to transmit is still at about 4,000, 5,000. The other day, there was a celebration of the grid supporting about 5,000. I think in the context of rolling back government participation, we see that there's renewed drive to privatize some of the assets that are still within the control of the federal government. But again, there should be more to privatization than just handing over the assets to private investors. Based on experience, there's a cloud of doubt over government commitment and capacity to adhere to the terms of privatization contracts. And it's very telling that only Nigerian investors and Nigerian banks showed any credible interest in relation to the three power assets that were recently privatized, that is Gurara, Afam, and Yola. And whilst this is not a bad thing in itself, the fact that only Nigerians show interest, nonetheless, it is indicative of what foreign capital thinks of the Nigerian power sector. As we know, capital is like electrons and it flows along a predictable path. And where capital is refusing to flow along a particular path, then one should take a closer look at that path and try to understand why it's not attracting the right level of capital. And with respect to the privatization, the proposed privatization of certain NIPP assets, it remains to be seen whether the market conditions and the contractual issues which frustrated the previous attempts to privatize the NIPP assets, whether those constraints and issues have now been resolved, or whether they will play out again. We expect that things will be done differently because it will be interesting to keep doing things the same way and expect a different result. Still in the context of privatization, one issue that remains a big elephant in the room is the issue of the legacy acquisition loans. Rather conveniently, most people, including government, we're not talking about it. Perhaps we're wishing that it will go away like a bad dream. The truth is that the acquisition loans will not disappear and will continue to grow until the loans are resolved in a thoughtful and systematic manner. Otherwise, the loans can dislocate not just the power sector, but also the financial services sector. Again, as we reflect on the future of power in Nigeria, we also need to take a second look at the market design and the role of the regulator. Of course, NEC is doing a lot, notwithstanding the various constraints. However, it will appear that there is much scope for improvement, because from the perspective of the licensees, at times the sense is that the regulator seems to prefer leaning towards short-term quick fixes, sometimes without sufficient regard to the unintended long-term consequences of such intervention. To next credit, it has been very proactive in rolling out initiatives. However, the outcome of those initiatives, the outcome has not been homogeneous. So while some of the initiatives have been spot on, others have not quite worked out as intended due to various reasons, some of which may not be absolutely within the control of the regulator. For instance, I think there is scope for NEC to take a second look at the eligible customer regime, which has caused serious dislocation in the market. The regime was designed to deploy what was said to be 2 megawatts of stranded power. And NEC needs to interrogate whether this is still the case. There is also the need to look at the IDN regime, which is currently being abused and used to balkanize areas that are actively being served by discos. The original intention behind the IDN regime has gone out even by on the face of the regulation, is to serve areas currently not being served or that are underserved. But what we see is that city centers, metropolis, areas are actively being, sought to be converted to IEDN. There's also the need for NEC to pay attention to a number of regulated activities that are currently being undertaken below the regulatory radar. A lot of things seem to be happening, and that NEC is not picking up. Particularly, a case in point will be the process for onboarding eligible customers. It's been said that the process that has been prescribed by NEC is not typically followed by those seeking to benefit from that regime. But to NEC's credit, one of the most innovative solutions introduced by NEC is distribution franchising. The regime has the potential, in my view, to transform the last mile of the value chain. I'm sure we'll hear a lot more about this during the panel discussions. However, to ensure that the distribution franchising regime lives up to its potential, NEC must ensure that all the other government agencies, including the BPE, are pulling in the same direction as NEC. Otherwise, the regulation will not achieve the purpose that was intended to achieve. Another issue to reflect on is the issue of electricity pricing. This has been flogged, so I will not necessarily dwell on it. Safe to say that we need to find the sweet spots between the inherent conflicts that exist between the interest of the operators and the preference of the consumers, not least because the long-term sustainability of electricity access is dependent on appropriate pricing. In that context, we must also continue to interrogate our near spiritual attachment to the MITRE in its current form and begin to query whether the model is working as intended or whether there are alternative models that can work better in this part. We must allow dynamic market forces and economic variables to determine the true cost of electricity. And on a final note, as we consider the future of electricity in Nigeria, we must begin to look at other opportunities and wider possibilities. For instance, we need to reflect on the opportunities presented by AFCTA for the Nigerian power sector, especially for our generation companies. The world is transitioning to clean energy. We need to begin to look at the impact of energy transition on our generation mix. We also need to begin to explore the possibility of hydrogen generation, which appears to be the direction in which the world is moving now. So ladies and gentlemen, looking at our lineup of speakers, I feel certain that today's event will be very energized and throw up solutions and perspectives that can assist in fitting the missing pieces of the Nigerian power puzzle and assure a secure and sustainable energy future for the country. I thank you for your kind attention. Mr. Igbogun, over to you. You're muted.
Yeah, I just realized that. Thank you. Well, thank you so very much for your conference framer. You spoke about a bolder vision encompassing mega projects that are capable of making or delivering huge impact, and how it is that it is imperative that we move the needle. We seem to be seeing a lot of motions with very little movement. And you asked the question whether there is a scope for a rollback in government participation, and also, in my view, how we can fast track the unbundling of TCN and perhaps the establishment of regional grids that can better serve Nigeria, given the size and diversity, but most importantly, the urgency and the huge work that we must do. 70 million people. I heard for the first time this new phrase now about Nigeria being the poverty capital of the world. Anyway, let me very quickly introduce our next, the panel for our first session. He's Jonathan Aluju, who is a partner at Olaniwu Ajayi. He will be moderating the session on unlocking liquidity in the power market and resolving especially the thorny issue of metering. Jonathan will have in his company Ademola Adegusi, who's Group Head Power Infrastructure at First Bank Nigeria. Emuyiwa Akiyemi, General Manager at UBA PLC. B. Barry Clark, Senior Special Assistant to the CBN Governor on Energy and Power. And Edu Okeke, Managing Director of Azura Power West Africa. It's instructive that, well, let me say that since Azura, we haven't had the courage to do anything in terms of expanding power generation. We will also have Christian Mulamula, Head Infrastructure at IFC. My friend Ahmed Zachary, Special Advisor to the President on Infrastructure. So that's the panel, a terrific panel. I can't wait. So let me very quickly now ask Jonathan to take the floor. Thank you very much.
Thank you very much, Mr. Ebogun, and good morning, ladies and gentlemen. It's my pleasure to be moderating the first panel. Once again, my name is Jonathan Aluju, a partner with the firm Olaniwu Ajayi, one of the partners in our power infrastructure team. Thank you once again, Wolemi, for that insightful primer. And I think it sets the tone for what we'll be discussing, particularly on this first panel, which is unlocking liquidity in the Nigerian electricity supply industry, the NESI. Now, Wolemi did mention the initial attempts by the CBN, Central Bank of Nigeria, to ensure some level of liquidity in the power sector, dating back to 2015. Now, we know the privatization occurred in 2013. Now, following the privatization and given the state of the market at the time, the government felt, let the market run based on the interim period, interim rule that was set up at the time. So the market generally just operated the way it was prior to privatization. But in 2015, the government thought, it was time that the market runs on its own full steam, governed by the contractual agreement entered into by the operators, in relation to delivering power to the sector, right? And then that gave birth to the declaration of the transition electricity market, right? And then to properly introduce that market, the CBN came up with the market stabilization facility of 213 billion, which Wolemi mentioned, right? Which was aimed at paying all legacy debts that had accrued between 2013 and the time, so that the market can start on a clean slate, and then, market operators deal with each other in terms of the contractual arrangement they have, the schools able to pay the generation companies, and then the generation companies, and the NBET, what NBET is able to pay the generation companies and also the gas suppliers, right? That was the intention. But this is 8 years after, and it would appear that nothing much has happened. As Mr. Ibogun mentioned, it's been a case of motions without much movement, right? There's still significant illiquidity in the market, right? On the one hand, the discourse, clamor for tariff review, a favorable market condition to allow them operate and be able to make the required revenue to operate the asset. And so there's no significant investment in the assets. Customers, end user customers, on the other hand, keep complaining that they can't afford to pay higher tariff until there is power availability. And so there's this question of, are we in the case of the chicken and egg situation here? So why are we where we are today in terms of the market being where it is without it being liquid? And I have seasoned professionals, gentlemen, to assist me resolve this puzzle in trying to unlock liquidity in the power sector. I'll quickly do a brief introduction, then we'll go right ahead into the discussion. Muyiwa Akiemi, is a general manager in United Bank of Africa, BSc degree in accounting, and also, chartered accountant. Muyiwa has been very involved in the power sector, right from the privatization in 2013, and has closed a lot of deals in the power space, particularly as it relates to the acquisition of the assets. He was also trained in leading institutions, including Harvard Business School, Watts Business School, amongst others. Another gentleman is Ademola Adebusi, who has about 25 years banking experience in corporate finance, treasury, energy, construction, infrastructure, finance, etc. He raised about $200 million for the acquisition of the power assets in Nigeria. He's currently the group head infrastructure at First Bank of Nigeria, where he oversees the power, infrastructure, construction, and maritime sectors. Also a fellow of the Institute of Chartered Accountants of Nigeria and the Chartered Institute of Bankers. Christian Mulamula is the head of the infrastructure team of IFC based in Lagos. I'm a principal investment officer with over 25 years of experience in infrastructure, including natural resources and mining. He has a background in engineering, accounting, and finance. Mr. Edo Keke, yes, most of us know him, he's the managing director of Azura Power West Africa. A seasoned director, manager with over 25 years experience in heavy capital-intensive industries. And prior to assuming the role of managing director in Azura, he worked with Guinness, Breweries, Schlumberger, GE Palm, water. So he has significant experience, at his belt. The man with the money, Mr. Eddie Perret Clark, currently the acting special assistant to the CBN Governor of Energy, and has been involved in the Nigerian power sector for the better part of a decade. He holds a bachelor's degree and master's in engineering from the University of Cambridge. And the last not the least is Mr. Hamad Zakari. Mr. Hamad Zakari is currently the special advisor to the president on infrastructure. Spent most of his career with General Electric, and in fact was among the youngest set of engineers admitted to build a career, at General Electric through a program known as Edison Engineering Development Program. So definitely a seasoned set of analysts to speak to this issue on unlocking liquidity in the NESI. And I think there's no better place to start than the man with the money, Mr. Clark. I think our participants will be keen to understand the role of the CBN towards ensuring liquidity in the power sector. And so grateful if you could share your insight into the various interventions put in place by the CBN towards ensuring the required liquidity in the sector. Mr. Clark, please.
Okay, thank you, Jonathan, and good morning to everyone here. I think that, before I describe and detail the CBN's interventions, I think we need to sort of define what we mean by liquidity. Essentially, the market should be able to raise money to pay for all the contributions made by the fuel suppliers, the generators, and transmission and distribution. Now, when that doesn't happen, a shortfall is generated. The main issue is, what are the reasons for that happening and who is responsible for covering that shortfall between the three parties in the market, the government, the investors themselves, or the customers. Now, as was mentioned previously, that there is a gray area in the market design, as definitely when it started, it was never fully clear who had that responsibility, depending on the cause. Typically you can say that the government might play a role if it subsidizes a market. Other ways you could say is that the investors find funds to plug that shortfall and they are repaid sometime in the future by future customers. So the specific design of the market in 2013, 2014, 2015 never really made it clear how that shortfall was to be covered at the time, and then for the party that covered it, how they were going to be repaid. Now, that being said, the CBN obviously came in, and you have to sort of understand that the problem occurs first before the CBN comes in, and that is the reason that there hadn't been an in-place design. First of all, we came in, as was mentioned, with the 213 billion NEMSF, Nigerian Electricity Market Stabilization Facility. And as mentioned, that was to pay for the gap that had arisen between the privatization and the start of TEM. But going forward, this question of how this shortfall is to be plugged and who caused it was not answered. So as the market progressed from 2015 to 2017, another gap occurred. And because of that, the payment assurance facility came in, which was to provide the generation companies with a level of assurance that as these gaps appeared for a variety of reasons, part of the reason being non-cost reflective tariff, i.e. the acknowledgement that revenues were not enough, and also part of the reason being perhaps the operational efficiency of the discos itself, that the generation companies were going to be paid. So we came in with the payment assurance facility. And of late, now that the service-based tariff has been brought in, the focus more now of the CBN interventions is more towards capital investment. We are providing funds for investment in CapEx for meters. We're bringing in interventions for investment in CapEx, in distribution and in transmission networks. So the point of that investment is to improve the efficiency of the networks in being able to collect the money. So going back to this long story, as I said, the question is, why has the liquidity arisen? Who's responsible for it? And how is that to remedy it? And principally, the CBN has played a part in trying to remedy that, both by paying for historic shortfalls that had arisen, and presently, and more importantly now, investing in capital expenditure that would reduce future shortfalls and improve efficiencies. I hope that answers the question.
Okay, thank you very much, Mr. Clark. I'll just quickly ask a follow-up question. I think you touched a bit on it in the course of your answer. And so there is one thing to ensure there's liquidity in the market, starting with what was done in 2015. And then we have a lineup of intervention fundings in the pipeline, at the moment. And so the question is, how sustainable do you think these intervention, facilities would ultimately be? Because it appears there is a number of constraints which, if not appropriately dealt with or addressed, would simply amount to a case of you pouring water into basket, right? And so we have the significant issues around the grid constraints, the significant ATC and sale losses by the distribution companies. There are also issues around the tariffs and all of that. So I'm just thinking, what is the CBN perhaps working with other regulatory agencies to ensure that these other, externalities, right, which may constrain or undermine the, intervention, efforts by the CBN to ensure it doesn't go to waste?
As I was trying to describe before, it all depends upon what the money is being used for. If, as it is to make up for a shortfall in revenue, then you can say, how sustainable is that? That isn't sustainable. If the intervention is to invest in capital investment in the networks, then that is definitely more sustainable. It all depends upon the economics of the market. And as was mentioned, the economics of the market is designed by the economic regulator, which is NERC. So we've moved more from a less cost reflective to a more cost reflective. So because of that, the market should be more sustainable. And therefore, we have the ability to look towards interventions that focus more on addressing the lack of investment in the market to make it grow, rather than address the lack of cash that had historically arisen due to inefficiencies in the market. If interventions are to be for cash shortfalls, they're not sustainable. If interventions are to be for investments, then by definition, if those investments are well placed, they are sustainable.
Thank you very much, Mr. Clark. So moving on to another panelist who also has the money. And my next question will be directed at Muyiwa. So Muyiwa, you've been very involved, with the power sector from 2013 when the assets were acquired. So I know your bank and that of Ademola and a number of the other Nigerian banks funded the acquisition of those assets. But it would appear post 2013 that the local banks have taken a back seat, in providing any additional funding to the sector. So my question would be, what do you think is responsible for this? And then just a follow-up question to that, with what Mr. Clark had mentioned in terms of the intervention facilities or funding initiatives being put forward and put together by the CBN, do you think that would, change the attitude of the local bank and provide some interest in funding the sector going forward?
All right, thank you so much for that question. I think Ebi has laid a very fundamental point about what is happening in the market. As you all would recognize, there are two key things. There's the illiquidity in the market and the insolvency of the operators. So the issue we're having to deal with has to do with the illiquidity in that market. And to correct your point, the banks have not taken a backseat in this sector for some time. Actually, banks working along with central bank have taken more or less like a front burner to see how to make this sector work well and be more liquid, and to also support the various investments that various stakeholders have had in the market. If we draw our mind back to 2013 when we started out, there were certain parameters upon which the banks undertook certain financing. Question is, those parameters have not come out as forecasted, and so the banks have had no other obligation or no other interest than to work with central bank and other stakeholders to see how to stabilize the market. And banks have been working very closely with central bank and other necessary stakeholders to ensure that the market returns to where it's supposed to be. But speaking to the point about bankability of transactions, or how banks would work in, would be able to do a lot more in terms of acquisition financing, I think you will be looking at how the structure of the market is and the correction of certain things that are in that market that we've observed, which regulators and other players are also trying to fix. As you all know, the subsidy exists in that market today. The question is, would a bank want to continue to finance transactions in a subsidized market? I think not. You would rather want to finance commercial transactions. You are not a DFI that will be looking at such transactions where the subsidy will be what will be relying on for your repayment of the transactions. The second point that has also changed over the period is also the FX. When we did these transactions, foreign exchange was, I think, about 20% of what it is today. And that has also changed in the repayment ability of those stakeholders as well in whatever it is that they're doing. So there must be a mechanism in which we can address those two fundamental things. One, correcting the sector as it relates to subsidies and what applies and how investors will be able to reap their returns. And secondly, how to also cover the exposure to the foreign exchange in the foreign exchange market, aside from other points that I'm aware that central bank and stakeholders are also trying to resolve in that market with NEC, as the case may be. Once those things are resolved, surely banks will be doing a lot more in terms of privatization. But mind you, banks are also working on the other transactions in the power sector, be it across the entire value chain. So you have a lot of banks supporting captive power plants, aspects, and so some other smaller transactions that may not be as loud as you would expect. And if you also look at the new initiative of government in the Solar Nigeria Power Scheme, banks are also supporting government in that initiative as well. So banks are not absent for the power sector. It's a critical utility, and banks can never be absent for that type of sector. That depends on where we want to play in the entire value chain in the power sector.
Thank you so much, Muyiwa. My next question will go to the colleague of Muyiwa, who is also the man with the money. That's Mr. Demonla Debussy. So I guess flowing on from Muyiwa's response, my question will be, what other changes do you think you will need to consider as, a prerequisite for debt financing by local banks of the NESI, right? So in essence, what advice would you give to discos looking to financing from local banks? And then in terms of the ongoing restructuring of the market, one of which is you now have sight over the money, right? So, the money sits with you, and given the directive from the CBN, you are able to determine how those funds are utilized, just speaking generally. And so just asking, what other things do you think should be in place to enhance the chances of distribution companies? I'm being careful with my words. Distribution companies, I know Muyiwa had mentioned that they are also involved in off-grid, projects, but then just bringing it back to the grid situation, which is not as palatable as we would want it. So just your views on the things that you want to see, perhaps minimum remittance level from distribution companies to NBET and the market players generally that you need to see. Mr. Debussy.
Thank you very much. Good morning, everyone. Following on from Muyiwa's comments and that of Ebi, I think clearly all I'd like to say up front is that banks have actually not stopped lending to the power sector. And if we do an analysis, we find out that our funding post-acquisition in 2013, it's probably very close to the amount of funds local banks provided to support the privatization program in 2013. But it's just that the lending has been to specific subsectors in that space, mainly to generation and also metering. So even as we continue to support those areas, it's getting to a stage whereby we also need to be very careful as lenders. Before it's becoming systemic, and it's like cancer, it could spread, because it's a limited capacity that the sector could be able to take in terms of funding. But I think the federal government and CBN has actually made moves to redress that issue, and I must commend the CBN for that. The initiative to just restore things in that market, and that is on track. So what do I actually require? What do I want to see? The discussions by CBN, NEC, and other parties have actually, it's been an holistic view of the issues and challenges in that sector, and they've tried to profile solutions. So what is actually required is the continuous and rigorous implementation of all those things. If that is done, I think things will change dramatically. Then the Siemens project too is not something we should ignore. I think it's something that should come to the front burner as quickly as possible, because of the funding requirement we actually need today to revive that sector is very huge and among us, and we need to deal with transmission-related issues. But one area that I don't think enough attention has been paid to by the sector, it's in the area of power thefts. It is very huge, and we need to change our people's behavior. I want to begin to see prosecutions, and where there are prosecutions, it should be publicized so that people know that it can serve as a deterrent to that, because it's very huge. I live in an estate that today, power loss as a result of energy theft, it's about 30%. And some people will do this and have a effrontery to get policemen to even come and harass and intimidate employees of the estate. So it is very critical. Once you do that, because there is a lot that is attributable to that, it is being underestimated. Nationwide, that has been underestimated, and attention needs to be paid to that. Okay, with regards to your other question, the advice to these schools looking to raise funding from banks. Well, like we were mentioned, the issue of liquidity and solvency is very key. And without that, a couple of months ago, the discos were tending towards insolvency. They've been illiquid for several years. We're tending towards insolvency. So for a bank, it's a minimum credit principle. No bank lends to a company with a negative shareholders fund. So the first thing the discos need to do is they should clean up their balance sheets. That has to be cleaned up. That's only when they can even consider they'll be eligible for consideration for a facility, because we begin to look at other things. And that may also involve them seeking some further equity injection or some long-term debt, because clearly we know what their issues are. It's around the commercial and collection losses, and that needs to be addressed. And as a bank, one of the things I also like to see is their clear strategy to reduce and eliminate commercial and collection losses. And this has to be monitored over time. We'll see that pattern to show that their revenue is increasing, those losses are reducing, and they are in the clear path. And as we begin to expose ourselves to Naira depreciation, etc., it is very important that we also, government has tried a lot in regards to the tariff. Inching that significantly upwards. Gradually that also needs to be taken a look at. And whatever it is that accounts for all those high costs must also be addressed to reduce the cost of those businesses significantly. Yeah, the top question is on remittance level. Well, I think that is being determined by NEC in collaboration with MBET and the discos. For me, for now, it is fair and reasonable. Like I said, what is very important to us as a bank is to see that those initiatives in place to take out those losses are successfully implemented to reduce the commercial and collection losses. And we also see that the monthly collection is going up significantly. Trading up, that is also very, very important, that is going up significantly. And once that is done and the balance sheet is clean, I think the banks will begin to take another look at supporting it. So the kind of funds, honestly, that the discos need today are very long-term debts, minimum of 10 years. That also poses a challenge on local banks providing that kind of facility. Say there are some form of interventions, or we can pull funding offshore. Thank you, Jonathan. Yeah.
Great, thanks so much, Mr. Debussy. Mr. Ahmad Zachary, we'll be keen to get your insights on where we are in terms of the transition from a cost reflective tariff to a service reflective tariff in September of last year. So we just want to understand, of course, for the benefit of the listeners, before Mr. Zachary threw more light on this, the idea is to ensure that payment by end users is reflective of the service they get, right? And then that would, of course, ensure some level of discipline and efficiency on the part of the discos, right? And so, Mr. Zachary, can you just share your insight on this transition from the cost reflective tariff regime, which we've had in the last 7 or so years, to the service reflective tariff, right? And you know, if that has had any sufficient impact, right, or in your view will have some impact on the liquidity of the sector going forward.
Thank you, Jonathan. The issue of cost reflectivity of our tariff is at the heart of any critical work that's going to be done in the sector. And if we take a trip down memory lane, you'll note that if we go back to 2015, the gap between what we refer to as cost reflective versus the allowed tariff was 15 Naira. And the balance, that 15 Naira gap meant that government, for every 1 kilowatt hour that was consumed by a Nigerian, irrespective of their level of access to power or financial position, got that subsidy. And we went through 2016, 2017, 2018, 2019 with very limited review of the allowable tariff. Some was due to government policy, some was due to litigation against the regulator. And at a peak in 2019, the gap between your allowed tariff and service and cost reflective tariff was 28 Naira. That resulted in almost a 600 billion Naira subsidy bill for 1 year in 2019. Clearly, that was an unsustainable approach, and it began to look very similar to the PMS subsidy that we so often had complained about as a people. Because if you think about more than $2 billion of subsidy, a regressive subsidy that doesn't necessarily care if you're rich or poor, that was something that obviously coming into the challenges that we've had was unsustainable. And the government made a deliberate approach to start to move to more cost reflective tariffs. And the approach that was taken by government was the introduction of the service-based tariff, which allowed you to look at end users that are receiving adequate supplies of power, and they pay a higher amount, whereas the lower levels of supply would pay a lower amount, pending the conclusion of the regulated performance improvement plans that have mandated the discos to improve the network throughout. And where we are today is we are at the closest point we've ever been post-privatization to the allowable tariff and the cost reflective tariff. As of the last cycle, the cost reflective tariff was estimated at about 58 Naira. The allowable tariff in the market, if you blend the rates through bands A and B, is about 45 Naira. So as I told you, in 2015, the gap was 15 Naira. Currently, it is only 13 Naira. And what we're working to do is by early next year to eliminate that gap in its entirety through two sets of approaches. You can eliminate the tariff subsidy either by reducing the top, which is how much it costs, or increasing the bottom, how much it's paid for. And we're doing a host of initiatives to reduce the top and increase the bottom, so you reach a point where there's no more subsidy. On increasing the bottom, obviously, we took the measures to bring the tariff to more cost reflectivity in September last year with the introduction of the SBT. We've effectively executed another minor review in January, although it was implemented in April because of the gaps we had with labor, which we've now closed. And in July, we're also gonna, look at the minor review. We'll continue to do the minor reviews every 6 months. I think that helps us with some of our funding from our development partners like the World Bank. But more importantly, it ensures that on a day where the consumer is able to pay for what it fully consumes, that then goes through the value chain. So we're closer than we've ever been. The service-based tariff is allowing us to have an approach where there's more equity, and with all the work that we're actively doing with the central bank, as well as other participating financial institutions, led by our work with EBI and the CBN governor, to provide infrastructure and metering. We do see a very clear line of sight to eliminating this subsidy and allowing for the market to exist. And you have to really assess. Government is doing these interventions and this policy shift at a very, very difficult time economically for our citizens. So we're trying to balance how rapidly a tariff can increase with efficiencies to reduce the top level cost. But that cannot be done without infrastructure. And I liked what Mr. Clark said around the sustainability. We're moving away from consumption subsidies to support for the discos through financing and loans to meter and to build infrastructure. And we're very confident we'll get to the promised land. In closing, let's not think that we can fly without a plane or without wings. If we've not done infrastructure investments since we've privatized this sector and infrastructure has lagged, the only solution is to get the infrastructure in. And when you get the infrastructure in, you'll have a more sustainable resolution to our market conditions. And that's what the government is focusing on and is committed to.
Thank you very much, Mr. Zachary. Very useful insight on that. Let me now turn to Mr. Edo Okeke, the MD of Azura. So, Mr. Okeke, Azura, of course, accounts for about 10% of the power dispatched to the grid today. So it would be useful to also get your thoughts as a key player in this sector on how you think liquidity can be improved, today in the next year. Your thoughts, please.
Thank you very much, Muyiwa. And yes, before talking about how liquidity can be improved, I must first of all congratulate the current government officials. Two of them are on this panel, Eddie Clark and Ahmad Zakari, for what they've done in the last few years. Let's look back at what happened when, after privatization, there was that plan to bridge that liquidity gap. NERC was very focused on that, but towards the 2015 election, I think that's when we lost the plot and we diverted. And ever since then, there's been quite a lot of subsidy in the sector, but unfortunately, it was consumption subsidy and was never going into production at all. So the thing kept growing, okay. Both Abi and Ahmad, they've talked about the 213, then you think of the 600 and then the 701. We kept pouring money into a basket. Until September last year when bridging this gap started, and we are very supportive of it because it's very important for us to bridge. You know, people talk about Azura, but nobody invests in any project based on subsidy at all. We invested in Azura because we saw a path then towards the sustainability of the sector. Unfortunately, between 2015 and 2020, nothing happened. And the gap, rather than closing, opened up a lot more. So as a generating company, we are at the forefront campaigning for this, lobbying for this, that this liquidity should improve. And I think what we've done with service reflective tariff is the first step, but I think we have to do more. I think also one of the key things we have to tell ourselves, the truth, is that Nigeria does not have enough generating capacity for the population. Let's not kid ourselves on that. So I think one of the challenges that we face is when we give this impression that, oh, if we get to this tariff, that all of a sudden is Eldorado for everyone. And it's not going to happen because we are also having a theoretical number where we think of number of customers. As the First Bank executive said, you also have a lot of power theft in there. People are not willing to pay because grid power is still back up to so many homes in the country. I think it's very instrumental that we tell Nigerians, those that enjoy the services should pay for it. It's very simple. We normally look at power and we compare it with the telecom sector. And I keep telling people, when GSM bettered in Nigeria, we bought SIM cards. Some people bought SIM cards for more than 50,000 naira. They paid for that original infrastructure. And then as you keep expanding the infrastructure, the cost starts coming down. So I will go further, and say, not every Nigerian should have electricity. We should just tell ourselves the truth, that we don't have enough capacity for everyone. Let discos also look at their network and say, I am going to prioritize just 2 communities. They are going to have 24 hours electricity, and those people will pay the full cost for the services. And the discos will now make, as they make money, as they expand their network, it flows down the chain. As they pay their bill against the discos, TCA will make enough money to be expanding their network. And we should be planning. Gencos, what let me say before, Azura, let's understand it, in the last 10 years, Azura is the only generating company or plant that has been built in Nigeria. And today I don't see any line of sight to another project. So we seem to be solving problems in silo, that you finish maybe fixing the disco end, you now realize that we don't even have capacity to do more because nobody is planning for it today. And we now, all of a sudden, you have that gap, everybody will rush into the Genco space again, and you start solving that one. By the time you finish, something has developed at the transmission end. So we have to do it and do it holistically, so that I will expect that as Azura was, we reached COD in 2018, There should be another power plant coming up in 2019. Another power plant should have been built in 2020, 2021. It should be happening like that. But we are not doing it. But all the same, it doesn't take away the fact that the principal problem for the sector is I don't even want to call it liquidity, is the insolvency in the sector starting from the disco end. I hope that what we are doing today, CBN is doing a lot, but can CBN fund the whole thing? The answer is no. We need private money there. We need long-term lending. And that's also now where it touches on one other part of the whole thing, which is the forex issue we have in the country. Because the problem for the sector is actually not boats and wires and everything, it's commercial. So power industry is a dollar industry. Let's look at it. 90% of the cost in that sector is dollarized. So as long as companies also having it difficult, having that difficulty procuring forex, those problems are gonna persist there. So as you are thinking of adjusting the tariff, you have to also take into consideration that if the Naira depreciates, that gap opens up again. Those are the things that come into play. But all in all, I must say that we are very supportive of the actions being taken so far to improve the liquidity in the sector. And the only thing is we are asking that government be bolder and do more, because we can't afford, as Ahmad said, next year. No, we should be closing the gap today, not next year. Because my worry again is that by the time we're talking of next year, then people will be thinking of election in 2023 and the whole thing derail. All of a sudden, you now get to 2023, the gap becomes big again. So we should be closing the gap today rather than next year. Thank you very much.
Thank you very much, Mr. Okeke. I'll come back to you shortly on at least one of the points you raised. Mr. Mulamula, you are in the DFI space, and IFC definitely has been very active in the Nigerian economy at large, and also the power sector to be specific. Now, given where we are today globally, in terms of the pandemic and its impact, globally and of course in Nigeria, do you think we can expect to see investment from DFIs in the coming months, perhaps as restrictions around COVID reduces? On one hand, I want you to answer this with thoughts that have been shared by other speakers around initiatives being put by the government, the CBN and regulators generally, on service reflective tariffs and all the funding initiatives. And if you think that those efforts are sufficient to turn the tide of liquidity. So just useful to hear your thoughts generally on that. Mr. Mulamula. Hello, Christian Mulamula, are you there? Hello?
Hello.
Hello?
No.
We can't hear you. Okay, maybe we'll come back to you. I guess maybe it's having connection issues. So maybe let me quickly go back to Mr. Okeke. So we've mentioned so much about the fact that we need more generation capacity, right? But it would appear that given where we are today, that may not be the major issue. Because there's this point around the fact that we appear to have more generation capacity than the available infrastructure to wield that power. And so you have significant stranded power giving constraints at the grid, right, at the TCN level. I'm so looking at that, what in your view do you think the government should do quickly, to address the bottlenecks at that level? Because there's no use generating capacity and then it's stranded and it can't go through the network. So what do you think the government needs to do to urgently address that situation?
First, let me say, we hear this stranded capacity a lot, and I think the jury is still out because just recently we had some issues at our plant and we are out for a few days. And during that period, I kept getting phone calls from TCN asking me when I go back because we didn't see any other plan to fill our capacity, which is about 450 megawatts we put on the grid every day. There was no other generating capacity to put it. So when we say there is this stranded capacity, we have this excess capacity everywhere. I mean, the jury is still out. I like the fact that I think NBET with NERC is going around power plants in the country today, doing some capacity tests to establish what we really have, because I don't know if we account for the rated, that's the actual output today or the nameplate of power plants, because a power plant that was built 20 years ago and probably the output at COD was maybe 500 megawatts. Is this still going to 500 megawatts today? It's probably going to come down to 300 because there will be the ratio. I mean, you don't know a lot of things happening there. So I still have my challenge there. But then let's assume there is that stranded capacity. But the question we need to ask is 4,000 megawatts good enough for Nigeria? Leeds is not a big city in the UK. Leeds is a mid-level city. Leeds alone uses more than 4,000 capacity on a daily basis. So when people tell me, oh, we have this, we have this excess capacity, well, what we do every day, Lagos alone should take more than 4,000 megawatts. So that's why I keep saying we have to have a holistic view of the whole thing. The unfortunate thing is that the money that has been poured into the sector in the last 10 years have all gone to consumption. It's about subsidizing consumption, so to say. We haven't put money into production. And how is it going to do? I mean, how many discos have carried out a proper analysis of their market to say, this area, I mean, for example, there was something we needed to do in Aba some time ago. I was in Aba for 3 months with a team of engineers. We knocked door to door to try to establish the demand in Aba. And the demand in Aba alone is more than 150, going to 200 megawatts. But we can only put 90 megawatts in Aba. So you have a city that needs about 200 megawatts, but you can only give 90 megawatts. You're telling me we have stranded capacity. There are quite a lot of things. And we should have, I mean, it's about DISCOs and TCN investing in the network. But it can only happen if we channel resources to capital, to projects, rather than to consumption. That's what I'm saying. So this, in terms of the liquidity, the tariff, reflective tariff, is very important that DISCOs get to that point where they are investing in their network. I don't know how many DISCOs that are investing in their network today. I can't see any major project TCN has really done in the last 5 years. We have to be doing those projects. But what I'm trying to say is, as you do those projects, let's understand that power plants are not built in a day. Azura, we started the project in 2009, and then we got to COD in 2018. You understand? That's 11 years from concept. So you don't just wait until you fix the DISCO and GENCO transmission space. You start where is the next power. We have to be planning everything holistically today. Thank you.
Thank you very much, Mr. Okeke. So let's hope Mr. Mulamula is back.
Yeah, can you hear me?
Yes, we can.
Okay.
Did you hear my question?
Yes, I did. Thank you. Sorry, I had a snafu with my headset, and I was able to fix it. So look, I know we're probably pressed for time, so I'll press on with a response. I think what some of the things that were said by, for example, Mr. Zakari, they really resonated with me, and also what Mr. Okeke's comments, they have really resonated with me. It really all starts by having a sustainable power sector. And you can only be sustainable when the sector itself can stand on its 2 feet. where we are right now, Nigerians are paying less for electricity than what it costs to supply that electricity to them. That is not sustainable. You know, you cannot be consuming something and paying for it less than the person who is producing it spends to produce it and give it to you. You know, and that's what we're talking about, the cost reflective tariff. And I think Mr. Zakari has articulated that very well, that the government policy obviously now is to push towards achieving a cost reflective tariff. And what does that mean? In the power sector, cash comes into the power sector at the bottom of the value chain and it trickles all the way to the top. And if you don't have sufficient cash coming in at the bottom, then not enough cash gets to Mr. Okeke up there at Azura, and therefore he doesn't get paid, and therefore he shuts down his plant and is no longer producing electricity. There has to be enough cash coming in at the bottom, and that's the cost reflective tariff. Now, there's been talk about the service reflective tariff, the service reflective tariff. I think Mr. Zakari was very accurate about it, or I think Mr. Okeke who said it, that it's really about equity. You know, it's sort of the path to get into cost reflectiveness. Are you gonna go directly, you know, whereby everybody pays the same as you achieve cost reflectiveness, or are you gonna try and achieve some sort of equity of some sort, meaning that the people who can pay more, who get better service, etc., pay a higher tariff? So the service reflective tariff to me is a bit of a nuance of the cost reflective tariff. The cost reflective tariff is a basic essential thing that you require, and unless you achieve that, you will never be able to get, you know, funding coming into the energy sector. I think that's very fundamental. Now, with regard to the initiatives, for example, on the metering, I think those are all great initiatives, you know, but they obviously attack only one or two specific issues that are ailing the sector. The other issues still need to be tackled. I'll give you an example. The World Bank data says that for every 10 naira of electricity received by the discos, about 2.6 naira is lost due to poor distribution infrastructure and theft. And then they say about 3.4 naira is lost, is just not paid for. Now, metering is probably going to address that not paid for portion of it, that 3.4 naira, but it doesn't speak to the 2.6 naira, which is poor distribution infrastructure and theft. So all those still need to be addressed, even though we're going through this mass metering, etc. All those components need to be addressed. And remember, that is only in the distribution. We haven't addressed the losses on the transmission side as well. So throughout the entire value chain. So I think, you know, and some of the speakers ahead of me echoed that it has to be the entire value chain. It has to be a holistic approach. I think Mr. Zakari has correctly pointed out that's the focus of the government to the PSRP, focusing on all those issues and bringing them all together to address the liquidity in the power sector and putting it back onto a solid footing. And it's only when you do that that we'll be able to achieve, you know, growth in production, growth in generation, growth in distribution. And the more electrons we put through the system, I think Zakari pointed out, the gap, you close it by lifting the bottom and also dropping the top. The more electrons you put into the system, it allows you to bring the top down and narrow that gap. So at some point, we want to start pushing a lot more electrons through the system. I'll stop there, Jonathan.
Thanks so much, Christian. One final follow-up question to you. You mentioned the financing, you know, funding initiatives by the IFC, particularly on metering. I mean, I just want to, we don't have time. We had a full question that was directed at another panelist on that point, but I would just want you to just speak in terms of how has that fared, you know, what's been the challenges in terms of funding metering, because that's also another vehicle through which the required liquidity, you know, in the sector can be ensured. Just in 1 minute, if you can just quickly give us your insight on the funding of metering in the country.
Yeah, I'll be really quick on that. So at the end of the day, you know, the federal government of Nigeria went through the MAP system, which is a meter asset provider system, and I think the consensus is that it has not worked very well, because at the end of the day, meter financing is really just about how a company funds its assets. Okay, so the discourse would ideally by financing of metering is how a disco chooses to finance its metering. It can either go and just borrow and overdraft facilities and buy meters, or it can somehow carve off those meters and do some asset financing. But that is only sustainable when the entire sector, is sustainable, because ultimately the repayment of those facilities depends on the sector as a whole. And as I said, the cash comes right at the bottom. And if it's not coming in at the bottom, all of those initiatives are not sustainable. I hope that was useful.
Great, thanks so much, Christian, Mr. Mulamula. So unfortunately, time is not our friend. Very useful insight. But in closing this panel session, I would just like our speaker in 30 seconds to 1 minute max, just to give your closing remarks in terms of this panel discussions. I'll start with Mr. Muyiwa Akiyemi. If you can just quickly give us your closing thoughts.
Okay, thank you for this platform. And I think what we need to be looking at in this sector would be how do we leverage on the capital markets and ability, other alternatives to raise long-term funding. Power companies and utility companies do not require short-term funding. It's a long-term game, so they need long-term capital. Perhaps government will also be looking at the situation wherein BP can take them to the market at some point in time. And even those owners can also go to the market to access long-term capital to fund their entire activities and be more expansive in their activities. The second part, that the chain that we need to also resolve, aside from what my other speakers have spoken about, is the transmission chain. That requires a lot of investment from the Azura down to the last mile in the marketplace, okay, the consumer. We need to be able to fix the losses that occur across that chain. And with all of this, banks will be a lot more interested in working with the various stakeholders in the sector, rather than having to rely on government intervention at every point in time. But I must say, government, especially central bank, has been very, very supportive, and key stakeholders, and also Office of the Vice President and NEC as well, supportive in revamping the sector over the past months, and to see some stability in what we are seeing today. And we thank them for all they're doing to ensure that we have a sustainable power and NESI sector. Thank you very much, everyone.
Thank you so much. Mr. Clark, your closing thoughts, and if you can use the opportunity to just answer one question. Do we have a specific date to transit from phase 0 to phase 1 in the NMPP program? If you're able to answer that in your closing remark, that would be great.
I'll answer that first. No, there's no specific date today for that transition. Let me just do my closing statement and I'll sort of round up. To me, it's simple. It's the economic model. And obviously, I'm going to blame the fiscals as a monetary person. Now, let's look at Lagos. If you look at the Lagos State Report, and it's something that came up, in a 2015 review of generators in Lagos, the state government counted 15,000 megawatts of generators. 15,000 megawatts. No generator manufacturer has come to the CBN and asked for concessionary money. No generator distributor has asked for FX, but yet 15,000 megawatts of generators have been sold in Lagos. Now we look at Echo and Ikeja. On a good day, they will get 1,000 megawatts. And we are struggling, we are straining, we are talking about technical losses, commercial losses, collection losses. But Lagos citizens have walked out and bought 15,000 megawatts of generators in 2015. It is the business model. And until you assign who pays for what, and you do it correctly, we will keep on be talking about technical losses, commercial losses, collection losses, and who should be paying for them today to pay them back later. It needs to be resolved. So I would say that if you can't sell power as a service through transmission lines, and you can only sell power as a product via generators, it's the equivalent of saying that Netflix doesn't work because everyone's going to Blockbuster. And that is a staggering thing to say. It's simply staggering. How badly do you have to run Netflix for everyone to go back to Blockbuster? That is a question we are saying. So we have to solve the economics and we have to solve it correctly. If not, we will be stuck in this. Thank you.
Thank you so much, Mr. Clark. Mr. Debussy, final thoughts, 30 seconds. Demola?
Yeah, sorry, please. There was a bit of a connection issue for a few minutes. I think I'm back. So clearly for me, I think what is very important, one of my major concerns in the sector now is, and we appreciate what the government is doing through CBN, the funds being pushed into the sector to revamp it. I'm also a bit worried about the capacity of the discos to absorb this debt, such that it's not as if that's a challenge you're facing now, are just moving it forward. Like that's a limit to that, and so really we need to test that at any point in time, because metering is key. Like somebody said, we still have about 5 million meters to be deployed nationwide to improve the collections and reduce losses around it, which is also very key. And secondly, for me, we need to fix transmission. Is that link between generation and the distribution? We need to fix it. I mean, there are discussions around that it's important that we begin to plan additional investments in generation given the long gestation period. As we begin to do that, same should be happening to the transmission network. Or probably there is a need to even take another view around how that is done generally. Rather than being centralized, should we be unbundled and regionalized, etc. So clearly for me, I believe we're on the right track with what CBN has done and the federal government. But the plan now is how do we bring in much more longer term funding into the sector? That is what we require.
Thank you so much. Thank you very much. Mr. Zachary, your thoughts, please. Very quickly.
Okay, great. I think we don't have any other country but Nigeria, and we must make it work. I'd say that we have basic issues that we've not done the basic solutions for. We need to have infrastructure to be able to deliver power. And we've not done it for multiples of years. If you look at the investments that were done between 2014 to 2020 in transmission and distribution, is a far cry from what we've needed to do. And then obviously the economics, as Eddie said, were out of whack. But seeking to have new solutions or somersaults on policy when there are basic issues at hand, to me is just a step in the wrong direction. And that's why I'm very happy that with a coordinated approach, we are seeking to solve these problems. Collections through the service-based tariff, the tariff was jumped by 36%. Collections have grown more than 60%. We've distributed 300% more meters than we've ever done in any calendar year. The top was 200,000 before. We've already done almost 500, 600,000 just between January and June. And we've also catalyzed, line of sight to $3 to $5 billion of infrastructure investment, either through CBN, World Bank, AFDB, and others. So we just need to ensure that we understand that if the infrastructure goes into the ground and the economics work, the sector will be fixed. And if we don't do it, it won't. There's no exotic solution. It's actually very basic. And in closing, I'd agree with Mr. Okeke that obviously you can't now shift only your investment to distribution and transmission and not do generation. I would say there are generation plants coming on board, but they're not privately funded. Occupy Phase 2 is done. Farm 3 is done. Zungeru will be done by the end of the year. Kudenda, we have a plan to fix it. And that's almost 1 gigawatt of new power. But it's not coming from the direction that we'd like it to come, which is private sector investment like the Azura plan. So we are making progress. We will eliminate the subsidy, the tariff gap. But we need to focus on basic blocking and tackling. And if we do that, we'll get to the promised land. Thank you.
Thanks so much. Thanks so much. Mr. Okeke, please 30 seconds. We are run out of time.
Yes, thanks again, Muyiwa. I must state there is something Mr. Clark said here that is very instrumental. We have to keep it. We are busy regulating a section of the market that is like 1/15 the total market. You understand that kind of thing? We are busy regulating the small portion of the market. We don't have enough capacity for the country, and coupled with that, that there is no capacity, we are basically trying to subsidize the few people who are connected to that grid that subsidizing the consumption. It's very simple. We have to allow discos run like a business. We don't have enough capacity. The discos should just look around and say, who is ready to pay for the power today to get power from the grid? If you compare the cost of diesel generator to the cost of power on the grid, it's between day and night. So people are ready to switch to the grid if they are assured of getting that stable power. But we don't have enough power. So we have to pick and say, we have to get some few people to be connected to the grid and let them pay the cost of being on the grid. And then the whole value chain gets revamped and we invest more resources to improve the infrastructure. And as we are doing it, just like we go back to GSM, when GSM came into this country, it was Lagos, Ibadan, Kano, Enugu, Port Harcourt, Abuja. Then now every part of the country has GSM. It's the same thing. We don't have enough power for all Nigerians. We have to get it to those who are ready to pay the cost today. And then from the money realized from that, we can now expand to the whole country. Thank you.
Thank you very much. Finally, Mr. Mulamula, in 30 seconds.
Yeah, thanks a lot, Jonathan. I'll be real quick. I think there's an English expression that goes something like, what is not measured cannot be improved. So you have to start measuring something and then you sort of know where you are at and then you figure out where you want to get. So to me, I think, we have to acknowledge the whole metering is an important first step because it allows you to measure, it allows you to take stock of where you are and then you figure out where you want to go. I think in terms of policy, as Mr. Zakari has pointed out, I think the thought process has already been done. I think we are now at that place whereby we want to take that policy and go out there and roll it out. And that's obviously is in the hands of the federal government, the able hands of the likes of Mr. Zakari. I think beyond that, I think it was either Mr. Clark or I think Mr. Okeke who talked about theft. That's another area whereby, again, the government can really help out so that you're going out there. If people are not paying for their power, they're getting disconnected. If they are stealing their power, those illegal connections are getting disconnected and etc. so that the discos have an opportunity to actually run a clean business. And as Mr. Okeke says, they get the discos and running a clean business and then they begin to grow their balance sheets and push out their business. And in 10 years time, all this will be gone. It will be history. We'll be looking back in the archives for these conferences and wondering what people are talking about. Thanks, Jonathan.
Awesome. It's been a great time, gentlemen. Thank you so much for the gentlemen of the panel that have made my job so easy this morning/afternoon. And I want to so express my thanks to the ladies and gentlemen participating in this conference. I believe there's nothing much to say. We just hope every relevant stakeholder, right, in the chain does what is required of the stakeholder to ensure that we get ourselves out of the doldrum where we are currently and ensure the required liquidity to move the power sector to where it should be. So thank you so much for your time and sit back whilst we'll proceed to the next panel. And it's my honor and pleasure to introduce Adaobi Oniwinde, Policy and Partners Manager, Olon, who will be moderating the second panel discussion on bridging the gap with renewable energy. Adaobi.
Hello, thank you. Good afternoon, everybody. Can we hear and see me okay?
Yes, we can.
Super. Okay, So good afternoon again, our distinguished panelists and participants. That previous session was actually so insightful. I was taking away notes and kind of forgot that I had a panel to do next. So welcome again to the 2021 edition of the Business Day Future of Power Conference. My name again is Adobe Oniwinde, and I'm the Policy and Partnerships Manager at Allon. We are also very proud sponsors of this annual conference. It's my great pleasure to be moderating this session on bridging the energy gap with what I actually spend my day job doing. It's what we do at Allon, and we're actually set up as an impact investing firm to do just that. So I'm looking forward to the insights the panelists are about to share. We have less than an hour. We have 6 speakers and lots to delve into. So without much ado, I'd like to introduce all the panelists very briefly. Okay, so our 6 speakers are Lande Abudu is the Executive Secretary of the Renewable Energy Association of Nigeria, better known as RIAN, an independent non-for-profit association of renewable energy professionals, project developers, and practitioners. RIAN promotes the interest of the private sector in Nigeria's renewable energy sector. Ms. Abudu is also a European Energy Center accredited renewable energy expert and a member of the Energy CPD Renewable Energy Professionals. Mr. Afolabi Akingorunde is the investment manager and my very good colleague at Allon. He is responsible for leading Allon's origination, deal structuring, negotiation, due diligence, and investment management functions. He has 2 decades of communications, commercial operations, deal delivery, business development, and economics experience in marketing, communications, telecoms, and the oil and gas sector. We also have Rory Connor, who is a partner at Adelshaw Goddard LLP, New York. He specializes in project development and finance in the energy sector, both in the UK and globally. He advises energy companies, developers, funds, and financial institutions on all project development matters, including construction and project finance, as well as project investments, acquisitions, and disposals. Ifeanyi Orajaka is the CEO of GVE, an Allon investee, I'm proud to say. He is the founder and CEO of GVE Projects Limited, with over 9 years experience in renewable energy systems design, business development, project management, rural electrification planning, strategy formulation. Ifeanyi has successfully led GVE from being an undergraduate student project concept to becoming a market leader in the renewable energy industry in sub-Saharan Africa and one of the fastest growing private companies in Africa, as recently recognized by the London Stock Exchange. We also have my good friend and partner, Suleiman Babamanu, who is the renewable energy specialist currently serving as the project lead for the Solar Niger 5M Solar Connections Program with the Rural Electrification Agency. His work involves managing renewable energy projects and the development of strategies for the deployment of commercially viable mini-grids and solar home systems to rural communities and the underserved in order to stimulate economic progress that fosters environmental sustainability. It's a mouthful, but these guys are, in a nutshell, doing pretty incredible work in the sector. I also have representing Mr. Akinwole Omoboriowo II, sorry if I butchered his name. He is the chairman and CEO of Genesis Energy Group and the chairman of the board of directors of GEL Utility. I've just found out in the last 15 minutes that he won't be on, but somebody will be representing him. His name is Simon Shaibu. Simon, if you're on the call, could you just introduce yourself in 2 minutes, please? Simon Shaibu. Super, thank you.
Okay, thank you very much. I'm Simon Shaibu, and presently the managing director of GEL Utility. GEL Utility is the operator of the 84 megawatts power plant in Port Harcourt, and we are driving on the group level the renewable energy across the.
Excellent. Thank you very much, sir, and welcome to all our amazing panelists. Like I said, it's a lot, 6 speakers. We have under an hour, and there is lots that I would like to cover. I'm going to ask my first question to Lande Abudu. So as the Executive Secretary of the Premier Renewable Energy Association of Nigeria, your organization is an umbrella of companies responsible for helping to deliver Nigeria's off-grid renewable energy agenda. It's quite an agenda, quite a task, quite an association. I'd like you to briefly highlight some key growth indicators over the past 5 years. Lande.
Thank you, Ada, and good morning to my fellow panelists. So as you rightly mentioned, RIAN plays obviously a very important role given the whole energy transition conversation and the way that the world needs to go, because we've been so fossil fuel dependent. So, you know, we have about 140 members at the moment, and they are all developing and creating renewable energy solutions to Nigerians in all geopolitical zones. So what I'd say, you know, in the last 5 years, I joined RIAN 3 years ago, and we're still a relatively new organization. So, but small but mighty, I always like to say, because our members are really deploying the larger projects in the country and obviously doing their bit to ensure that government achieves its aim of Vision 30-30-30. So that's 30 gig generation by 2030 with 30% forming renewables forming part of the energy mix. And that's important for us because that's what drives RIAN's activities and that's what drives our members' activities as well. So I'd say in the last 5 years, what we have been able to do is impact in various sectors, because obviously, as we all know, and has been mentioned at various forums and other places, without energy, we simply cannot move forward. It impacts on the health sector, it impacts on the educational sector, and you know, access to energy is obviously a huge driver for positive socioeconomic change. So we have our members deploying solutions to libraries. For instance, we have Ashtam Solar. They have solarized the mechanical engineering department of University of Ibadan. And it's big because prior to that, the lectures, students couldn't go to lectures. You know, it would have to be using torches and stuff like that, which sounds primitive, but that was their reality. So that's one of the things. Apart from that, we have our member Oksano, who I'm sure you're quite familiar with, being an all-on investee as well. And they now assemble solar panels. So that's also a key part of ensuring that we have scale up, because we can't continue to import at the rate we do. So these are parts of the support that Oksano has received to be able to deploy solutions and also to manufacture, because it's a key part of what we should also be thinking about, because it's all right to say that we want to deploy renewable energy solutions, we want clean energy, we want to achieve SDG 7 by 2030, but we have to also put all of that in place at the back end. So I might just take a breath here because I could reel off, you know, loads and loads of other members deploying solutions in the healthcare and all the others, but suffice it to say that that is what they're doing. They're contributing hugely to increasing energy access in Nigeria. You have to unmute yourself, Adobe.
Apologies. I said thank you for that, Lande. I'm going to stay with you, but I will ask my question very slowly to give you a couple of seconds to catch your breath. But the next question is also for you. So while there are several challenges plaguing the sector, what in your view just give me top three challenges plaguing the sector?
Okay, so it's a good question, but I always like to say we should be optimistic and view challenges more as opportunities to either do better or to innovate and obviously find solutions. So yes, we will always say the major challenges is access to finance. And this is both, this applies also at the consumer end. So at RIAN, for us, we try to be a bridge between all the stakeholders. So we do make the effort to try and talk to funders, potential investors, to ensure that this, this money comes around essentially and in the right way. So I'd say access to finance is one of the major challenges. Then I think, well, we've overcome awareness, so to speak. So that's not a huge deal. It's also the enabling environment, which is tied into the access to finance thing. So we have policies, but how well are we implementing them? Again, this is a nascent industry. We will make mistakes. We will, toddle before we can run. And I think that's where we are, but it's about focusing on how we can do better and understanding what those challenges are, so we can, so we can mitigate. So that's, those are the two major ones I'd say. Capacity building, again, a work in progress. You've got to build capacity within to be able to scale up the right way we want to. Credibility in the industry, standards, quality assurance. Those are mainly the what I would like to highlight.
Thank you very much, Lande. You can take a deep breath now.
Thank you.
So one of the challenges that I'm really interested, obviously, we all are, access to finance, unlocking finance. Rory, I'd like to get an international perspective from you. You specialize in project development and finance globally. Two-part question: what's working in the international space? And secondly, how can we, what can we learn from international players that could help transform our industry in Nigeria to help unlock more finance?
Thanks, Adobe.
So what's working and what can we gain from that knowledge to unlock finance here in Nigeria?
Thanks, Adobe. Good to be here today. Thanks so much for the invitation. I guess the short answer to that, and I'll go into the detail afterwards, but the short answer to the two parts of the question is what we can do is we can learn from what's working in other parts of the world and try to implement that as best as possible in Nigeria, where there is so much opportunity. I think looking at what's worked elsewhere, and it was really interesting to hear what Lande has just said and the speakers in the previous panel, there are no sort of silver bullets here. There are no exotic answers. It is the basics which need to be done right. I think before you look at what works, you need to look at what you're trying to solve. What works for off-grid and grid connected are two different paradigms. We're talking about distribution, power generation. There's different things that work in different contexts. But for the purposes of this question, I'd focus on sort of renewable energy generation. And as I say, it really is the basics. It's getting that system functioning in a way that the basic laws of economics will work, because the basic laws of economics say that if you're able to provide a stable and secure income, people will invest. And the way to get massive infrastructure and energy development the world over, not just in Nigeria, is to mobilize private capital. There's just not enough public capital to go around to do everything that needs to be done in these sectors. So you need to create an environment where investors are confident that they will get a good and stable and secure return. I think summarizing that into three very broad headings, I think we're looking at, firstly, a credible off-taker or a stable market into which power can be sold and people can be assured that there's going to be a market for what they're providing and that there's going to be a decent price and it's going to be paid. That trickles into a number of different things, whether it's liberalization, end user PPAs, corporate PPAs, further liberalization to allow the sale of power to end user, to discos, is all part of that discussion. But I think that's really key. And different models do work. We have a highly liberalized electricity market in the UK and it has its challenges, but basically it functions very, very well. In other parts of the world where I work, we're not quite that liberalized in terms of our energy market and electricity market. It works in similar ways to what you have in Nigeria, but maybe just the way it works is slightly better. And I think that's really, really key. So one is a properly functioning market and a credible off-takers, whatever those off-takers may be. And there's different ways of having off-takers. It doesn't need to be a single buyer off-taker. The second is basic political will and support. One of the things we've done well in the UK over the years is having policies, implementing them, and to create a stability within the electricity sector and in the energy sector generally. We've never, I'm not saying the UK has done everything right, but if we just take, for example, subsidies or support mechanisms in the UK, there has never been one discretionary or capricious change in policy. When a policy has been announced and implemented, the government have stuck with it. And if there is a change in course, then the existing policy is grandfathered so that the investors who are already in are protected, and then there's a change of path. And that's the way you have to do these things. You can't make investors nervous that things aren't going to be stable and that once they invest on a premise, things will change. And I do think support as well is important. Even in the most advanced, liberalized, privately funded energy markets around the world, I think energy is one of those industries. As we've heard, it's an asset-based industry. It is something which can be very investable, but it is also about serving a public good. And I think state support, public support is part of that. In the UK, we have plenty of that, highly liberalised market, but plenty of government support as well. So it's about providing that where it's necessary to incentivise the right investments. And then thirdly, I would just say, wherever possible, reduced red tape, reduced ease of doing business. The easier we can make it for people to come into the country or who are already in the country to find ways to projects, to invest, to have a planning system, a licensing system that is easy to use, to follow, and has a defined path, the more barriers you will bring down to investment, and that will help as well. So I think they're the key points. That's what works in other parts of the world. And I think in terms of learning, it's looking in those areas what we can do more of in Nigeria.
Thank you very much, Rory. I'm going to change the order of my questions now based on something you just mentioned. We talked about, you mentioned, of course, that one of the levers would be state support, the will of the government to step in when necessary. Mr. Babamanu, the next question is for you. The federal government Solar Niger program is considered, in my view, and in the industry, a huge positive stride in the sector. It's been 6 months since the program was launched. What, in your views, are the biggest levers needed to shift to be able to deliver the 5 million connection target? Suleiman?
Thank you very much, Adelby, and thank you, Business Day, for having me here today. Yeah, very, very interesting question. As you would imagine, from the time the program was launched, there's been a lot of enthusiasm, excitement in the space due to the fact that companies are now able to access concessionary debt financing in local currency. So, of course, as with every program, there are quite a few challenges that you would face, and that is likely to affect the rapid implementation of the program. So, to answer your question directly, I think number one is disbursement. We've had a couple of a number of companies that have applied to the program in various forms, because we have the upstream side companies that are applying to sort of finance the production or manufacture or assembly of off-grid components. And we have downstream companies that are into distribution of solar home systems or the construction of mini grids across the country. So, across the stream, we've had a lot of applications. So I think number one is the disbursement, which is exactly the reason why the program has been introduced, to see that money is being disbursed to these companies as fast as possible, to allow these companies to carry on their activities. Of course, we have done a disbursement. As you know, the program has been exploring credit enhancement mechanisms, and through one of such transactions, a solar NDPHC partnership, the program has disbursed about 7 billion naira for that transaction, to be able to sort of deploy 100,000 solar home systems and also set up assembly lines in the country to manufacturing plants in the country. So that has gone. But on the smaller downstream components, we are still finalizing on the disbursement to companies that we have approved. So I believe that fast tracking that would be very, very useful, and for companies that are just being qualified into the program. I would also say that some of the regulatory or policy bottlenecks that we're seeing, especially around customs delay in clearing of systems from the ports. This is very, very key, and this is if not addressed properly, is likely to hinder the scale up of this program. So this is one thing I also think that we're working also on addressing and making sure that companies are able to go through the process seamlessly, and energy is being provided to the people that need them as quickly as possible and as affordable as possible.
Thank you very much for that. I'm going to ask a very specific question on what we are doing specifically, maybe one or two programs you can describe what we are doing to help ease the foreign exchange tension. So disbursements are going great, but how else are we helping small players with unlocking finance? What's the government doing?
I mean, this is a challenge, and I'm not going to pretend as if access to forex is not a challenge to companies. So especially on this program that we're relying so much on, even on the upstream and the downstream side, we're relying so much on either importation of components that would be used to manufacture, assemble systems in the country, or fully assembled solar home systems. So companies do need access to forex, especially at the scale that we're looking at, doing 5 million solar connections. So what this program has been able to do, and for the first time I've been in area for quite a while, and this is the first time we're seeing the support on the off-grid space from the highest level of government. This I'm talking about His Excellency the Vice President, engaging directly with commercial banks, engaging directly with private sector companies, off-grid companies, engaging with investors, just to ensure that whatever challenges we have in the program, or whatever bottlenecks we have, is being able to be it's being addressed. So similarly on the forex, at the highest level of government, between the office of the Vice President and of course with the support of the SA to the President Ahmed Zakiri, the MDREA, making sure that that issue of forex is being addressed. So at the level of the Vice President to the CBN Governor, this is a conversation that has been going on for quite a while. We have commitment from the CBN that companies that have actually gone through the process, have applied, and are able to access funding under this program would have access to forex. But whether that is going to be very easily accessed is a question that we'll see how that goes. But there's a huge commitment from the CBN to allow that to happen.
Thank you very much, Suleiman. And what I was very interested in you mentioning is the fact that indeed, at the very highest levels of government, there is certainly commitment to help ease these tensions and to ensure that this sector does indeed grow and thrive. My next question then is to you, Afolabi. So we all have a role to play in this. I'd like you to share three key, in your experience as investment manager at Olon, what are three key things that renewable energy companies should be doing to make themselves investment ready and scalable? So the commitment is there are funds available, but there's also responsibility on the company. So what are three key things they can be doing to make sure that they are investable? Afolabi,
thanks,
that one's for you.
Thanks, Adobe. Pleasure to be here. Probably we are proud of the amount of skill of progress that's been made in the sector in the last 5-6 years, and I think we're also proud of the level of detail of work that has been done by a lot of the operators, the developers and players in the space in the last few years. We also have noticed that there are also a few things which need to be improved in terms of the quality of the material of the work that needs to be done, especially by a lot of the indigenous players in this space. I think my colleague Suleiman would attest to some of the challenges we've had when we look at the proposals, the quality of the proposals which a lot of the players would bring forward for them to get the required financing to get their businesses to the next level. So I think in terms of what needs to be done from our end, one of the first things is for you to get your story, your financial story together. You need to have at least 2-3 years audited financials by your firm, done by firms which are reputable firms, which if you at least have a Google check of them, they are firms which operate in this space. Firms who can look at your books and say, okay, this is the way, and certify that this is the state of this company. This company has achieved this level of milestones in the last 2-3 years. I think that is the key thing that needs to be done. And then you also need to do as much documentation as is possible. We always find out that, for example, if you go through the accounts of a few companies, you find out that, for example, you find out that there was a transfer of $20,000 to Mr. XYZ. What happened? Why was that done? And then you find out that I had to use that to buy Forex, for example, for my Forex dealer, and that was what that was done for. So I think there needs to be a lot of record, and then you don't have records of those transactions. You don't have any certainty as to what really happened on those transactions. So I think there also needs to be a lot of record keeping, which is why one of the first things we do when we get into investment discussions, and also when we also get into further scaling up discussions with investors we've gone into for example, angel stage investments, is to let them know that you need to have at least a certified accountant on your team supporting you, putting in place the right documentation, the right accounting policies, the right accounting frameworks. We're ensuring that you meet IFRS standards, ensuring that you meet the minimum tax, that your tax papers, your tax work, your tax documentation is in line. Everything is done. Your documentations are filed at the CAC at the time. All these are basic, simple questions and simple deliverables, which which are a lot easier for more experienced, much skilled operators in this space to understand and to take on board. But I think as a lot of the operators in this space will go and get to that point, they need to start taking those things into account. Number one, I need to have accounts in place. Number two, I need to start documenting. I need to start having people on my team who can actually, for example, support you when you start looking at, okay, how do I get my seed financing? How do I present my pitch decks? How do I present my financial model? Does it make sense? Are the elements in my model, are they the things I can defend? Do I have documentation to actually support the projections which I'm making in this model, which I'm saying that this business can do in 2, 3, 4, 5, 6 years time? Do I have the advisors on board, legal? And we also recognize that some of these things also cost money, which is why, for example, at via the All-On Hub, we also have in place a lot of support, non-financial support, legal support, financing support, legal support, finance support in terms of setting up your own books, looking at what is available in country, helping you look at what you need to put in place to enable your company operate as a standard entity in this space. You see sometimes some entities coming up here and have registered is a business team. There are certain things you also need to put in place to make it easier. And I think also third thing, which is also very, very easier for you to get, both to number one, secure financing. That's the first. And number two, also operate your business to the best limits. If there were only 2 or 3 of you who were bootstrapping on everything, you were doing the admin, you were doing the actual solar systems, you were doing the customer interface, you need to get to a point where you say, okay, at what point do I need to either bring in co-founders who have the skill sets that I do not have in this business, who can support me, who can do, for example, if I'm a technical person, I understand how the product works. Do I have somebody who needs to do marketing, who needs to do commercial, who needs to do business admin? Do I need somebody who can, for example, at this stage of the good stage of the company's existence, can engage stakeholders, can engage financiers, can talk to somebody at the CBN in terms of getting your own financing from the Solar Nigeria program, and talk to somebody at Olon with an investment that makes sense, that can chase up opportunities for you at that entity. So I think those are the three core things. Number one, get your story right. Number two, get your books in order and your documentation. And number three, get a team. You cannot be everything in this space. You need to have a team that complements, that provides the skills you don't have, co-founder, and that can enable you scale. Hello.
Those in these space, entrepreneurs and small to have to get themselves prepared to be investable. It's telling your stories, right, as you say, documentation, paperwork, being thorough, as well as, of course, building a team. And I also think there's actually room for actual training. So maybe like we do at the Hub, actually offer training to companies who are trying to get into that space whereby they are actually not just technically sound, but investable. Thank you for that, Afolabi. My questions are a little out there. So Ifeanyi, I have a question for you. You've clearly done all the right things. You went through the process, you got a grant, you're expanding. I'd like you to just briefly share some highlights of GVE's journey. You're the only operator on this panel. Good to hear your perspective on so where you are now, ease of doing business, as well as accessing finance, and how you would encourage others in the space. All things else being equal, there are still challenges. So I'd just like to hear from an operator's perspective, sort of on your journey and what advice you could give others in the space. Fine.
All right, thanks a lot, Adobe. Thanks, Business Day, for the opportunity. And good morning, distinguished, or good afternoon, distinguished panelists and participants. As introduced, my name is Ifeanyi Orajaka. I lead the GVE Projects Limited. Just to shed a bit of light, as has been said by the moderator. So GVE, actually, we started this journey about 11 years ago when we were still undergraduate students with no experience in independent power producer like GVE would work in a mutually beneficial framework to ensure dual value to all the stakeholders and across that chain. And we launched the pilot phase of that project about more than a year ago, and that has accorded significant learnings for all the parties that have been involved in that transaction. We are currently actively implementing the construction of the full scale, which is a 1 megawatt solution that will effectively ensure 100% reliability of supply in the wholesale market cluster. And we believe that project, and already we are seeing some of those attributes, that it would clearly change the dynamics of the electricity industry in Nigeria, because it offers mutual value for all the stakeholders. The consumers are very excited because they have reliable supply at the moment, and equally they're having some cost savings and also improved health benefit. And for the DISCO, some indices published by the DISCO a couple of months ago shows that they on their own, from data from the pilot, they are already seeing as much as 174% increase in their revenues from the pilot project, and they've seen about 323% increase in their collection rate. And these are some of the lessons that we learned from implementing and deploying mini-grids in rural communities that we have now brought into bear in this as well. And talking about some of the challenges or things that can be done to improve some of the operational environment for companies like GVE in the country. The key one of them would always, at least for now, still be the finance. Although the landscape is a whole lot different and better than it was 10 years ago when we started this journey, but you would agree with me that considering the dire need and the current level of energy poverty in the country, we still have a long way to go. But before I talk about, I know the earlier speakers have talked about it briefly, but before I talk about improving energy access, it's equally important to consider and talk strongly about investment protection. And by investment protection, we all know, aside the recent Solar Niger program by the federal government, most of the financing in the sector is pretty much to a large extent, and the issue of forex would continue to be a recurring issue, at least in the short term. So it's pretty important that we all come up with very good structure to help ensure that confidence for investors, to ensure that their investments are pretty well repatriated, and for businesses like GVE as well to be able to have access to a reasonable rates for forex repatriation, as the case may be, and perhaps maybe 3 years or 4 or 5 years down the line, with the impacts of the Solar Niger program, some of the components of the value chain would experience some level of backward integration to ensure that we maintain as much value in the country, because for as long as the receivables are in Naira and some of the obligations are in USD, considering the current situation, it will continuously be an issue. But like I said earlier, the sector is evolving and is currently at a very exciting phase, and we strongly have huge confidence and about what the future holds for both the consumers and all the other stakeholders in the sector.
Thank you very much, Ifeanyi. You actually answered 2 questions in one. Super. So as we all know, it's a nascent industry with its struggles and challenges. And then of course, the COVID pandemic hit and has certainly had some pretty significant effects on not just our industry, but industries globally. My question for Simon would have been for Akinwole. Simon, my question for you is, what do you think are the most significant effects of the COVID pandemic on the budding sector? And a follow-up, what 3 immediate steps would you recommend are taken to support businesses trying to stay afloat? So the significant impact, negative impacts, and what key 3 things, what 3 immediate things does the industry, stakeholders need to do to ensure that businesses stay afloat?
Thank you, Albi, and thank you, Business Day. I would like to thank you for having me today and to represent Mr. Akinwole, the chairman of Genesis. Yeah, back to your question, the significant effect of COVID pandemic. Well, to answer your question, let me just go back a little and give a bit of background to it. You know that the Renewable Energy Master Plan set out to get about 13% in 2015. then move it up to 23% in 2025, and 36% in 2030. Now, the outbreak of the COVID-19 pandemic actually brought a lot of delays, and it will, you can see the impact of this COVID on the renewable energy growth. For example, you will discover that during the pandemic and even aftermath of some of these recoveries that we have during the pandemic, you will discover that there were a lot of restrictions to some of these nations that actually produces the renewable components. And so those restrictions causes a lot of delay in filling projects across Nigeria. So, and it continues, and some of these restrictions are still there. For instance, if you may not have good access to China now, but you will have to order and go through a lot of processes for some of these things. But before the COVID, it was an easy flight to go over to China or to India or to the Europe nations to get some of the renewable energy components. So because those restrictions and those constraints are there, there's a delay in filling the renewable energy target for Nigeria. So the projections that we see in the renewable energy master plan from 13% in 2015 to 23% in 2025, there's an impact on the COVID and a lot of things like that. Significantly too, the COVID now impacted on how the commercial flows of most of these renewable energy projects come by. And so there are a lot of delays and so pre-COVID, there were a lot of engagement. You can physically meet, you can determine what you need to do, you can push forward the commercial flows, you can push forward the financial flows, you can push forward the implementation. COVID actually brought a lot of delays in this pandemic. Now, to speak to immediate steps, I can recommend for businesses trying to stay afloat. One of the things I would recommend is that, since COVID brought a lot of things, changing the way we do things, the way we live, the way we engage, the way we generate power in renewable. So I suggest, number one, that all businesses should adapt to the changing times. All businesses should adapt to the changing times by going back to the digital process that was started during the COVID time. You can remember that communications, conferences, meetings, and all those things were all through the digital means. So going for business, you need to go by the digitalization so that the solar projects can become more effective. So for businesses, they need to take advantage of the digitalization so that the solar or renewable energy space can go. Then secondly, I think we need to look at some other speakers have talked about partnership. I think for businesses, we need to look at strategic partnership agreements for us to survive. Some other smaller, some other ones that have experiences, some other ones that are established. We should engage in strategic partnership agreement so that some of these businesses can survive these challenging times. Then thirdly, we need to, mention about funding, government support, and my friend here, Suleiman, to talk about the government initiative. Well, again, government needs to do more to provide a long-term support to renewable businesses. It's challenging to talk about it because timing and factors and so many things to put in place. But they can as well do more, again, establishing financial support programs and creating a clear guidelines on how to assess them. rather than creating the support and at the same time creating the bottleneck. So I suggest that the government give support to businesses and help them and let them survive in these trying times. So I think these are the three things I need to suggest for businesses to survive in this.
Thank you very much, guys. Can you hear me? I lost audio for a minute, so I'm on my phone now. Can people hear me okay?
Yes.
Fantastic. Excellent. So thank you, Simon. Absolutely, businesses should adapt to the changing times or the changed times. Digital processes, strategic partnerships, and funding support from the government and others. I'm looking at the time, it's 1 o'clock, but I do want to get a minute or two wrap up from each and every one of you. But before we do that, I'd like us to sort of end on a positive outlook note. For Rory, quick question for you. What would be your projection for the future of the renewable energy delivering an efficient and sustainable Nigerian electricity market? So I'd like a projection from you.
Sure. I mean, the
on
projection.
how the.
Go ahead.
So the question is a projection on how renewable energy can help deliver an efficient, sustainable Nigerian electricity market.
Yeah, I think ultimately, I think there's two things. One, the resources are absolutely there. Nigeria is one of those rare countries which is blessed with massive hydrocarbon resources, which has been a huge part of the economy of the country for so long, and in many ways part of its national identity on the global scale. But it's got equally amazing renewable energy resources as well, with wind, with solar and hydropower, and that gives great opportunity for Nigeria. And there's a massive amount that can be done given the development opportunity in the power sector. So that's there's no reason why it can't be a very large part and provide a sustainable opportunity for Nigeria going forward. Beyond that, I just think it comes down, as I said earlier, to political will. Ultimately, you look at energy systems around the world, whether it's the UK, Eastern Europe, Latin America, wherever. These things do require an element of central design, no matter how liberalized and how much private capital is involved. It requires some central planning. Market needs to be designed, the market needs to be organized in a certain way, and there does need to be political will to support certain types of technology. I think you have that in Nigeria. I think you have absolutely have the resource, and therefore, if some of the challenges discussed today can be addressed, I think my projection is that a significant portion of renewable energy in the sector going forward. And of course, ultimately, that is essential, regardless of climate change analysis. In the end, we need to move to a form of energy which is renewable, which will last forever, and that's the crux of renewable energy.
Thank you very much, Rory. So it's not an ambition, it's what has to happen. I'd like all of you now to very quickly, in 60 seconds or less, give me your closing remarks, starting with Lande Abudu.
Okay, so I would just say we need to continue to collaborate. No one sector can do it alone. So, in terms of RIAN, we try to be the bridge between ourselves, investors, government, and other stakeholders. So we need to continue to collaborate to find solutions. We need to continue these kind of conversations and make sure that, we're working together towards creating a solution, because it's a huge market, it's a huge potential, and it has a huge potential for socioeconomic, which is what we're also looking at. Not just, I'm turning on a light bulb, but I have access to energy, which also means better lifestyle, better healthcare, better access to education, and all the add-ons that come with having increased energy access.
Thank you, Lande. Very quickly, Suleiman, your 60-second wrap.
Yeah, thank you very much, Adelbi. I think for me, sitting on the government side of things, I would say that it is quite obvious that the government is ready and happy to work with the private sector to develop the off-grid market and provide access to electricity to especially the unserved and underserved people in the country. You can see very clearly over the past few years in terms of regulation, access to finance through grants or debt. It's very evident that the government's making that commitment to allow private sector participation, and we've recorded a lot of progress on that. All I want to say is on the side of the private sector companies, we need you to also come up to speed, develop your capacity in terms of, your ability to raise capital. Just like what Afolabi mentioned, I think it's very, very, very key that companies are able to, package a bankable proposal. We've seen that from some of the applications that we received under the program, that there's a bit of lack of capacity in some companies, and I think that should be addressed. Of course, from the program standpoint, we continue to provide support to these companies, whether in developing your financial models or your business plans and so on. So we're very, very happy with the collaboration we're getting with the private sector, and we're hoping that over the next 2 or 3 years we're able to at least be able to do 2.5 million connections under this program. Thank you. That'll be your mute.
Sorry, Suleiman, thank you very much. Afolabi, you're on next in about 60 seconds or less. Final thoughts?
Okay, well, I think I'll just say basically 3 things, which I think are very, very critical for the sector as a whole, both operators and investors. Number one is that we need to, even though we have some of the most forward-looking progressive policies, regulations, and initiatives for the off-grid space in Nigeria, we need to also bring in significant fiscal incentives to make solar investment more viable and attractive. This is what the bulk of the countries in the world which have made progress in this space done. So I think central bank is doing stuff. But I think, as Mr. Clark said in his remarks, we need to also do something at the fiscal level. Then we also need to provide a lot more clarity, definition, and uniformity in terms of the terms governing importation of key solar inputs into Nigeria. A situation where a solar developer pays 15% levy and then pays 28% levy 6 months after. It makes it difficult for them to plan and operate optimally in this space. And we also need to strategically start looking at how to domesticate as much of the value chain in Nigeria. The Solar Niger program has an element of that which is dedicated to that. So I think so that requires both public sector at the government level, at the macro level, determining that this is something that needs to be done for the benefit of the space as a whole, and then private sector then coming in, bringing in the capital and the heavy lifting to actually take that risk and plow that capital into that area. Because as long as we continue to import every 99% of our inputs, then we will continue to be energy security will continue to be a mirage for us as a country. So I think those are my 3 key takeaways. Thank you.
Afolabi, thank you. Ifeanyi, in 30 seconds or less, your final thoughts.
All right, thanks, Adobe. So basically, I believe the other panelists have touched on most of the key attributes. But from my own end, the industry is pretty much at a very exciting moment when all the parts and pieces of the ecosystems are beginning to fit together to drive the needed scale in the country to help achieve universal energy access for all Nigerians by the year 2030. And while government have been able to record a lot of successes, also there are still some impediment that needs to still be addressed in order to help ensure that the pace of the anticipated growth is well in line with current realities. So to shed a bit more light, especially for the mini-grid component, while some of these processes and systems have been set up, there are still interdependencies with some government agencies and ministries, which at some point poses us as clogs in the wheel to helping achieve the required level of skill. So it's something also the government should potentially look at and see how to make things a lot more seamless in view of enabling ease of doing business in the country.
Fine, thank you very much. Simon, I'm going to give you the last word.
Thank you very much. Finally, the renewable energy market space is huge. And so we need to develop a concept to bring down the price of renewable projects in Nigeria. If you compare with thermal, renewable is still expensive. And other speakers have talked about the way to go about it, but I want to emphasize again that we need to create an environment to manufacture most of these solar components in Nigeria so that we can reduce the cost of imports, the bottlenecks in clearing, the sea freight, and some of these things. We need to deal with some of these challenges that are here. And to improve our visibilities, we need to collaborate on many fronts. Most times people go, most industries, small scale industries on solar, renewable go solo, and in the end, do not achieve a lot. And so because the market is huge, we need to collaborate together so that we can achieve the visibility that all of us desire. Thank you.
Thank you very much, Simon. So I think just in a nutshell, collaboration and just creating the enabling environment that includes all the things that you all have talked about in this session. It's a real pleasure to have moderated this session. It was a lot to cover. I really like doing these sessions because I'm really new in the industry. So this is really an opportunity for me to hear from those who know this work a lot better than I do. I've been doing this for a lot longer than I have. So always really insightful for me, and I hope as insightful to the participants and the audience. I'd like to now hand back over to the publisher, Frank Aibogun, to introduce the next presenter. Thank you very much. Over to you, Frank.
Adaobi, thank you so very much for the splendid way you moderated the session. And of course, thank you for being one of our sponsors. Much appreciated. Our next speaker is the Chief Executive Officer of Stradite Consulting, a fine gentleman indeed. Someone whose unique insight about Nigeria's energy market and its evolution is perhaps unrivaled. He is a former commissioner at the regulator NERC. Eyo Ekpo is one of whom I proudly can say is my friend. The floor is yours.
Thank you very much, Frank. And thank you to Business Day for inviting me once again. You have to forgive me. I've had a bit of a flu for a few days, and it may affect my voice and how you hear me, but hopefully I'll be able to convey the message in the next 20 minutes. I've been invited, and I'm privileged to do so, to have been invited to speak on the subject, how state governments can facilitate electricity markets in their states. And I think it's one of the subjects that we will address if the various issues that have been highlighted by all the speakers and touched upon in our discussions up till now. So let me start with the question. What do we all want as far as electricity is concerned? It's not so much of an obvious answer because we tend to get carried away by the big things, but let's start with the very basic question. What do we all really want? And I think the answer to that is very simple. It's universal access to reliable electricity. Simple. And so what does that phrase mean? I would define it as access by all of us who live in Nigeria to publicly available electricity supply in the desired quantity, of the desired quality, and at the time when we want it, when we need it. If we use that parameter, then Nigeria does not yet have universal access to electricity reliability. I think that much has been accepted that we've had today. But let us also bear in mind that the delivery, the proverbial, what the telecoms people would call last mile, is local. It's a local issue. So distribution issues live with Nigerian residents who reside in states, not in Abuja. So all of Abuja, as powerful and as important as it is, harbors less than 7 million Nigerians. The remaining, theoretically, we are told we are 200 million. So the rest of us, 193 million, live in states. And so it's a bit of a paradox when you hear us speak at events like this, and you hardly hear of states being mentioned. Everything that we've talked about, really, at the end of the day, boils down to how we deal with distribution. And distribution, I will continue to emphasize, is a local issue. So it brings to mind what the states have to be asked to do. So this is a country, civilian government, democratic principles apply. So what do policy, what the law, what does the Constitution say? We've got a national electric power policy that was enacted in 2001. We tend to forget that it exists, but it's still there. And the first thing it highlighted was that countries are unbundling, and that they're unbundling horizontally. We tend to forget that unbundling has two aspects: horizontal unbundling and, of course, vertical unbundling. And so that bit about the vertical, from the federal government down to the states, the local government, hasn't really happened. And everything we've said today harks back to the fact that we tend to be driven by what is happening in Abuja, driven by people who work for the federal government, with very little discussion with states. I keep harping on this because ultimately we're going to come back to the fact that states do have a role to play, which we should begin to recognize and think a little bit more differently about. Paragraph 3.13 of our National Electric Power Policy talks about state governments having to be responsible for the development of off-grid electrification and for the regulation of off-grid, and I'm quoting here, off-grid, non-centrally dispatched operations. So let's think about that for a second. Central dispatch operations are operations that are carried out by TCN, the system operator. And I think it was Educate or pointed out that we keep our gaze so intensely focused on a very small part of the Nigerian electricity sector, which is all of, in a typical day, about 4,200 megawatts or thereabouts, sometimes even less, significantly less. But all of us depend on capacities that are quite possibly 10 to 15 times much more than that. That is the totality of the Nigerian electricity market that we need to address. So off-grid, non-centrally dispatched operations are what states are concerned with. And if we consider that all that the federal government does is to centrally dispatch to us 4,000 megawatts a day, the enormity of the task that is actually left to states begins to become apparent. Because like I said, distribution, generation within states, transmission within the boundaries of a state are the responsibility of each of the 36 states of Nigeria, individually, not collectively. Section 3.1.4.2 of our electric power policy also tells us that NEC will be the independent regulator of grid-connected services. So NEC is doing its job when it talks about transmission markets, generation wholesale markets. But when it comes to distribution, the next thing I'll talk about is what the Constitution says, and that is this, that our Constitution in section 13 of the concurrent list, this is what we have had for the last 22 years or so, since 1999, that the National Assembly will make laws with respect to generation and transmission of electricity in or to any part of the federation and from one state to the another. I think my limited understanding of the power sector tells me that what the federal government is constitutionally responsible for is the wholesale market, which deals with moving electrons from a generator in one state across borders into other states. And there's no dispute about that. But the next point has to be made also, which is that section 14, the very next section of the concurrent list, then goes on to say that the House of Assembly of a state will be responsible for making laws for the generation, the transmission, and the distribution of electricity to areas that are not covered by the national grid system within that state. Again, let's go back. If we consider that all we have from the national grid is 4,000 megawatts on a good day, maybe 4,300 on a good day, but more often than not, less than 4,000. What the Constitution has been telling us for the past 22 years is that the states have constitutional responsibility for creating the frameworks for a significant part of our electricity business in Nigeria, which is not at all concerned with our central electricity grid. I hope that thought will sink in. But the strange thing here is that not one state has bothered with this in the last 22 years. And there's a reason for it. And it's not actually a bad one. But again, I'll come to that. So we have reform and privatization that has been ongoing since 2001, when the electric power policy was first drafted. I was involved in that. And it's sad to say that we really cannot argue that 20 years later, reform and privatization have not quite delivered on even unbundling, because we've only unbundled from generation through to transmission through to distribution, but we haven't unbundled our local distribution companies across states. So not one distribution company that we have today, the 11 of them that we have, has actually said to us, we will further unbundle this disco across the state so that you have it so becoming a holding entity like our banks have become, so that within the boundaries of each state, each disco has a subsidiary that deals with the distribution issue within that state. That hasn't happened. And it was mandated to happen, but it hasn't. So we haven't delivered on unbundling, we haven't delivered on universal access, and we certainly haven't delivered on private sector investment, which were the three key objectives of the entire power sector reform process. So from this point of view, I think it will be, for me, it grieves me to be able to have to say that we haven't delivered on these three key objectives of reform after 20 years. So our market size hasn't grown at all. In real terms, it's strong because we're a lot more now than we were in 2000, but our market has probably grown from about 1,900, which it was doing then, to about 3,800. But you might say that that is 100% increase or more. But the reality is that if you use the most conservative yardstick, let me pluck a figure from the air. Let's say 1,000 megawatts for 3 million people, which is not the case anywhere with any of our peer pressure, our peer countries, Indonesia, Egypt, India. None of them does anything remotely like 1,000 megawatts for 3 million people. They do better ratios, but let's use that. Today in Nigeria, we should be talking about 60,000 megawatts and above, but we don't have that. Not even if we count all our generators put together, probably. So we're doing a lot less better than we should. Investment has dried up after Azura, that was noted. We started out on the IPP road with promise, but 4 or 5 years after Azura, 13 years after it was first conceived, here we are still not being able to sign up another PP with another IPP. And at this point, it's the honest truth is that only the federal government has really been investing to any degree at all in our transmission and our distribution networks, such as they are. Not even the discos, which are supposedly privately owned, have invested in their own entities in terms of CapEx investments. And the reasons, again, are well known. So for 7 years, the proverbial 7 years, we haven't gone anywhere near universal electricity reliability for the country. So the question then we must ask ourselves, isn't it time that we rethought, we had another look at the idea of a single national electricity market? if our constitution, our policy, and indeed our law enables us to have individual electricity markets, why have we stayed stuck on the idea of a single electricity market managed, regulated, funded from Abuja, when you have 36 states that can, some of which, not all perhaps at the same time, but definitely some of which can actually foster their own domestic electricity markets and expand that footprint that we all want to see. So let me do a quick case study of one state, Lagos. We can take a number of others. We can take Kaduna, we can take Rivers, we can take Enugu State, we can take Anambra State, and we'll all come to the same conclusions in varying degrees. But Lagos State has 27 million people. It has a footprint of about just under 5,000 square kilometers, which is nice in terms of distribution, but it also has its challenges. But it's so much nicer because you don't have such long distances to go over. It has all of 1 gigawatt, 1,000 megawatts of public power supply, which costs an average of, I would say, something like 15 naira per kilowatt hour. And perhaps you will all agree with me that, because I know many of you live in Lagos, perhaps what we get on a typical day is 12 hours of supply at best. And so that gives something like 600 million naira billable by the two discos in Lagos. I may be wrong here, but perhaps not by too much. But on the other hand, as Ebi Clark noted earlier on, we have 15,000 megawatts, 15 gigawatts of backup capacity in Lagos. I would say it's more because this was 2015 and today we're in 2021. But the average cost of that 15,000 megawatts per kilowatt hour is something like between 120, 130 naira per kilowatt hour, which means that on a daily basis, Lagosians are actually, because one thing that Ebi also noted is that generator sellers are not owed. They collect all their money upfront. Diesel LPFO sellers, natural gas owners or CNG owners are not owed. They collect their money upfront. So Lagosians actually spend, get this figure, 33.75 billion daily powering this 15,000 megawatts of capacity that we have in Lagos. Now, if that 15,000 megawatts ran at a typical, perhaps cost-reflective number of about 70 to 80 naira per kilowatt hour for just 24 hours in each day, we'll be paying something like 27, 28 billion naira for that capacity. My conclusion is that we in Lagos spend about 5 billion naira a day that we ought not to be spending. And this is Lagos alone. And across the country and look at the cost of not having an efficient, reliable, publicly available source of electricity to us in Nigeria. It is a real cost that we pay. But because we pay it individually, perhaps we don't see it for what it is, which is the cost of failure to be able to deliver that energy across, what you might say is a much more efficient, much more reliable system to Nigerians, using only Lagos as a small yardstick. So I wouldn't mention, of course, the environmental or the health costs of burning distillate fuels for 15,000 megawatts in Lagos. No need to talk about that. But the truth of the matter is that while we have in Lagos 1,000 megawatts of capacity being distributed daily by Eko and Ikeja, these two discos together today, as we speak, have at least a nominal transformation capacity for as much as 4,000 megawatts at their own 33 kV and 11 kV levels. But TCN, which is the federal government-owned entity that is supposed to deliver energy into Lagos through the grid, has at best 2,500 to 3,000 megawatts of transformation capacity at 132 kV level, which is the level next to the discos, at which energy should be transformed to them. So even though Eko and Ikeja have 4,000 megawatts of capacity, at best, if TCN could, it would not be able to deliver much more than 2,500 megawatts into Lagos. And this is a city, a state that actually has that demand for this much energy and more as we speak today. Because if you think about it, it brooks no argument that Lagos, in terms of its political, economic, and demographic characteristics, would definitely, and I think we've had quite a number of investment bankers on our platform today, it would command in all the investment that is required to be able to develop that grid-connected capacity into Lagos if and only if there was actually a Lagos electricity market, which doesn't exist today. So I said earlier on that something like 190 million Nigerians live in states. Distribution is local. Franchises, which we've all talked about, are even more local. The paradox, therefore, is why would the federal government want to regulate what is actually local when we have state governments, some of which have the capacity to collect revenues or to create frameworks for collecting revenues, have the capacity to create frameworks for regulating this local business? Why don't we at least just think about the idea of finally giving some breathing space to states that can and are willing to develop the capacity to be able to create their own local markets for the people that reside within those states? NAC had determined as far back as 2014 that up to 27% of the regulated asset base of the distribution companies was actually contributed by the state governments. So if our state governments were good enough to put in the money, how come they are not good enough to be able to create frameworks for putting in even more money to serve their residents in those states? So clearly, and this is what comes back to the reason why our state governments have not historically looked at creating markets. It's because given our history, unitary governance system that we historically came from, there was, you might say, a political economic bargain that was entered into between states and the federal governments, whereby the states allow the federal government to lead, not just in terms of policy making, but also in terms of policy implementation, in terms of capex spending, and in terms of regulation. That hasn't yielded dividend. I think we're all agreed on that, no matter on what side of the divide we may sit. But therefore, if it hasn't yielded dividends, what then can we do? The desire for universal access to reliable electricity supply is even more so in states which are demanding. Talk to any governor today about the 3 hot potato issues that he has to deal with. Power will be at least in the top 2. And they seem to be lost. But there are 1 or 2 states that have finally begun to think it and realize that perhaps they can do something about this. So pressure is growing inside the country from the people who live in states. Pressure is growing on us from outside the country, from outside our political environment by technology innovation. We spent quite a lot of time talking about what renewable energy developers and financiers have been doing. The reality is that technology innovation is reducing the small footprint of the discos even smaller.
Mr. Ikbo, can you begin to round up, sir?
Yeah, I will. I've got just one more slide. So pressure is growing. And so market design for Abuja does not necessarily have to mean that execution has to be by Abuja alone. So my last discussion here, and if you just give me a minute or 2, is that vertical unbundling has to be accompanied by horizontal unbundling from the federal government to the states also. And how can that happen? How can we make that work? States that wish to do so and can do so should be allowed to actually develop the human resource capacity to pass laws and create the frameworks for this. And it can be done in very short order. Discos should not stay stuck at their initial levels where they are covered in a number of states, but discos need to disaggregate into a number of state-focused operations, never more than 2 or 3 or 4 of them, because no disco covers more than 4 states. And indeed, in Lagos State, for example, you've got 2 discos in the same state. The federal government, I think, should engage in good faith with states around the question of how do you transit responsibility for regulation of the distribution companies and operations that are carried on within states to state-based entities. Now, the reality is that 2 states are actually doing this. They've taken leadership in trying to get this done. So perhaps what we should be doing is try to facilitate and enable what those 2 states, Lagos and Edo, are trying to do. And let's see where we will be in 2 or 3 years' time and answer the question whether collaboration between the federal government and the state government rather than obstruction is what will actually deliver the energy, the universal electricity access, reliable access that our people need. So that much I would say. Thank you very much. to speak. If there are any questions, if they have the opportunity for that, I'm happy to answer. Thanks, Frank, and our viewers.
Eyo, thank you so very much. And as usual, you have not disappointed. Pity we do not have as much time, to allot to you. But I probably will allow one question before we make the switch to the next panel, which will be moderated by Joba. Is there any question for Eyo Igbo? I haven't seen any on the chat platform, so I can as well assume you are fine for us to make the transition to the next panel.
Thank you very much, Frank.
Thank you, Joba. So the floor is yours.
Okay, thank you very much. Good afternoon, everyone, and thank you for taking the time to attend the Business Day Future of Power Conference 2021. My name is Joba Akinola. I'm a senior associate at Team Lead at Olaniwa Ajayi, the knowledge partners to Business Day for this year's event. Now, just setting context very quickly before we go into the panel. Now, over the years, it's become quite clear that most of the key issues and perhaps the most complex and significant in the power sector are concentrated on the distribution end of the sector value chain, at least from the perspective of MSMEs and everyday Nigerians. That very much appears to be the case. Now, many of the challenges around liquidity and the financing constraints have been touched on in earlier panels, so there's no point focusing on them here. But now, there have been recent developments in the distribution subsector geared towards resolution of some of these issues. And many of them are quite, well known to most of the participants here. Things like tariff reviews, intervention facilities from the central bank, proposals on resolving outstanding MDA debts, the National Mass Metering Plan, amongst others. Now, these initiatives show quite clearly that stakeholders at various levels are making concerted efforts to resolve the issues. And some of the other panels, speakers, particularly in the first panel, have attempted to shed quite a bit of light on some of these efforts. Now, one key development that hasn't really been touched on today, although Mr. Epo alluded to it, and I think it also came up during the renewable session, is the relatively recent introduction of a regulatory framework for sub-franchising of electricity distribution networks. In essence, this is a framework where DISCOs can carve out, or a DISCO can carve out some elements of its activities or the entirety of its activities in a geographical area and hand that over to a private investor to invest in, operate, and manage under the cover of that DISCO's distribution license. Now, that's the focus of this panel, and we'll be looking at electricity distribution franchising in Nigeria, the key issues, challenges, opportunities for various stakeholders that are active or looking to be active in that space. Now, the speakers on this panel have been carefully selected for their experience in developing, financing, or structuring and advising on projects of different kinds in the power sector. I should mention, by the way, that Olaniwa Ajayi, given our exceptionally strong expertise in the distribution subsector, we have been actively involved in this area, that's distribution franchising. And the key highlight of that is our role structuring what is expected to be the first electricity distribution sub-franchise in this market. That's the Connexa project, which we'll touch on in the course of this discussion. But first of all, introductions. The first panelist that I'll introduce is Joel Abrams. Joel Abrams is part of the founding team and serves as director of Connexa, a developer, investor, and operator of distribution networks across sub-Saharan Africa, and the company responsible for what is expected to be the first electricity distribution sub-franchise in Nigeria. He also serves as the managing director of Nigeria Solar Capital Partners and has been working to spearhead the introduction of large solar facilities in the Nigerian energy sector. He is responsible in these roles for international project finance, structuring equity and debt deals, and raising funds to support delivery of international projects. The next panelist is Fola Fagbule. He's a banker and investment professional focused on infrastructure in Africa. He currently serves as Senior Vice President and Head of Financial Advisory with responsibility for mergers, acquisitions, capital raising, and other technical advisory assignments at the Africa Finance Corporation. His work revolves around large infrastructure projects, companies, and investments across sub-Saharan Africa. Fola also serves as a non-executive director representing AFC on the board of Energy Holdings Limited, a leading diversified energy business operating in several African countries. The third panelist is Dafe Akpeneye. Mr. Akpeneye Dafe is a commissioner for legal licensing and enforcement at the Nigerian Electricity Regulatory Commission, NERC, which is the apex regulator of the electricity supply industry in Nigeria. In his role, he's primarily responsible for issuing licenses to all participants in the Nigerian electricity supply industry, enforcing the provisions of the Electric Power Sector Reform Act, and resolving industry complaints and disputes. He previously worked at leading commercial law firms and PwC Nigeria, where he was the general counsel for Anglophone West Africa. The fourth panelist that I'll introduce is Ikena Emehelu, or Ike. He is the projects partner at Nelson Rose's Fulbright's New York office. His practice focuses on energy and infrastructure project finance transactions across the entire spectrum, including renewable energy, conventional power, energy storage, and midstream sectors. He has developed expertise on PPPs and transactions involving governments and other private sector participants. He represents commercial and institutional lenders, developers, private equity, and sovereign investors on domestic and international transactions. He has experience across the United States, Africa, and Latin America. The fifth panelist is Obiora Okoye. He's an experienced investment professional with over 18 years in energy and infrastructure, spanning oil and gas, power generation, transmission, and distribution across Africa. He's co-founder and partner at Black Iron Capital, an infratech investment and advisory company currently developing a number of opportunities across solar and battery storage, gas midstream services, power generation, waste management, and financial services. He previously was at General Electric Nigeria, the Africa Development Bank, and Power Africa. The sixth panelist is Daniel Muller. He's the head of origination and structuring at InfraCredit. That's the Infrastructure Credit Guarantee Company of Nigeria, where he oversees the pre-assessment of infrastructure candidates against strict eligibility criteria, conducts due diligence on eligible transactions, and structures transactions based on detailed risk assessment and credit appraisal. Prior to this, he was managing director of Global Emerging Markets, West Africa. And last but not the least is Dr. Yusuf Ali. Dr. Ali is the special assistant to the president on power regulation. In this capacity, he is responsible for supporting the presidency with policy coordination across the Nigerian power sector, advising the presidency on how to engage relevant government agencies across the electricity industry to ensure consistency in policies, managing the relationship between the presidency and the regulator, that's NERC, to ensure regulations are aligned with the government's overall socioeconomic objectives and contributing to policy thinking and planning of the Nigerian electricity supply industry. Prior to this, he was a policy advisor at the Tony Blair Institute for Global Change. So that's the panel that we'll be discussing, that we'll be having this conversation with today. You can see it's a very interesting panel with very robust and rich experiences and perspectives expected. But I'll be starting with a question to Joe, who is a developer as I mentioned, he's a director at Connexa. So we'll start with his project to sort of serve as a case study of what a franchising project looks like. So Joe, is Joe with us? Okay.
Yes. Hi, Joba.
Okay, great. So your Connexta, your company is developing an integrated utility project in Kaduna State. And a critical piece of that project is a sub-franchise of Kaduna Electricity Distribution Company's network. This is something that you guys have pioneered at Connexta. And this is work that even predated the issuance of the NERC guidelines. So can you just tell us a bit about the structure and the key innovative features of the Connexta project to set the tone for the rest of the conversation? Thanks.
Sure. Primarily, the key of the initiative was to identify a varied range of customers within a smaller franchise area of Kaduna Electric's distribution concession, where we would test a mixture of willing buyer, willing seller tariffs together with regulated tariffs and an augmented supply to allow for a 24/7 reliable network, where we would be bringing in fresh capital to tackle some of the historic issues related to underperformance of the transmission interface down to the distribution network for the customer base. The area that we are tackling has got a range of customers going from customers spending less than 100,000 naira a year, all the way up to customers spending in excess of 3 or 4 billion naira per year. We are incorporating a SCADA system. We are incorporating multiple supply sources to allow for redundancies to kick in and prevent outage. And critically, we are working on repatriating volume that has historically always been lost from industrial customers back into the distribution network. We also have an energy access agenda. So where the grid and the distribution network does not meet the customer, we don't necessarily force a grid extension where it's not economically viable, but we target that customer using mini grid or off-grid solutions with the general approach that all customers can be served, much like a bank would serve your leading Nigerian multinationals all the way down to the lowest earning income members of the banking community. So too, in the distribution side, we're targeting across all of the network. Perhaps just to say a little bit about the structure itself. We are operating a Naira business. We're looking for long-term alignment with a Naira business. So that's very, very happy to see that Daniel Mueller from InfraCredit is on the call. We see long-term access to local currency as key to investment within the distribution sector. And we also look at this in partnership with the incumbent disco. So rather than have a sort of third-party approach where we pay some sort of fee and then get on with our business separately from the disco, we actually see ourselves as partners with the disco, whereby the disco itself becomes a shareholder in the franchise area where we're bringing in fresh capital. And also we provide, I think, some meaningful guarantees of our commitment to remove any subsidy from the franchise area. So we have a commitment to pay for all of, apologies, there's an echo, but we have a commitment to pay for all of the energy under the vesting contract that will come into our area 100%. So the subsidy removal from the franchise is a key part of our alignment with federal government's policy on distribution as well.
Okay. Thank you very much for that, Joel. And I think that's a very helpful primer on business is structured and how franchises will be structured. So it seems like a very brilliant idea. The next, after how well conceived a project is, it won't reach viable terms. So Obiora, this question is for you. Against in the power sector and the financing constraints faced by the discos, much of which was covered in the first panel. How do you reckon distribution franchisees will be able to access capital to fund their projects? I mean, what do you reckon are the opportunities once this really kicks off and starts to reach full swing?
Yeah. Sorry, I can't hear you. I don't know if I've, Job, I can't hear you. Hello?
Jobber, your network is off, Jobber. Jobber, your network is off.
Okay. I think I got
yes, my question.
But can the rest of
question was around financing. I don't know if.
Yeah, I think you're going in and out. But I mean, if the audience can hear me, I can go ahead.
You can hear me now. Well,
we can hear you clearly, Obiora.
All right, great. So I think Joel already spoke a little bit about, one thing I like about the franchise model, and I think it was, something that the government really did very well in the structuring, was it gave it a lot of flexibility, right? So you heard Joel talk about, having different models depending on which customer segment that they are focusing. So you have some willing buyer, willing seller customers, and then you have some other customers who are being targeted to pay at the NERC approved tariff. So that's ability to, as a franchisee, to go as shallow or deep into the operations of the disco, depending on your capabilities and depending on what the need is at that particular franchise area, I think is key, right? So it offers the opportunity to actually have cost-reflective tariffs at the franchisee level. And I think when it comes to financing, that's one of the issues that the discos have obviously faced in the fact that they've been so fiscally constrained and operationally challenged. Bringing in a third party who's going to work alongside these discos, who are able to service these customers at potentially at a lower cost, and having to ring fence the commercials and the cash flows into an entity that is not burdened by some of the legacy issues in the sector. So I think from a financing point of view, as long as you can show the stability and predictability of your cash flows, and you're able to ring fence that away from some of the issues that the discos have been faced with, I think you should be able to finance those projects.
I'm sorry, Obiora, could you go on? It appears that Jobber's network is off.
Okay. You can still hear me?
Yes, loud and clear.
Right, okay. So yeah, I was talking about some of the things that from a financing perspective that you'll need to do. You need to demonstrate, obviously, that you've done a viability analysis of the franchise area. You are very, very cognizant of the different customer groups, who is prepaid, who is not prepaid, what distribution investments that needs to be made. So you've done your full technical analysis independently. And I think, once you have, just like you'd have in any other project, really, once you have the documents that are bankable, you've done your research and you really understand the customer groups that you're trying to serve, and you're able to ring fence the financing, really, to be able to repay back your investment.
you should be able to raise the capital for these types of investment. I think there's a big element of the development side, right? The early stage investments that need to go into some of the pre-feasibility studies on how to get funding for that. And I think, as Joel has obviously demonstrated, there's a lot of grant funding out there for stuff like this that you can actually tap into to support these types of projects. So I think it's quite exciting. I think the opportunity is huge. I don't think that Connexa or there's any 2 or 3 companies out there that can meet the huge opportunity. So I think there's a huge opportunity for a lot of players who can come in and structure these types of investments that obviously keeps them quite at a distance from some of the issues that the discos are going with in terms of their liquidity. But I think, also the idea of closing that tariff gap, I think that's absolutely key, because once you can demonstrate that you don't need a subsidy and that you can do this purely on commercial basis, then financing will definitely flow to those projects.
Okay, great. Thanks a lot for that helpful, actually quite detailed analysis. I was taking notes. And my next question is for Daniel. And it's good when Joel was speaking, he touched on the fact that the model they have designed is a Naira business. And I know that InfraCredit has been very active in Nigeria's infrastructure space and has helped many players to access local currency funding on the domestic market. I also know that you guys at InfraCredit have been advocates for cooking the elephant in smaller pieces. What are your thoughts, Daniel, on distribution franchising, and how do you see InfraCredit's potential involvement in helping players in this space access capital for sub-franchising projects?
Thank you, Joba. Can you hear me well?
Well, I can.
Okay, good. And thank you again. Yes, at InfraCredit over the last 3 to 4 years, we've facilitated access for various infrastructure clients to raise over 43 billion Naira. And this is really bringing confidence to projects, bringing confidence to the debt capital market investors, these institutional investors, to be able to purchase the debt instruments issued by eligible infrastructure issues, including power companies. As far as the distribution subsector goes, and that's really what the franchising is meant to open up, as we understand it. It's really meant to open up investment into a relatively neglected or difficult to finance subsector. So some investment has gone into the generation side of the market, some investment has gone into customer metering, but not enough has gone into just the sort of the branch between the distribution substations and the end customer generally. And that's maybe your transformers, your feeders. And that's generally because that investment needs to go through these regional distribution companies that maybe are not as profitable as people would like. Maybe they don't have the multi-year track record that people would like, or maybe just the unfamiliarity. So what we've done at InfraCredit, we've tried to help sort of pierce this mystery, if you will, about can the power sector be financed? Is the power sector credit worthy? We facilitated 3 generation companies to access the debt capital market for long-term local currency debt issuance. The first 10-year corporate infrastructure bond, the first 15-year corporate infrastructure bonds, but not much has happened on the distribution side of the market yet. So this distribution, this franchising model is a tool, really, we see, that's going to enable investment into this distribution subsector. And the first time a company wants to access 10-year or 15-year money to match the lifespan of the assets in this subsector, they may need to rely upon a guarantor like InfraCredit to do that. Otherwise, if you go to a bank, they'll probably offer you, maximum 5-year tenor. If you go to the debt capital market on your own, you're trying to figure out how to get a satisfactory credit rating to attract institutional investors to actually buy your debt. And again, you're probably going to find that you can't do that on a long-term basis or maybe even a short-term basis if you're a first-time issuer. So what we bring is we facilitate this this path to the debt capital market and really a path to long-term local currency financing. If we take it back, I mean, the privatization in 2013, had it all been paid for in Naira, had everybody borrowed Naira, we wouldn't be talking as much about maybe the gap in terms of whether the market price is cost reflective. This foreign exchange pass through from due to devaluations, due to the fact that so many companies borrowed in foreign currency to finance those really the acquisition of the concession interest in the distribution companies and generation companies. We need to move away from that. So since since these franchisees as well as the distribution companies are earning Naira, the more that they can be matching that revenue with a Naira cost basis, which includes their borrowing, the better for them and the better for the market. And certainly what we see our role again is to bring confidence, start on a reasonable size, be customer centric. You need to know who these end customers are. You need to know as a credit institution that you have rights to those cash flows first and foremost, even if the central bank has maybe a first right given their role in financing the distribution companies thus far. But certainly it's easier to believe that 1,000 customers will be satisfied and you can grow on the back of that, on the back of this franchise investment, than to say we're going to finance the entire distribution network across 4 states, across 400,000 customers, these sort of things. So that sort of scaling model is important. It builds confidence for us, and it builds confidence for the institutional investors. And the way our model is, we like to back a client the first time with a full guarantee. Bring a AAA rated guaranteed bond to the pension funds and the other long-term investors. They will buy it on the back of our guarantee and our AAA credit rating at InfraCredit. But once that project company, once that franchisee has satisfactorily paid their debt service the first few times, maybe 6 months, 12 months, 18 months in to their debt instrument, they start to build market confidence. And they'll find that the second time they want to go to the debt capital market, they won't need as much credit enhancement from InfraCredit, or maybe they won't need any credit enhancement because they will have really developed their reputation through performing on that first debt issuance. Thank you.
Okay, great. Thanks a lot for that, Daniel. I think that's very helpful to prospective developers who might be thinking of various ways to access financing for their project. And I think we've listened to a developer, we've listened to two financiers, one who is also an advisor. I guess, well, Daniel is also an advisor in some respect. But now I'll go to someone who is, well, just an advisor as far as I'm aware. Ike, you frequently advise international investors executing or financing power projects across Africa and elsewhere. Based on your experience, what parallels come to mind, and how do you envisage the distribution franchising model will be received by international investors who already have an appetite for Africa and Nigeria in particular?
Thank you, Joba. I think it's positive. I think the international investors, what they hate is when there's retrogression instead of progress. So the fact that NERC is coming out with guidelines and creating up the franchise model shows that the government is aware of challenges, and it'll be positive. However, investment is not charity, as we all know. So there's still certain hurdles that need to be overcome. If you compare the distribution franchise model to other models across the world, people generally tend to point to India because when you read our guidelines, it looks like it's modeled after India. But one important difference is that in the Indian model, the franchisor is usually a government entity.
So you don't have to have a private entity as the franchisor, where you then rely on the private entity to sort of intercede between you, franchisee, and the government. I think what we've seen succeed in other places with a similar model was something I missed the beginnings. I'm not sure who said it, but having the franchisor, the disco, own shares and become essentially a joint venture partner and a shareholder in the franchise. I think I am not aware of a situation where if this distribution franchise model has succeeded without without something similar, without the franchisor being sort of an arm of the government or having sort of a shareholder, or without the franchisee having direct privity with the government. And so having a shareholder in the franchisee sort of solves that problem. So that's one. The second parallel that I see is just the opportunity to, especially based on the willing buyer, willing seller model, to do what is typically now being referred to as community choice aggregation, which is to seek out specific businesses, specific residents who are willing to pay a higher price, either because they want additional guarantees on reliability, or because they want to know that the bulk of the electricity is coming from renewable energy resources or something else. And then if you compare the willing buyer, willing seller model, or a community choice aggregation model with a select distribution franchise, it would replicate what we see in, say, California, for instance, where you essentially have franchises, to use that word, that are that still use the public grid, but from a contracting perspective, from a funding perspective and a creditworthiness perspective, have higher credit generally than some nearby utilities. So that would be positive. I think ultimately folks will be able to structure an investment where regardless of the sort of the net mandated tariffs, if there's a willing buyer, willing seller model, it could be quote unquote cost reflective. But I mean, let me pause there. I'm conscious that there are others, but I think in summary, this is positive, but it will still be very difficult, I think, ultimately to achieve the end goals, unless the franchisors, the discos, are willing to cede some rights that they have over to the franchisees. And we can discuss that in detail later.
Okay. Hopefully we'll have some time to come back to you to discuss some of these challenges that might impact bankability. I'll just move very quickly to Dr. Ali. Dr. Ali, I mean, you work with the presidency in the corridors of power, and you I imagine see quite a lot and are very involved in policy making and helping to chart a path towards resolving many of these issues. Since the guidelines have been issued by NERC, there's been some movement, although perhaps maybe not much, given that it's still early days. But what do you reckon are the key challenges that may have contributed to any perceived slow development, if at all? And more importantly, what do you think the key stakeholders, so besides or in addition to the points that other people have raised, what do you think key stakeholders such as the federal government, the Bureau of Public Enterprises, acquisition lenders, the central bank, and all of those can play in accelerating project delivery?
Thanks, Joba. Can you hear me?
Yes, I can.
Excellent. First and foremost, thanks for the opportunity. I think this is a very ripe conversation, right? I think in my mind and mind of the guys I work with as well, we actually expected there to be a massive boom of sub-franchise arrangements since the introduction of the service-based tariff. Because what that allows you basically is to create a disco within a disco of sort, right? Which is, and sort of like you can get new capital in and you're not encumbered by the larger issues affecting the main disco, which have prevented you from accessing finance to actually make the required investments. Now, I think in terms of like the question that you ask around the key challenges, I think I have like 3 or 4 things that, this is my own sense of what the challenges are. I think there's some issue around regulatory clarity, right? As you said, Connexa basically ran through the start of the race, yeah? And so clearly, people are a bit hesitant to make a jump until the Connexa transaction, which is like the token transaction in this space, sort of like, gains traction. So I think there's some hesitancy there. I think the second issue is around the concern about the wider financial health of the discos. I think, as an investor in a sub-franchise arrangement, I want to be sure that my franchisor is in a good position. And it's no secret that, the discos are facing some challenges around their financial health, which obviously, as the earlier sessions have said, there are things ongoing. Some of the things are actually government liabilities that are encumbering the books of the discos, and we are doing work to remove some of those things. But I think that's another thing that has, put a sort of like a break in sort of like the traction that the transactions are getting. The third thing would be around the fact that, the performance agreement for this set of core investors is actually sort of expiring in a few months. So I think as an investor in a sub-franchise arrangement, I want to be sure that I'm in bed with the guys that are in for the long haul. Now, ultimately, we do not expect that anything will change in terms of like the core investors that are currently in the scopes. Just have to get the agreements in place. And those agreements would fundamentally also affect the dynamics of the franchisor-franchisee relationship under any sub-franchising arrangement. So I hope that, as we close out on those transactions, on those agreements by end of the year, there would be more clarity, and hopefully that would instill more confidence in potential sub-franchisees. The last thing that I would say is, I think the discos as well. They're my friends, ultimately, to make the sector work, but I'm not sure that there has been enough push on their side as well to bring in this, to attract these transactions. And this could come in 2 ways. There's a way where they're actually not just going out there enough to go and bring people in, right? Or alternatively, they are putting too many roadblocks in sort of getting people involved. I know Connexa and Kaduna have, got a good thing going, and I know Connexa is speaking to another disco. But I've also heard from a few people that when they approach the discos, they face so many headwinds in terms of making progress on this sub-franchisee agreement. So I think the discos as well have been sort of bottleneck potentially sort of driving this through. Now, your second question is around the role of key stakeholders. I think in my mind, I have like 3 or so key stakeholders. I think the first one is NERC, the regulator. I think to address one of the issues I raised around regulatory clarity, I think, NERC will always have a role to play to educate people, right? It's good that we have Commissioner Dafe here. I think forums like this allow him to sort of lay out the regulator's position around these transactions. And also, NERC can do I think they can do some more work around sort of like just, publicly available information, so that when these transactions are being contemplated and people are going to financiers, they don't have to make any calls to people in government to sort of like get in on the secret of how this thing works. Second thing is around BPE. As I mentioned earlier, performance agreements are elapsing within the next few months. I think the new set of agreements, it will be good if they have a section or some portion that actually exclusively speaks to the sub-franchising model. And sort of like, at least on the government side, the franchisors have confidence that, the arrangement that they're looking to get to with the discos is covered, 360 with the other investors in government. I think the last thing is around the lenders, right? Which are in this case, I'll focus on the local banks. I think the sort of like highlight is they just need to loosen the purse strings a little bit. They are with us, Muiwa and Co. They join our meetings on the Technical Committee on Payment Discipline, and they have full visibility, I would say, in terms of like what is going on with these discos, right? They're in on the secrets. So I think, it would be good for them to sort of like apply some more, pragmatic lens and sort of like appraising some of these transactions. Because if you go into them and I mean, I can't blame them in a way, right? I think there's some scars from the original loans that went out to the core investors, right? Which I believe is sort of like potentially clouding some of the judgment that the banks are making in terms of getting involved in the sector. But I would say, you know, a sub-franchise area is basically, it's almost like a greenfield within a brownfield. Because as Conexa is doing in Kaduna, you can go into an area, define the parameters of your operation, and basically, you know, all of these things around like losses, collection losses, and technical losses, and so on and so forth, you can put in those investments and, you know, ensure that you almost have like a, you have like a, you know, a very sane grid to operate by yourself. So I think it'll be better for the banks to, you know, sort of like appraise these proposals on their merits, and hopefully, you know, let the cash flow support these transactions. And I'm confident that, you know, these things can really turn out well. Thank you.
Okay, thanks a lot. I'm sure people have taken note. Many of the stakeholders will certainly perhaps start to take some actions based on the useful insights you shared. My next question will be to Commissioner Daffy. I mean, when you have a regulator in the room, you ask all the questions that you can ask, so you can get all the clarity that you can get. And regulatory clarity has been one theme that was touched on. Although in the context of franchising, I imagine that there are two sides to that coin. Some people certainly feel that the approach that NERC has taken to the franchising guidelines gives a lot of flexibility to developers, operators, and financiers to structure this project in a manner that they consider to be most bankable. Sort of NERC seems to be advocating for a market-led approach. But I mean, these are just us from the outside making our own conjecture. I think the first question is just in relation to the guidelines on distribution franchising. We've spoken about that light touch approach. What was the thinking behind, you know, allowing the market to take the lead on this one?
Okay, the anti-privatization, DISCOs had commitments to come into Nigeria with technical partners that would support them in meeting their commitments in the performance agreements. Basically providing services to customers and whilst reducing losses. We had seen that there were challenges with the initial approach, and to move forward, we had to adopt a model that first of all recognized that the DISCO is responsible for its franchise, for the network area. And also we have to take an approach that took into consideration these different dynamics in different network areas. And the only way that could be done properly was to take an approach that has the DISCO leading, whilst holding the DISCO responsible for its commitment into consideration under under its performance agreement and its commitment as a utility. That would enable them, okay, what would work? Taking a light-handed approach enables the DISCO to take into consideration its current state and what it needs, and also allow the parties to negotiate a framework that would work and come to the commission where we basically issue a no objection.
Thanks a lot, Commissioner. And I think just one slight question that I'll ask is, there's been some, and maybe there's no time to go into detail on it, but I just wanted to ask, there have been some suggestions that there is some sort of overlap between the franchising guidelines, the sub-franchising regime, and some existing regime in the sector, like the IEDN, the mini grid regime, and the MAP. Because, for instance, the guideline contemplates that you can sub-franchise a portion of your against an area. So, what are your thoughts on this, and how do you, if at all, how does the Commission, if at all, intend to address these perceived overlaps?
I wouldn't say the only overlap I would see is that all the regulations you mentioned are working towards ensuring that we can get electrons to the customers. With regards to, and there are different models when one looks at it, but the franchising model takes into consideration that, okay, I want to do the different activities the DISCO does by supporting the DISCO. So you could become a utility within a utility in a ring-fenced area, or you could pick on different activities to support the utility. Now, when you look at the other frameworks that you mentioned, IEDN, the IEDN presupposes is a framework whereby you can have an independent electricity distribution network in an area that is underserved or not served by a DISCO. So the difference is with the IEDN and the franchise arrangement is that an IEDN isn't partnering with a DISCO. But under a franchise arrangement, you are definitely working under a DISCO's distribution license.
Thank you very much. I think that will have helped to clear some of the questions that we've heard people ask in the market. And I think we have about 5 minutes left, so I'll just do one round of just get your final words from everybody. But I'll start with Joel. And in giving your final, tips for other developers looking to get into the space, it would be nice if you touched on one, all within a minute, Joel, one or two challenges that you've encountered in developing the Connector project.
Yeah, okay. So within a minute, what I would say is the key is customer engagement. Know your customer is critical. Doing a proper energy audit and asset audit of the area that you intend to franchise. And then the third fundamental pillar is not underestimating the key alignments required with the DISCO, with the stakeholders such as BPE and other ancillary stakeholders such as the acquisition lenders. So those are the key sort of components I would advise for others.
Thank you for that, Joel. Excellent timing. So I don't know if you just last words, especially if you can just squeeze in one or two of those bankability points you were going to touch on.
Sure, just all within a minute. One, I agree with Joel, do an audit. We worked on a transaction where there was no audit, and it turned out that the cost of fixing line losses was 7 times more than anticipated. So know exactly what you're getting into. Second, confirm what rights you would have versus the DISCO with respect to, especially if you're putting in any asset that could be deemed to be a generation asset, confirm who owned that. Third, completely engage with the DISCO. I think a model where the DISCO is an equity owner or or you have a long-term contract where there's an incentive beyond the franchise fees for the disco is important. I think it'll be difficult if the disco is not sort of involved. I'll stop there in the interest of time. Yeah.
Okay, thanks. Dr. Ali, just 1 minute, last word. You've spoken to stakeholders, this one for developers.
Yeah, I mean, I think my key piece of advice would sort of follow what Ike has said. I mean, I think working with the discos is very important. I mean, I've been in conversations with Joel, Pradeep, and I think the secret to the progress they have made is the excellent relationship that they have with the Kaduna disco folks. So I think, collaborate properly, and I think you'll be all right. I think if you collaborate well and ensure that you sort of like understand the stakeholder landscape, to what Joel said, right? You have to understand what's the role of BPE. I mean, NERC has been generous enough to give a light-handed regulatory approach, but I think obviously there are still rules, right? So it's not a Wild West. So just be sure that you're aware of the rules, and I think everyone will be all right.
Okay, thanks a lot. Obiora.
Yeah, I think the only thing I would add is, that Connexa basically are the pioneer in this space, and basically panel beating a lot of these industry documents and agreements for the rest of us who are following behind them. So I also encourage them to open source as much as they can. Development costs can be reduced when we kind of share information and don't have to go through all the hurdles that you've gone through. So I'll just say, as much as possible, collaborate and open source as much as you can. Thank you.
I personally have some thoughts on open sourcing, and I'm sure that. Okay, Daniel, I don't know if Daniel,
just the last point on pricing. Every project needs predictable and sustainable pricing. Nobody wants to be going back for approvals to change the tariff if inflation moved or FX moved. So that long-term certainty around pricing, whether it's through regulatory means or bilateral contracts with some of the largest customers within the sub-franchise area, this is what investors want to see. Thank you.
Okay, thanks. And lastly, Commissioner Dafe, tips. I'm sure everybody's waiting to hear what tips you have for developers.
Okay, so you see a lot of people said stuff about regulatory certainty. And I would tell you that real entrepreneurs are not waiting for the regulator. I met the CEO of Connexa in London, I think in 2017. And even before we had a regulatory framework, they had started this deal, right? So if you've done your due diligence, you know what you need to do, you will go after it. And in some cases, like you said, Connexa is leading the way, and the rules they required got formed after they started the transaction. So it's not always you waiting for the regulator, but seeing the opportunity. I think Nigeria has the largest power market in Africa, with a lot of untapped opportunities. And besides the preconceived notions, investors are seeing that, and they are coming to invest by adopting different models.
Okay, thanks a lot, Commissioner. I think for all listening, Commissioner Dafe was saying, welcome, come and do this. This is the move. I had planned to round up with a one minute or 2 minute talk, but I think that the speakers have done more than enough justice to the topic, and they have covered all of the key issues, even within such a short time. I believe that there are insights which are quite unique and are born out of years of experience in the space, are invaluable. And I will just say that for those looking to play in this space, one thing that cannot be underestimated is working with the right advisors who are creative and able to work even when the regulatory framework is not clear. As Joel mentioned, we've been on this project, and even Commissioner Dafe mentioned we've been on this in 2017-18, and we are now in a place where there's more light around it and people are coming in. So distribution franchising is going to be a big thing undoubtedly. And with these tips that have been shared during this conversation, I'm sure that developers and financiers looking to play in this space have enough of a playbook to get started with. Thank you, everyone.
Thank you, Joba.
Yeah. Thank you.
Thank you. Yes. So now I'll hand over to the next. Yes, thank you, Mr. Agbo.
Yes, good afternoon, everyone. Should I just go ahead?
Yes, please, Ibi, go ahead.
Do a smooth handover of the baton.
Please go ahead.
Thank you, Mr. Aigogun. Good afternoon, everybody. And for all who have been with us since the morning, a big thank you to you. And so happy to see that things are progressing quite smoothly. So very quickly, we'll move on to the fourth panel for today. And with the panel topic, the new wave of privatizations in the NESI and future IPP development. I have a very, very robust panel today. I'd like to call this panel my panel of family and friends. There are a lot of familiar faces on this panel, people that I have been working with over the past over a decade in the power sector and doing all kinds of transactions with. So it's good to see a number of them on this panel. I will, if you're a panel, 4 panelists, I'll be glad if you could turn on your video. I'll just go straight to start introducing everyone. I just want to make sure who I have on. So I make sure I introduce all of you appropriately. I can see Reason. I can see Mr. Chris. Yes, my good friend Patrick is here as well. Where are the ladies? I haven't seen Antonia and Mrs. Ono. But very quickly, let me just introduce the members of my panel. I will start with Patrick Ngbenwelu, a good friend of the house and somebody that I have done quite a bit of work with over time. Welcome to the panel, Patrick. For those of you who know, Patrick Ngbenwelu is currently the group executive at FBN Quest Merchant Bank, and he's also the head investment banking and operations. He joined the bank in December 2011, having spent 3 years heading the project financing department of Standard Bank's Lagos operations. That's a Stanbic IBTC Bank. Patrick has over 28 years banking experience, of which 23 years has been dedicated primarily towards financial advisory, structuring, debt arranging, lending, and closing of big ticket project finance transactions in the UK, Portugal, Saudi Arabia, Qatar, Oman, UAE, and other GCC countries. Patrick has worked on project finances in excess of approximately $7.4 billion since 1998. As head of FBN Quest Merchant Bank's investment banking division, he's responsible for leading deal teams involved in advising, structuring, executing, and closing of the firm's debt, equity, and capital markets, arranging and advisory activities. Again, welcome to the panel, Patrick. Very quickly, I would move on to Mr. Chris Chijutomi. I hope I got your name, and apologies if I didn't. Chris is the Director, Head of Infrastructure, Equity, Infrastructure, and Climate Group at the CDC Group. And he's responsible for CDC's investments in equity across Africa and Pakistan. Chris is based in London, and he joined the CDC in 2017. He has over 20 years of infrastructure experience across Africa, South Asia, and Europe. He has particularly his focus, his expertise is in power, water and wastewater, and transport infrastructure, both operational and investments. He's a board member of a number of CDC key investment companies such as Globalec, Gridworks, Ayana, and Africa Power Platform, a CDC JV with the ACFED Group. He's a chartered chemical and process engineer, and he's currently a member of the EON Technical Working Group of Finance and Investment. Welcome to the panel, Chris. A pleasure to have you. Reason, let me quickly introduce Reason. Reason is a true friend of the Olaniwu Ajayi family. He was with us a couple of years back before he went to seek greener pastures, aka more money. Reason is, he assists African governments with negotiating projects in the African Development Bank. And he's based in the ALSF's power project portfolio with about 26 projects having a total of 4 gigawatt total capacity of transactions under his belt. Reason organizes capacity building workshops for African governments on negotiating IPP projects. And prior to joining ALSF, Reason worked with a leading New York-based commercial and industrial solar power company, where he supported the company's legal team in reviewing, drafting, and negotiating agreements for the development and acquisition of over 20 commercial solar power projects. Reason is a Harvard grad, and he's admitted to practice law in Nigeria and the state of New York. Welcome to the panel, Reason. I don't know if any of my other panelists are on. Yes, Antonia is here. Hello, Antonia. It's been a minute. Good to see you. Let me just quickly introduce Antonia. Antonia Oko is with an executive director at Standard Chartered Bank, UK, within the Project and Export Finance Group, with a specific focus on project finance in Africa. She has been involved in significant multi-billion-dollar transactions in Africa across the value chain of oil and gas, petrochemicals, power, and infrastructure. Prior to Standard Chartered, Antonia previously worked at Seabed Branford Shank & Co. New York, where she structured and underwrote billions of dollars in municipal bonds across the United States and its territories in various sectors, including power, water, and sewer, and transportation. Antonia holds an MBA from Wharton and a BSc in finance from the West Virginia University. Welcome, Antonia. Moving on to our second lady on the panel, Mrs. Heather Ono. Mrs. Heather Ono is a visionary executive. She has over 20 years of domestic and international experience in operations management, market identification, strategic business planning, and strategic positioning of startup and growth organizations. Heather championed the $201 million acquisition of the 1,020 megawatt Sapele power plant back in 2013. She also served as a project developer for the Rural Electrification Agency and Light Up Nigeria program. She's a member of the board of directors for Flow Engineering International and Sapele Power PLC. Do we have Heather on the panel? I suppose she'll be joining us soon. Last but not the least is Kolapo Joseph. Kolapo Joseph is an astute investment banker with over a decade of experience in the power sector. He spent 6 years in one of Nigeria's leading independent investment banks, Vertiva Capital Management, and rose up to be the deputy head of the investment banking division. He went on to become the pioneer head of the capital markets and advisory unit in the company. He's presently the GM head corporate finance at North South Power Company Limited, a company established by a diverse group of Nigerian and African shareholders to own and operate a diverse and growing portfolio of electricity across Africa. He currently oversees the company's 30-year concession of the 600 megawatt Shiroro hydroelectric power plant and the development of a 300 megawatt solar power project in Nigeria. Ladies and gentlemen, there you have it, my very august panel this afternoon. And we're going to be discussing the new wave of prioritizations and future IPP development. And just to set the tone for our conversations, as you all know, in 2013, the federal government, in culmination of a number of policy initiatives, embarked on a very landmark, unprecedented privatization program, where the hitherto utility, NEPA, PHCN, was unbundled into a number of successor companies, 6 generation companies, Gencos, 11 discos, and 1 transmission company. That was a big undertaking back then in 2013. A number of people on this panel were part of that process, and there were high expectations in the market for the energy sector as a fallout of that privatization. The hope was that all the inefficiencies that had been experienced under having a state utility with NEPA, that all those inefficiencies would be a thing of the past, and that the sector was geared towards leapfrogging into a true sophisticated energy market where the forces of demand and supply will come to reign, where there'll be more investments in expanding and rehabilitating the power sector across the value chain, and where ultimately the benefits would go to the consumer in having increased access to reliable and dependable electricity supply. It's been 8 years since that privatization happened, and as a number of the panels that we've had since morning and since the conference started have shown, we are yet to really harness the benefits of that process. And on the back of that, the federal government tried shortly after completing the privatization of NEPA to also privatize the NIPP assets, the 10 NIPP assets. That wasn't quite successful for a number of reasons. And there's been a recent attempt to restart that process. The NCP recently announced it was inviting expressions of interest from potential investors in 5 of the NIPP assets. I think the deadline is tomorrow for the submission of expressions of interest. During that process, during that timeline as well, we've also had last year in November 2020, the AFAM generation asset was successfully privatized and sold to the Transcorp Group. That's both of the AFAM Genco and the AFAM Fast Power Genco assets were privatized and sold. 100% of the issued capital was sold to the Transcorp Group. We also have upcoming privatizations by way of Zungeru, the hydropower plant that's also to be privatized, and the government is looking to privatize these assets this year. So the question then is that in the wake of where we're on the curve of another round of privatizations, and what this panel is going to be exploring in essence is what are the lessons that are useful to be learned from the privatizations that have been done in the recent past in the energy sector, especially from the 2013 privatizations and also the more recently concluded privatizations of AFAM and Yola, and the ones that we're going to undertake. What are the lessons that to be learned to ensure that these produce more optimal results, in the sense that 2013 showed us that it wasn't so much, it's not a race to offload these assets to the private sector. A lot more needs to be done to ensure that even when these assets are in private hands, the assets can be worked and can be optimized, and that the ultimate objective of having increased generation capacity and having consumers have access to affordable, sustainable and dependable power, those objectives can be met from a policy and commercial and also socio-economic perspective as well. So those are the issues this panel is going to be exploring. We're also going to be looking at what are the factors that are affecting the ability of the Nigerian government to have more IPPs in the pipeline. One of the panels this morning, Mr. Edu Okeke, he was very passionate about saying that we don't have enough generation capacity in the country, and definitely we need to have a more strategic and focused and orderly way of bringing online more IPPs. So since, like Wolemi mentioned in his conference framer, since Azura was commercially operational in 2018, and we achieved financial close in 2015, not much has been seen. There have been attempts with OMA IPP, the QIPP, with the Proton IPP, to launch these various, and for different reasons, these projects have not been able to take off the ground. So we're going to be exploring what are the issues, what are the factors that are militating against successful privatizations and future IPP development. And straight off the bat, I'm going to start with Mrs. Ono, Heather Ono. Do I have you here? Okay. If Mrs. Ono is not available, let me move quickly, very quickly, to Patrick. And I'm going to start with you, Patrick, because you have a very, very unique perspective. You were part of the 2013 privatizations. You and I were a number of those deals, and we saw all the challenges that played out during that privatization. And you've also been opportune to advise on the government side. Even recently, your firm acted for the BPE with the privatization of AFAM. My firm acted for the Transco Group. And you've also been, you've had mandates during the 2013 privatization. You represented sponsors who acquired assets. So you have a sort of a 3D view of the whole privatization process. And I'm very, very keen on hearing from you that as a financial advisor, as a financier of these acquisitions and these privatizations, what would you say have been the key lessons that you have learned that you think would be useful, to take into consideration for the new wave of privatizations that we have? And in answering that question, you can look within the context of, in terms of deal structure, contracts and the contractual terms, and also post-acquisition, some of the challenges that the owners have faced. So looking back at it all and having your own, sort of the 3D view of privatizations, what would you say are the key lessons to be learned?
Thank you very much, Ibi. Good afternoon, ladies and gentlemen. I hope you can hear me. It's a pleasure to be here, and good afternoon, Frank Aibogu. I think this would be one of my favorite exam questions, but I'll try to keep it brief. And the issues are quite a lot. But let me just focus on some of the big ones.
I think we're having some connectivity issues with Patrick. Yes, I think he froze for a moment there.
Way back in 2013 was the aggressive timetable which the private sector had. And we know that for some of these assets, insufficient due diligence was undertaken. And that due diligence would cover things to do with the gas supply, pricing of the feedstock, gas pipeline infrastructure, offtake or offtakes, distribution, and collections. They should be more focused, and now this is just looking more again at what was paid for some of these assets. The focus really should be more on what is the asset's debt capacity, as opposed to simply the valuations or how much it was paid for. Now, I'll make a subtle distinction. To the extent, you want to buy an asset and you're forced and you say, well, I'm going to bid 10 naira, another person says 15, another person says 20, but it's not necessarily the highest bid amount that translates into debt that that asset can carry. And part of the due diligence should also involve, if you're putting down a number on the table for acquiring an asset, can that asset pay off the debt? And we found that quite a number of these assets are actually struggling. The other point worth mentioning is, you have the borrowing vehicle, which is separate from the acquisition vehicle. And one of the concerns which lenders and investors had was how distant they were from the cash flows. And the expectation was that, whether it's 6, 9, 12 months further down the road, there was going to be some kind of a collapse or consolidation with the borrowing entity and the target entity, such that lenders had clear visibility and were much closer to the cash flows. Now, we as FBN Quest, we've advised a number of clients, and without mentioning names, we've been able to tick the box in terms of getting certain approvals. But there were some other approvals which simply didn't come through from the FGN side, simply because the FGN was concerned about the debt that had actually been taken on, and they didn't want to assume responsibility for those debts. Now, there were solutions put on the table, which were not really embraced. So I think, number one, expediting the process to make sure that, lenders and investors are much closer to the cash flows, giving the private sector much more time to undertake their due diligence. And then, at the bedrock, the fundamental bedrock in trying to structure some of these deals is tenor. And I've been on this webinar since about 10:30 this morning, and we keep talking about tenor. We structure deals around a tenor, which unfortunately post-acquisition simply doesn't work. So another big lesson would be we need to also make sure that working with FGN, the private sector is able to access local funding with tenors of at least 10 years as a minimum. Because we found that, and the reason why I emphasize local funding, quite a number of these entities took on funding in US dollars, and they're actually struggling quite significantly today. And some of the debt tenors have been 5 to 7 years, and that hasn't helped. And I think just to wrap up, because there are quite a few other points, one other point worth touching on is trying to make sure that from the onset, we incorporate the capital investment plan of that asset as part of the financing structure. So, private sector entity acquires an asset and then later on down the road realizes that they need to embark on capital investment process to ramp up revenues. They go to the bank market and they're not able to raise the funding. So the overall financing plan and the overall financing structure must include not just the cost of acquiring the asset, which should be able to amortize the debt, but also including the capital investment plan for actually enhancing and improving the revenue generation profile of the IPP or whatever power sector entity that's involved. I mean, it's a long list, Ibi, but let me stop there, and then others can contribute. Thank you.
Thank you very much, Patrick. You're spot on. It is a long list, a lot of factors that, a lot of lessons that have come out of, being part of that prioritization process. And, this takes me to, because some of the things you've said have highlighted the challenges that the investors faced upon acquiring this asset. There's a debt mismatch in terms of the currency of the debts they acquired and the currency in which the asset earns, generates revenue. And, in terms of the lack of the asymmetry of information, we didn't have enough time to due diligence this assets, and this played out in a lot of operational challenges that they had. So this takes me very quickly to Kolapo. Kolapo, I mean, you are, North South Power is the concessionaire of the Shiroro, hydro power plant. I mean, for me, just speaking for myself, I think the hydro assets, with the concessioning structure, I don't know what it is, but it seems they got it sort of a better deal in the private. They've done really well. The hydro assets have done really well. So I suppose the question to you would just be to ask that, what has been North South's, experience? I mean, operating the assets so far, and what would you say are key lessons in terms of, because we do have Zungeru that's in the process of being privatized. What are the lessons in terms of the structure in which that was adopted for privatization of Shiroro that you think, would be useful in undertaking, future hydropower privatizations?
All right, thank you, EB and Business Day for organizing this panel. I think it's well apt at this stage of the business. Look, I came from the finance world. I was also involved a lot in the privatization. When I was at United Capital then, so clearly understand how it was structured and what was promised and where we are. We are North South Power. We've been able to achieve a couple of things. It's not really because the hydro is structured differently, but I'll touch about that. But really, one of the things we came, well, when I joined immediately, I lead corporate finance and strategy for the company, was how do we work on our capital structure? At that point, we had USD dollars, we had dollar financing, we were a bank. The first thing we wanted to do was take out our dollar financing. The next thing was how do we optimize our capital structure, and how do we improve our sources of funding when we want to take up projects like Zungeru, and recently we acquired a 30 megawatts Gurara power plant concession, the concession for 25 years of that power plant. And what do we do next? So once we took out the dollar funding, because we knew there was a clear mismatch, the next step was now to go to the capital markets. And we first did our first series one with InfraCredit's credit enhancement. They believed in our stories, in our growth story, in our ambitions, and they backed us up. And the next one we closed last year was Series 2. We did a Series 2 fund without any credit enhancements. And we raised it at 12%. Noting that our rating A-. When we first did our rating was investment grade was BBB. So there's a story behind, and there was a thought process and strategy and thinking towards it. Now, so we faced the challenge everyone faced. What has helped us in, I think, from a hydro perspective, in a way, is that we have to pay concession fee every year. So think of it, ours is $21 million. That's equivalent to our feedstock plus 5% of our revenue. But one thing we've been able to tell the government is that to the extent that you owe us, there's this huge receivables, we want a set of arrangements to net that off. And we're in discussions with them, and that's ongoing. But there's a reliance to be done this way because of the peculiarities of the. Now, lessons learned, I think Patrick touched on them. I think one thing the government needs to get going forward is that, look, you cannot use a standardized approach for all assets. Every asset has its peculiarities. And also based on the state of the macroeconomy. Then when we did these privatizations, Nigeria was in a different state. You know, GDP was growing, and there was a lot of enthusiasm on the Nigerian growth story. Now that has changed. So one, they can't use the same standardized approach to drive it going forward, because definitely they're going to be challenged, even for the NIPP asset. Looking at, there's going to be challenges. One of the other things a lot of us did during that privatization, which Patrick touched about also, is that, look, we all had we came in with, most of us were eyes blind. There was limited due diligence on the assets. We took big risks, made certain assumptions on certain things. For us, sure, we thought we had three, so we have four units, each can generate 150 megawatts. In reality, they was planning to shut down one. So we're going to, at the end, we're going to be left with an asset that could only generate 450 megawatts as against 600 megawatts. And that's because it had a big intake gate, which we had to tackle. The government had given hope and was planning to close it. So immediately we took over. The first 2 years, we spent $10 million just tackling that. And this was when we were loss making for that during that period. So that needs to be sought out, needs to be changed in terms of the model of how they approach the financing. But the reality is that when you compare having a new, like an Azura IPP versus a privatized asset, I would always say a privatized asset will still be a project I would go after. And that's because there's a lot of development risk in Nigeria for any greenfield project. And I really dug my hat, because I was in, from the advisory space, I really, it's kudos to Azure what they've been able to achieve, but it's also, I think, is a signal to the government what needs to be done if they want to attract certain Azures going forward. But I think I'll just end there by I think I've spoken about the challenges and how we have viewed it. Yes, the hydros have it a bit better, but we still face the same challenges. Our concession is in dollars, so every year it goes up based on the prevailing exchange rates. We still have the challenges of receivables, high receivables. Government pays us the same way they pay every other GenCo. So what I've always told people is that despite the challenges, you have to find a way to work and make it work, because this is Nigeria and the challenges will always exist. But you have to find a way to make it work. And for us, it has been looking at our capital structure, being disciplined on how on our investments, making sure we have the right incentives for employees and everyone to make the right decisions for the company. And that's how we've been able to go forward in the logical but growth phase going forward.
Thank you very much, Kolako. I mean, you've touched on, something that I'm going to ask you just also to hold your thought on that, because I'm going to take up Antonia on that. When you talk about, developing projects in an emerging market and the high, government risk involved. But before I get to Antonia, let me quickly just, engage Heather. Heather Ono, because you were also, I mean, you were part of the investment in Sapele Power, the investment vehicle, you spearheaded that. Good to see you. It's been a couple of years. And, we advised you on that, acquisition. So just to ask you that, in terms of what are the lessons, what would you say now that, you went through that privatization process as arduous as it was, raise the capital, acquire the asset. So looking back in terms of how the deal was structured, the acquisition was structured, what would you look back and say, look, if I having the knowledge I have now as an operator of the asset, these are the things that I should have insisted on changing in the contracting structure? Because I think those are the kind of pointers that are useful in structuring, the new privatizations that we're doing now. So what would you say would be, your own key insights from, perspectives on how those privatizations were structured and, what you've experienced since taking over the asset in 2013? You're on mute.
Okay. Can you hear me now?
Yes, I can hear you now.
Okay. Thank you very much for having me. And thank you for taking out your time to understand what's really going on in the sector. The first question, I joined late, but notwithstanding, I pretty much understand where this is going. The first question is, if I were to do this all over, I probably wouldn't invest in the power sector. And the reason being that there's no synergy in the entire sector, and the people that we thought were experts lack the basic knowledge in terms of understanding, and it continues to be the problem. However, we are already in it. I have asked myself the same questions over and over again. Should I continue to complain, or should I find a solution? And even if I complain and give back the assets, they cannot even find my money to give me back. So right now, I've been very focused on solution for the sector. And it's been about 5.5 years pushing from the presidential level on how we should go to actually ensure a profitable, a lucrative power sector that would ensure that people actually get power to grow our economy, most importantly. So we've started getting that response from them, and in terms of a partnership with the transmission company, which is the bridge to make sure. But for the record, let's be clear about the problem of the sector. The problem is, I'm going to put it in a layman's words. So we generate an average of 5,000 megawatts every day, and we're only able to successfully transmit about half of that, and maybe less than half of that is also paid for. So if you have that knowledge in mind, you will know that we are going to continue to run in perpetual deficit. It does not matter, even if God were to come down from heaven and the situation continues this way, it would be in perpetual deficit. The banks lack the knowledge, the technical people lack the knowledge, BPE lack the knowledge, transmission know the knowledge, they have the knowledge of what the problem is, but there is no willpower to do it. So that makes it even difficult. We as investors actually lacked the knowledge before going in, because we didn't ask the right questions. Being Nigerians that we are, we just wanted to acquire, and thinking that once you acquire, it's going to start minting cash for you. But getting there, you will realize that that's not the case at all. So there's a lot of mismatch from, just name it, from the beginning of the transaction to the last, to the end. There's mismatch technically, there's mismatch financially, like one person mentioned about, acquisition cost continues to go up because the dollar, we bought this plant when it was 152, And there were lots of banks that were not ready to come on board because they kind of saw that this was going to be there. The PPAs, all the vesting contracts are not live. So, and except for Azura, lucky. And I'm not one of the Gencos blaming Azura. That is how the business is supposed to be done. So if we were dumb and they were smart, don't blame them for that. And of course, the money came from America. The government couldn't do anything about it. They wouldn't even dare think of not giving them the guarantee that is required for them to run the business. But they didn't give that to us in the same market where we are all, experiencing the same thing. Some people are treated with preferential treatments. Well, that's what it is. And because there is nothing, the government don't have the willpower to right the wrong, the only other options I have personally as an investor is to look for the solution. So we're working on that, and hopefully we should be able to, by the end of next year, we should be able to show something that could actually profile how we can come about the solution so we can balance the shortfalls, the perpetual shortfalls in the system. Unfortunately, Nigeria is the only place where you actually invest money and start praying for something. You start fasting and praying for something to happen, as opposed to understanding the sector first before going in, or having the government respect their contracts. Now we're trying to activate the contract in through successive approximation process. Hopefully, even if that works, and I can tell you that is not going to work, because there is no how you're going to give what you don't have. If we were to say all contracts come live, they should be able to pay me, not even for deemed capacity that I put in the national grid today, they cannot pay. The market itself cannot pay. And I think that is where some people's minds are crystallized, the bank's minds are crystallized, that the market itself cannot pay for what the power that is being generated. So that is the long and short of it. Where I am right now, where my mind is just focusing on what the possible solutions are. It's not like there is no solution out there. All hopes are not lost. It's just trying to kind of convince the people sitting in the helm of affairs that let's do this way. What you have been doing, you've been doing this over and over and over, expecting a different result. Nothing is going to happen in that sense. You can have all the build out that you're building out. If you notice what is going on in terms of trying to increase capacity, there are lots of bridge to nowhere. Like you build transmission line from south to north, to up north, to wheel out and spend billions of dollars for it, naira, for it to get there. And there is no company to utilize it. So you are just spending money to wheel out just 10 megawatts. That we don't have industries in Nigeria that can actually consume real power that could make an economic sense or grow us economically. And those things are things that were not considered from the BPE point of view, from the government point of view, and from us, the people who purchased. Having known, now that we know all these things, it's taken 5 years for us to understand it. It doesn't even matter whether you think the hydros are doing better, they're not doing better. It's a perpetual shortfall. It's a perpetual loss for all. The loss for one company in this sector is a loss for the entire sector and the entire people of Nigeria at large. So that's the long and short of it for me. But I'm focusing now on the solution. And I'm actually, for the first time in my life, I'm very optimistic that once the solution comes on board, we would be able to actually mitigate the shortfalls in the industry. But it's a vicious, as it is right now, it's a vicious cycle of waste, energy waste, financial waste, technical waste, manpower waste, all sorts of waste.
Thank you very much, Heather. I mean, I can feel your passion and your pain. I mean, you're an investor in this business, and it's been 8 years, so I really can feel your passion. I mean, you've highlighted a number of things, and you've said that, I mean, if you could speak to yourself in the past, you would have not even ventured into the power sector. Well, we are here, where we are. There are investments today, and the government is about to privatize another set of assets. And the question, some of the things you've highlighted then comes back to bankability. If these assets are going to be, acquired, how are those acquisitions going to be financed? And a number of the things that you have flagged and that Patrick alluded to and Kolako alluded to all go to bankability, because ultimately somebody has to fund not just the acquisition, but also CAPEX, the operations of these assets post-acquisition. So I'm now going to turn to the financiers on the panel and sort of seek their views. I'm going to tilt the conversation a bit. I'm going to go to Antonia to speak in terms of IPP development. So Antonia, you at Standard Chartered, played a very significant role in the financing of the Azura PPP, and that took quite a bit to get over the line. We advised the syndicate, of lenders on that deal, and there were a number of significant issues that had to be dealt with. So I just wanted to know, Antonia, from your point of view, and looking at there are new opportunities in the market now, and let's even leave aside the issues that have been flagged around the currency of the debt that is taken on by these assets. What are your thoughts from the perspective of an international financier on financing future power projects in Nigeria? Are there any valuable lessons that your institution and you as a financier generally have learned on how to manage emerging market risks in developing and financing new IPPs? I'd like to hear your perspectives.
Sure, Evie, thank you very much for that question. And I just wanted to say thank you for having me on, as well as a big hello to my fellow panelists, most of which are very well known to myself. If we're going to talk about IPPs in Nigeria, especially starting from Azura, I think the first thing I would say is when we as an institution, when we think about Azura and the work that we did on that transaction, we actually feel some sort of pride at being able to take it across the finish line, because it was a very challenging environment, probably not as challenging as it would be today to execute that kind of transaction, but it was quite challenging. However, I am aware that depending on who you ask that question to, there's certain people that sat at different sides of the table who were not very pleased with the way that the Azura transaction crossed the line. But what I will say is the financiers are getting their debt serviced, so that's always a very good sign for us. And it appears that when you look at that particular IPP in the context of all the other IPPs in the country, we probably, and the lady who spoke right before me kind of alluded to that, we probably did something right in the contractual framework if we're getting paid better than other generating assets. So something went right, at least in the contractual framework. But I do note that it is a bit contentious. What I will say is lessons learned. It's been a very painful journey. And there's a reason why none of the other IPPs, and you mentioned that earlier, Evie, none of the other IPPs were able to get across the finish line after Azura. And why is that? Well, for one reason, contrary to what certain parties may believe, Azura, the contractual framework and the risk mitigation structure that we put into that transaction represented the minimum tolerance that the international community was willing to undertake for this type of project. And the moment they moved the goalpost and changed somewhat the framework, we saw that no other transaction was able to cross the finish line. Another lesson learned, and I'm really hoping that all the stakeholders in the sector are learning this lesson or are understanding this lesson, is that you cannot look at IPPs in a silo. You need to look at them as part of a value chain, because if there's a break in the link, it affects everybody. Okay, so I'm going to, for the purposes of this, I'm going to exclude Kolakwa and the hydros, because I'm going to start off with the gas supply. because most of our generating IPPs rely on gas. You need to look and fix every aspect of this value chain, from the gas supply. You need to fix the transportation of that. Then we look at the actual IPPs themselves. You have those IPPs, but they're not silos unless you would build stranded assets. You need transmission that can actually absorb that power. You need distribution. You need to get it into the homes. And you need to create the environment that provides the right type of incentive for the private sector to invest in each of these aspects of the value chain and actually make money from it. Now, what does this mean? Does this mean that eventually it's going to translate into a higher cost for the end user? Perhaps, but that is the reality. We have tried to stem that cost at the end for the end user and try to keep it low. And I mean, look, has it worked? It's been 8 years. It hasn't worked. So that's not working for us. So we need to go back to the page and we need to refigure it out. We cannot just focus on financing IPPs and then assuming we're successful, we're just going to have a whole bunch of stranded assets. We need to focus on the entire value chain, and that's one aspect of it. Another aspect of lessons learned, and I think it may have been Patrick who spoke to this earlier, but I actually want to touch on that because we tend to, yes, I do note that we do need quite a bit of investment across this value chain that I've just spoken about in order to provide the amount of power that would even meet the latent demand for power in the country. But we cannot just look to international financiers to plug this funding gap. It is important to have a risk framework that is attractive to international financiers. But I mean, again, looking back at the past, if we're going to learn a lesson, a lot of these transactions took place when someone said it, a dollar was 150. Where is the dollar now? What have we learned from that? Kolakwa talked about a takeout into the capital markets. Why did they do that? Because you cannot fund 100% of your projects with foreign currency when the final end user is paying Naira. It's common sense. So again, have we learned that lesson? And in order to learn that lesson, how do we then unlock that liquidity? And it's not rocket science here, because other African countries in which we've been involved in these transactions, when I say we, at Standard Chartered, we've unlocked close to 25 years in local currency liquidity. But in order to do this, it's a value chain. And that chain has to be supported by the government, MOF, and CBN, because you need to be able to help the local banks, one, manage the risks, because the last thing you want to do is cripple your banking sector in a country. That's something we all know what happened when the financial markets imploded in 2010. Not good. So then how do we look at this? We actually need the CBN MOF to actually support the local banks in order to create attractive structures. They started to do this with the PAIF fund, but this wasn't continued. But there are other ways that you can unlock liquidity, mini-perm structures, but it is not smart to undertake financings in solely 100% foreign currency. You will run into trouble, and we see that now. So if I'm to go back to your original question, EB, and I'm really sorry, this is a very long-winded way of responding, but if I'm to go back to your original question about lessons learned, I kind of feel like the lady who spoke in the terms of, I don't know that there were lessons learned, because we're repeating the same cycle where we already saw the pain that the first set of privatizations under PHCN went through, and how they've had to struggle, and how they're still struggling with a few things that were highlighted from the initial point, and then we're undertaking another privatization in the same sector, in the same environment. Have we fixed those problems? No. So and then as an international investor, remember when the first privatization wave was happening, all the banks, all the international banks were trying to get into it. And then as we started to do a DD, we saw a lot of international banks step back and the local banks had to carry this. This new privatization wave, you're probably not getting calls from a lot of international financiers because we haven't fixed it. And this translates to the IPPs, and it's quite heartbreaking because a lot of the developers that try to come in post Azura, the OMA Powers, the QIPPs, they actually did throw a lot of money into developing, and unfortunately, they've been yet to reap success from their investments. But it comes back to the whole to my beginning premise. The value chain doesn't work as it is. And we're not learning from the past, we're repeating the mistake. And so until we can fix each point of the value chain, I'm not necessarily sure that we'll be able to see more large IPPs come through. Thank you.
Wow. Thank you so much, Antonia. I mean, that's, you covered a lot and you've raised a lot of things that are very concerning. And which takes me to the DFIs on the panel. Because you've spoken from a commercial international banking perspective with a focus on the profitability and the bankability of the transaction. So let's move to the DFIs and see. And I move to Chris and of CDC, and just trying to say, what is your own perspective from a DFI? Is it the same as what Antonia is saying, that we're not likely to see a lot of international financier interest in these deals, regardless of investment philosophy, whether it's commercial, whether it's DFI? Is it what do you see? What's your take on it, on financing either IPPs or privatizations in an emergent market like Nigeria?
Thank you very much, Evie, and good to see a few familiar faces on the panel. Good afternoon, everyone, and thank you to Business Day for, I guess, inviting me to this distinguished discussion. I think it's been very interesting listening to all the various speakers. I think the passion in Heather kind of resonates with me. If I think about my historic equity investing hat, I was an investor in Azura. I was a developer on the Azura project, so I know a lot about the Azura. I also participated in looking at some of the privatization process in the first wave. And we decided not to, in my old fund, it was which was ARM Harith. We decided not to participate because we couldn't do the due diligence, because we couldn't understand the risk we were taking, and largely because it wasn't our capital. And it was a large international capital. So we had to be very careful about the risk we took on. And I guess history kind of, history is a great thing when you look at it. And we made the right decision because we felt it was very much a local driven privatization process. And when you look back at that, you will probably see there weren't many international investors. Neither were there many international banks, for the reason that Patrick spoke to. The process was rushed. I think it was still the right process because I think the asset needed to move away from government to the private sector. The challenge was then, did all the investors go in knowing that there was a path to a solution or resolution? So that's just, I just wanted to put some context into all the discussion points. It's resonated, be it from the 2011-2012 period of privatization, the time we spent on Azura. When I got into Azura, it was, I think, 2013. We were told it was going to close in 6 months. It didn't close in 6 months. It closed a long time ago. And without the way it was structured, we would have lost our capital today. And we won't be talking about Azura still being a transaction that international investors are still looking at to say there is hope for the right projects to be structured the right way for capital to come into a market like Nigeria. So speaking to in terms of how we look at it. So I wear a number of hats in CDC. So CDC has been doing investing in the continent for 70 years. So in 60 years, we've been doing power investing in Africa. So we've seen things are very cyclical. So there's probably not many things we as CDC haven't seen in the power space, looking at it from a Pan-Africa perspective. So the Nigeria challenges are not unique in the sense that some markets have gone through that, some have evolved quicker. But I think what gives Nigeria a lot of hope is clearly there is an untapped demand there, because when you look at the diesel kind of generation perspective, there's so much generation capacity in that market that international investors are hovering around to say, okay, we are interested, but because of the capital, the type of capital, my capital comes from UK taxpayers. So I have a fiduciary responsibility that any transaction I look at, I don't look at it from a full entrepreneurial perspective, which is, you want to do a deal, you want to close. I've got to look at it from a perspective that it is going to be investing capital. So we invest patient. So we look long term. When we provide debt, we look at 10, 15, 20 years if possible, because we understand markets, emerging markets, you need to have patient capital, you need to have long-term capital, you need to take some risk. And when we talk about risk, ultimately, the job of a DFI, if I speak to CDC, our job is to, over time, mobilize private capital into the sector, into the space. Because without private capital, no sector can be sustainable, okay? So we understand that you probably start off with concessional finance, you start off with subsidy, but in time, you're doing it such that it can become self-sustaining. So you have the like of North-South Power, you have the likes of Heather's entity coming in to invest as private sector to try and take it to that next leap. We take our money out as DFIs and go to another market. So that's how we think about it. So therefore, investment discipline is key for us, which means the documents need to be banked, which means the risk allocation needs to be clear between the private sector and the, I guess, the awarding entity, be it government or even maybe sub-national elements of government. So alignment of stakeholders in any transaction is fundamental to success. So if there is a wave of a new privatization process, we need to go back and, to Antonio's point, think about the lessons learned. If it is very much a local driven transaction, meaning we're looking at local entrepreneurs who are going to take the risk because they feel they understand the risk, then that's clear. But I don't think there's enough depth of capital in the market to allow it. So if you want international investors, be it DFIs like ourselves, and we are interested in the Nigerian market, I've been involved in Nigerian space since 2010 in the power sector, and all the woes are there, but still we're interested. But so therefore the interest is around, is the government and the key stakeholders willing to chart a path to a solution? And when we talk about a solution, I talk about a solution from a system perspective, okay? So be it the gas, if it's a fossil fuel, or kind of, I guess, renewable, if it's the natural resource, to the generation, to the transmission, to the distribution. That's the system. Investors want some level of predictability in terms of there's a solution, there's a sign up to it, and we know it's going to happen, okay? I wear a different hat. I'm an executive director on Globalec. Globalec is a CDC majority-owned company that develops power across Africa. We are the main developer of the QIPP project, which has been referenced a few times. We invested significant development capital in that transaction just at about the time after Azura closed, because we believed Azura would be the gate opener for many more private sector players like ourselves to invest in, because that was the start. And when government took on the Azura transaction, the view was it was going to follow a path. After Azura, there was the PSRP, which was a World Bank-driven program, which talked about the system, the gaps, you fund it, and then you move to a path where the private sector is able to say, okay, there's a clear path. We can then take a risk and invest knowing that sanctity of contract will take place. So I think these lessons or these, solutions are possible, okay? We just closed the transaction on a process of closing the transaction with Globalec in Mozambique. Mozambique is not that different to the problems Nigeria has in terms of, sectors broken, but guess what? They are signing up to a plan. They are starting to fix the tariff and the system issues ahead of a project closing. And they've got the will, right? And they are bringing international investors on board. And there's also a track record that they've done it on 1 or 2 transactions, which for investors like ourselves, we look at track record in a country and say, okay, is there a track record of private, public, long-term finance projects where people are being paid? There might be shortfall, because there's always going to be shortfall, but is there a plan to fill that shortfall over time, and a government paying that off over time? If there is, then investors like ourselves will come into a market. If there isn't, investors like ourselves will work with developers, work with government to try and bring lessons from other jurisdictions to try and bring it into place to say, okay, if you go down this path, which is a system approach, then you're going to have capital. So I sit on a lot of capital as part of what CDC does, be it equity, be it debt, be it through funds in terms of intermediate capital. On the Azure transaction, we invested in direct equity, we provided debt. So we believed in that structure as a route for more IPPs to come in. Unfortunately, that isn't there yet. But to Heather's point, I think intent is there in government to try and do the right thing to attract private capital, because without private capital, be it DFI, I think you're going to struggle to change the narrative. And we all want to help change the narrative because we know the country is suffering from the lack of power. So to your point, how does the DFI think? We don't think in direct details to Antonia's entity in terms of commercial banks, in terms of it's not necessarily about the return, because we're thinking longer term. It's about how do we do more to mobilize the commercial banks, the Colapos or North-South powers of this world. How do we do that with our capital such that we are providing some halo effect because of who we are to enable more transactions to take place? So I think the current wave of privatization being planned will struggle if it doesn't take on board all the lessons learned from other places. We don't have to fix it 100%, but we have to commit to try and fix it so there's a clear path and it is evidenced. Now, Nigeria, because of its shortfall, most participants on this panel will see that the sector currently attracting capital, both local and international, in the power space is in the decentralized renewable energy space or the CNI space. Why is that? Because there is an element of risk predictability, because people are now starting to think about credit-worthy off-takers, probably taking partially government out of the loop and using that as an angle to provide the much needed energy access in the market in Nigeria. But unfortunately, it is not going to fix the overall problem. It will solve a part of it, but I do think for us to really make the difference and fix the grid connected power, we do need to take a step back and go back to say, okay, what can we learn from the Azuros of this world? What can we learn from the first wave of privatization? And how do we then basically put that forward? And financiers like ourselves, our role is to help government, to help developers play that. And I use a strong word here. It's important.
I'm so sorry, Chris. I have to, because we've run out of time,
okay.
And I still have, to speak to reason. So thank you. I mean, you've given a broad range of insights. So it's very key. I mean, whether it's a DFI or a commercial bank, the contractual structures, the risk mitigation mechanisms, and sort of the whole framework in the sector geared towards mitigating all the risks that any financier would be concerned about is key. So I will turn to Reason, and Reason, to ask you the least person on this panel, just to see. I mean, AFDB is the philosophy. Is it very similar to CDC? What's the view? What's your view about AFDB's approach to further involvement in investing in the Nigerian power sector? I mean, there were talks at some point of AFDB providing a partial guarantee, but those talks seem to have dwindled, over the years. So how do you see AFDB's participation in the Nigerian power sector? Do you share the views of Antonia and Chris?
Thank you, Ibi. Thank you, everyone. Hello, everyone. I think the participants have summarized it very nicely, and from the AFDB's point of view as a DFI, even though concessional financing is needed, I think the blended finance principle, which the AFDB, the World Bank, and the rest of other multilaterals subscribe to, is that the more attractive a project would depend on the less concessional financing that will be needed for the project. So if a project can become bankable on commercial terms and less concessional financing will be needed, that project will be more attractive, because the essence of concessional financing is to mobilize private capital, just as was said. And if if the objective of concessional financing is to remove private financing, then we will not have achieved its objective. So bankability is still key. The contractual framework is still key. And for the current wave of privatizations that we see now, the ALSF, AFDB, and some other experts came together recently to co-author a book on transmission financing. And in some of the brainstorming sessions, I was privileged to be part of the exercise. In the brainstorming sessions, you kind of feel the vibe in the room, the thoughts in the room that privatization necessarily may not be, especially for emerging markets like Nigeria, may not be the first option that people are looking at. There may be other options that they're considering, even though we were looking at transmission as just a part of the entire value chain. There are other options that were explored to bring in private finance into the sector other than privatization, especially given the fact that there is information asymmetry possibly, and also because sometimes you see the government, because of the need to avoid the risk of regulatory capture and all, they may not give the investors for a privatization transaction as much comfort as the investors need to inject the capital needed. So depending on how the privatizations in Nigeria are structured, if the lessons from the past are learned, then we would wait to see how the DFIs will react. But at this point, I do not think that there's a lot of appetite for it.
Wow. Just tell it as it is, Reason. Thank you very much. I'm really grateful to my panel. We've tried to explore, there's so many dimensions to this topic. I mean, 1 hour is, 55 minutes is not enough time, and we're already out of time. So I'm going to have to ask everybody to just within 30 seconds, just, give me your closing remarks. I'll start with Patrick very quickly. And Patrick, particularly, I'd just like you to round up on, in terms of, we're talking about lessons learned, just in terms of looking at what was done with AFAM and just trying to look forward to what was changed within the AFAM privatization that you think would be useful in going forward with the wave of privatizations we have in the pipeline. Quickly, Patrick.
Let me, because it's, I need to be quick, right? Let me, with your permission, let me focus on lessons learned, and it'll be very, very short. And this will touch on issues raised by Mrs. Honor, Antonia, Chris, Kolakbo, Reason. My advice, given the depth and the breadth of all the mistakes from the previous NIPPs and privatizations and the successes we've seen in Azura, my advice is, dear FGN, please sit and engage with the private sector, sit with the banks, sit with the investors, for about 6 to 12 months, and then take away their concerns before you go ahead with this. Full stop.
Excellent. Thank you, Patrick. Thank you very much. Antonia, any closing words from you? If not, we can hear from Chris. Any closing remarks from Chris?
Yeah, can you hear me?
Yes, we can hear you.
Yeah, no, very quickly. So I agree absolutely with everything Patrick said. What's missing on this panel today is probably someone on the other counterparty side, which is government. So I think that's fundamentally important. I would say this from a CDC, a DFI perspective. Nigeria is a key market for us, so we can't ignore Nigeria. So we are interested in helping solve the conundrum in Nigeria where we can attract more private capital to the power sector. And we can do that in many ways, be it our capital, but also our influence in terms of government engagement and also lessons learned from other markets. So from our perspective, we are open for business and we want to do more in Nigeria. That's where I would probably leave it at.
Thank you, Chris. Antonia, any last words from you?
Yes. Definitely. I think that it's great that we're having these conversations. We should continue to have these conversations. But more importantly, I think the right ears need to listen to these conversations. The coalition of experts, and I'll call ourselves experts, the coalition of experts that you've put together in this panel represents, quite frankly, a very important side of the table, because it represents the equity side of the table and it represents the debt side of the table, as well as the advisors. So it's very important that when we speak, the right ears listen to what we're saying, and obviously we all have a stake in this game, and I do hope that we're able to see a lot of progress in the sector. And thank you very much for having me.
Thank you so much. Kolako, any closing remarks from you?
Yes, thank you. Well, look, from our perspective, I think the government will face the hard truth by the time they commence NIPP. They'll be very surprised because international participants will not be there. The local investors, which we will be there, will be very few, but we'll do it subject to certain terms. Forget what happened 8 years ago. They would never get that today, not from us or not from anyone. We will not put what we built at risk because we want to add value to the Nigerian economy by acquiring an asset. So clearly, that's why I really want them to go ahead with the NIPP asset, because whatever we say from experience won't move the government. They'll still think someone somewhere in Nigeria will be so bullish to bring out the cash and do it. But I think when they go through this process, then they'll see to someone like what you and Patrick did on the AFAM asset, we even downgrade that about 50%. They'll have to do that, and that's when the reality will hit them. So good luck to them on that. So
a note of warning there from Kolako. Thank you. Reason, quickly wrap up. Let's we can close the panel.
Yes, I think I'll echo the sentiments of everyone in the panel that broad government support will be needed to fix the issues in the sector. The private sector will do its part, but the government has to take the skin in the game and approach the issues as they are. Try to fix each issue as an integrated whole so that it's not trying to solve supply problems without looking at demand problems. So I think broad government support will really be needed to make it work.
Thank you. And Mrs. Ono, a last word from you.
Okay, I just realized that somebody's name is Reason.
Yes, that's his name.
Can we borrow him?
Nice,
yeah, because that's what the government needs. We can say all we want to say here, which is very good gesture, but the government actually need to sit down and reason. They need to engage their brain, and they know that I'm not shy about telling them that any day, anytime. So we just need to make sense of the sector. If we really want to have a country, we need to make sense of it. So that means the sense needs to cut across. You cannot look at one sector and think you want to solve that problem when you call it a value chain and it's a part of a chain. So if anything is a part of that value chain, if any part of it is broken, it's just not going to work. So we need to apply reason, deep thinking, that deep thinking to make this country, make the power sector work, because without that, we can say all we want to say, there's not going to be any economy for Nigeria. So we need to make it work and engage the government.
Thank you very much, Heather. So there you have it, Reason. We need you to come back to Nigeria, preferably in Abuja. We're going to be dragging you through all the government offices in Abuja until they see Reason. Thank you, everybody. It's been a fantastic panel, and it's been lovely hearing from all of you and listening to your very, very insightful perspectives. I mean, we're totally out of time, so we'll have to round up now. Thank you very, very much for being part of this panel, and enjoy the rest of your day. Thank you.
Thank you. Take care. Bye-bye.
So I'll be handing over to the next panel. The moderator for that panel is Ejeme Offerman, our last panel for the day. Ejeme, are you here?
Yes, I am.
Okay, so over to Ejeme. Thank you.
Thanks, Ibi. And good afternoon to all panelists and participants, especially those who have been here since we started this morning. I am Ejeme Offerman, a senior associate with Power and Infrastructure team at Olanyo Ajayi. At Olanyo Ajayi, we routinely advise project sponsors, financial institutions, government institutions, and corporates on the financing and development of on-grid and off-grid power projects, as well as transport and healthcare infrastructure projects. I have the privilege and the pleasure of moderating the fifth and final panel session this afternoon. The panel session is themed The Good Bypassing, Off-Grid Solutions to Commercial and Industrial Challenges. Let me just proceed to introduce the members of the panel. First, we have Ms. F.A. Brimer. FA is an associate principal and deputy head Nigeria across Boundary Advisory, where her team advises entrepreneurs, investors, and policymakers, conducting substantive diligence and analysis and providing actionable advice to unlock investments in underserved markets. Prior to joining Cross Boundary, FA worked at Boston Consulting Group, where she supported BCG's energy practice in upstream transformation for oil and gas majors, and BCG's social impact practice in strategy development, as well as government stakeholder engagement for donor-funded organizations in Nigeria. FA also worked at Symbion Power, where she carried out transaction due diligence, project investment analysis, and financial modeling for captive and off-grid power projects. FA holds a first-class master's degree in civil and environmental engineering from Imperial College London. Next, we have Mr. John Wajumogu. John is presently a partner with the strategy and transactions team at Ernst & Young West Africa, where he plays a dual role as the energy and infrastructure leader across the region. He has over 21 years of experience providing financial advisory services on mandates ranging from project and infrastructure finance, transaction structuring, mergers and acquisitions, divestitures, financial modeling and valuations for corporates and a range of institutional investors. He's been involved in assignments in various sectors such as energy, oil and gas, mining and infrastructure, amongst others. He has vast experience working in the key energy markets of Houston, Calgary, and Lagos, and has advised on over 200 transactions. John is a certified public accountant and a graduate of the Fletcher School, Tufts University. We also have Mr. Femi Adeyemo. Femi is the founder and chief executive officer at Onergy, a Bill Gates affiliated venture-backed distributed utility that provides reliable energy to residential, commercial, and industrial customers in Nigeria. Energy enables SMEs and economic clusters to run sustainably by providing reliable and affordable uninterrupted electricity using rooftop solar solutions. Before Energy, Femi was involved in the nationwide rollout of 4 mobile telecommunication access networks. He was a single point of contact on rollout and managed service operations projects across Africa, South America, and Asia for multinational telecoms or original equipment manufacturers, including Ericsson, Huawei, and Nokia, both from startup to nationwide scale. Femi's work has been featured on CNN, BBC, Reuters, Bloomberg, and other international and local press organizations. And he holds a master's degree from KTH Royal Institute of Technology, Stockholm, Sweden. And finally, we have Mr. Dele Fasimo. Dele has over 20 years of experience in the banking sector, across corporate and investment banking, infrastructure and project finance, and treasury and asset management. He has led several infrastructure and project finance transactions across multiple sectors, including telecommunications, power, and oil and gas. Dele has bachelor's and master's degrees in economics, an MBA, and is also an alumnus of Harvard Business School's General Management Program and Lagos Business School's Advanced Management Program. Dele is currently the group head of energy at Sterling Bank, overseeing oil and gas, power, and renewable energy. Welcome to all the speakers, and thank you for finding the time to join us today. Just to set some context for our discussion, really electricity access remains one of the key drivers of economic growth across the world. According to recent estimates by the International Energy Agency, over 61% of Nigerians do not have access to electricity. And according to a 2017 report by the World Bank, over 80% of Nigerian companies still cite electrification challenges as the most significant obstacle to doing business. Most of the progress in electrification in Africa over the past decade and a half has been due to grid connections, but there has been a rapid rise in the deployment of off-grid solutions. And this has seen countries like Kenya increase electricity access from about 20% in 2013 to almost 85% in 2019. In view of this progress, decentralized off-grid solutions are increasingly being canvassed as the least cost way of rapidly expanding electricity access to residential, commercial, and industrial customers. Here in Nigeria, we have witnessed significant growth in off-grid electrification with some marked success in the commercial and industrial segments of the off-grid market. But there are challenges. Although globally financing for off-grid electrification has accelerated in recent years, industry stakeholders still cite lack of financing as the most pressing obstacle to scaling the off-grid market. So our discussions on this panel really focus on off-grid electrification in Nigeria, some of the challenges, particularly in relation to financing, and hopefully we'll be identifying some of the ways we can spur further growth in Nigeria's off-grid electricity space. So if members of the panel could just turn on their cameras so I'm aware of who is present. But really, I just want to start with some broader macro questions, right? And the first question goes to John Wajumogu. How effective can off-grid energy solutions be in improving energy access and bridging Nigeria's energy gap? Hello, John.
Hello. Good afternoon, everyone. Thank you, HMN, and thank you, Business Day, for the opportunity to come and speak on this very important topic, which is also very prescient as we go into the first year of the implementation of the Africa Free Trade Agreement, which hopefully should transform the fortunes of the continent, and of which electricity will play a very significant role in, particularly given that agreements bias towards locally produced goods and able to lead us onto the pathway to industrialization. And talking about pathway to industrialization, electricity is really the bedrock upon which industrialization is built. And we are in a situation, like you mentioned, where the off-grid space of the market is seeing more action than the grid. And in fact, the grid unreliability is what is really driving all the actions that we're seeing in the off-grid space. Companies are having to, in order to be able to service their businesses, are having to go into power generation, which is non-core to their operations. And as they expand operations, they are even expanding their power operations, which end up companies like Dangote becoming a whole power company on its own. So what we're seeing now is that with advanced technology and with a desire to find an alternative to grid unreliability, obviously capital would always go into where to solve problems. And we've seen businesses and investments in that regard in looking to bridge that gap that exists and in grid unreliability. Now, the issue is that while off-grid has been effective in solving the reliability issue, the affordability issue is still remains. And for us to really have an efficient, the dual problems of reliability and affordability to be resolved. As you can, has been focused on commercial and industrial clients. And they would even tell you that while they're able to get reliable power through off-grid sources, it still comes at a very expensive rate, which makes Nigerian products not to be competitive. And it's still a constraint as to pivot away from over the dependence on oil exports or over the dependence on exports of commodities, start moving into exports of value, start moving into value adding activities and exports of finished goods. So the key question is, how do we harness the growth of the off-grid space in building a very robust and effective energy market? And I think what is happening in other countries is instructive on what we can do in this regard. Now, if you look at particularly in the developed economies, there's also, this issue of off-grid versus on-grid is actually a universal phenomenon. And unlike in Nigeria, where it is really born out of necessity, in some advanced economies, the advancements in technology driven by changing consumer patterns as they seek cleaner energies, cleaner sources of energy, as well as capital being supportive of and having ESG as a key component of the investment decision and being supportive of cleaner sources of energy. We're seeing that shift towards off-grid sources enabled by technology and consumer changing patterns. And with that is making off-grid to have a compelling cost proposition for consumers. That is not really happening in this space, but in other economies, we see that happening. And what is instructive in that regard is, at the time that this trends now comes into the Nigerian context, what should we be doing to position ourselves for it and harness the huge capacity that currently exists in the off-grid space. So we don't end up building a grid that for a market that no longer exists anymore. You don't want to be the last person that built, if I use the telecom sector as an example, you don't want to be the last person that built your landline when mobile technology was just making its entrance. So the same thing happens here. What sort of grid do we want to build, and how do we harness the capacities and the potential that exists in the off-grid sector in order to build a more robust electricity market? And I think the way to do that is to work collaboratively, rather than looking at the grid and the on-grid as almost disparate sections of the market, but rather looking at ways that we can harness this huge trend that is happening in the off-grid and being able to integrate it into the grid so that we can scale up the off-grid space and be able to disperse the scale economies that comes from that aggregation of the off-grid capacity, so that the beneficial effect is not local or restricted to a particular area, but can be pervasive across the economy. And to do that will require an integrated approach. Because right now, as I mentioned earlier, the affordability issue is still a problem. And the off-grid space is still overly targeted at certain commercial and industrial customers, and based on arrangements that are still on a bilateral or captive basis. So you have them on one-on-one, and what obtains is that you have this proliferation of excess capacity that is lying idle. And in fact, there's more capacity on the off-grid space than, as mentioned earlier, than really on the on-grid, than what is on the grid. So we need to find a way to harness this capacity and use it in aggregating it so that it gives us that scale potential to really drive transformative impact in society. And the way to do that is to define the role that the grid can play in that regard, and making the right investments and being able to have, particularly in digital technology and in building a smart grid that can play that balancing act of not only pulling electrons from where it's abundant to areas where it may be scarce or sorely needed. Thank you.
Thanks a lot, John. Quite a few key points in that response. I think for me, the focus on having, ensuring that we have an integrated approach, both in dealing with off-grid and on-grid electrification, if we're going to have or bridge the gap for energy access in Nigeria. But also, the challenges with affordability with off-grid, especially off-grid electrification, even in the commercial and industrial segment. So that's actually a very key point. But on one of the points you touched on how we can actually scale the deployment of off-grid solutions. I think on that point, I'm just going to direct my next question to FA. FA, at this time, many industry stakeholders are discussing and contemplating solutions that can help to catalyze investments in scaling up the deployment of off-grid energy solutions in Africa, and more particularly in Nigeria. Now, with your experience and your perspective on the off-grid segment of Nigeria's power sector, what are your views on what these solutions could be?
Thank you, Ejaman, for that question, and thank you to the Olaniwon Ajayi team for having me on here today. In order to scale off-grid projects in Nigeria, we really need to, and you touched on this earlier, we really need to be able to increase access to finance to these projects. And the only way to do this is first and foremost to develop solutions that make the projects more bankable and more affordable to the end user, or to de-risk the investment for the financier. And sort of what underpins all of this as well is sort of creating an enabling environment. So just on the first point of being able to create projects that are more bankable and more affordable to the end users, there's a few different business models and financing instruments that we can start to think about introducing and scaling in this space. So when we think about lower income or more rural communities, developers can start to think of business models that help merge the commercial and industrial solution with energy access. So an example of this would be where businesses form the anchor load or anchor client for a mini grid. And you reduce the payment risk in this way. You get the benefits of cross-subsidization of tariffs here. Developers can also think about increasing demand within their sites by, appliance financing or introducing productive use equipment. And I think beyond this, we also need to introduce instruments that help de-risk and incentivize, investments from financial services providers. So, thinking about blended finance vehicles, credit guarantees, first loss capital, all these instruments will be really important to achieving scale, especially where off-grid solutions are geared towards energy access. So there would be no PPA style contractual agreement that would manage offtake risks. So these are some ways to get around that. Closely related to access to finance is the ability to create, an enabling environment, for the sector to thrive. From a policy perspective, we all know that Nigeria generally has a robust regulatory framework for mini grids, but I think we can continue to think about new approaches to advance the sector. Like getting to the point where we can actually operationalize net metering, for example, and that will improve invest cases for near grid connections, or something that is the pain point for many sort of developers is reducing the import duties on certain renewable energy components that will help, with affordability, even for locally manufactured or locally assembled units. And I'm sure there's a long list of things that we can do to help scale the solution, but I think some of these high level points, I think, will go a long way to helping scale the sector.
Thanks, Efe. Thanks a lot for that, Efe. So my next question is really for Dele. We know that grant funding providers, impact investors and development finance institutions have really been instrumental in driving growth in the off-grid space. But this kind of funding, as a lot of people on various panels today have indicated, will not be sufficient to bring the market to scale. Right? So however, Nigerian commercial banks and other institutional investors have had limited involvement in the off-grid space so far. Maybe to some extent, Sterling Bank has actually more involved than most. But in your view, Dele, why is this the case? And what is Sterling Bank doing differently to support players in Nigeria's off-grid space?
Thank you very much, Jamia. Can you hear me clearly, please?
Perfectly.
Thank you. Thanks for that question. I think the context is very important, and the context is within what the previous panels today have actually sort of discussed. So there is a history, there is a context around the national power situation in the country. I don't want us to divorce experiences and in terms of the propensity of financiers to provide funding for off-grid solutions from the experience that everybody has spoken about very clearly today, right from particularly the 2013 privatization exercise. There is still, on the whole, that sort of lender fatigue, and sometimes it could be difficult to convince people to sit down with you when it comes to power financing before they actually get to know that you are speaking off-grid and not you are not speaking on-grid, or whether you are speaking privatization of state assets or greenfield privately sponsored projects. So that it's important to set the context as to where financing has sort of remained a bit of a mirage. But that is just on one leg. There are a few other issues that I think we need to pay attention to. There is the perception of the high risk nature, of infrastructure and general project financing in Nigeria. Project financing as it is, technically is not something that we're all familiar with. I'm privileged to be part of the Azura deal. I was in one of the banks, actually FCMB to be precise, that actually, did the financing or supported the Azura deal. That took a very long time to structure. There is some painstaking approach that went into negotiating the contracts and all of those, which of course, like various other panelists have spoken today, we didn't have the opportunity to bring to bear on some of the existing deals that were done with the privatization. So the general perception of risk is another element that we need to be aware of. That there is the regulatory concerns, around the power industry entirely. And these will speak to things around tariff. But potentially when we speak about, the economies of scale or the pricing of off-grid contracts, what generally comes to mind in terms of what people are comparing is the price they get by getting power on grid, which we know today is substantially subsidized. But if you remove and take out all the subsidies, it actually would help everyone to see the true economics of any bilateral negotiations you're having when it comes to negotiating a potential off-grid transaction. Now, the other element is around the capital structure. I think, generally speaking, we've seen deals that have been done in this environment where there's what I would consider too much of debt. I think we need to begin to migrate a little more to funding and capital structure. And I think in the previous session, Kolapo spoke about the capital structure that they sort of have adopted in some of the deals they've done. We need to increase or have a general notion of bringing more equity into the sort of deals that we structure to help and aid the bankability of those structures. There are other issues around the general economic climate, because when we're speaking of grid most of the time, these are mostly bilateral deals, right? And finding credible counterparties as off-takers, remains something that it's actually at the core to having a credible PPA that you can take to a potential financier, whether even debt or on the equity side. So all of those issues remain important for us to deal with, to identify and recognize them as potential bottlenecks and challenges that are sort of, limiting the flow of capital into that space. But for us, it's important that we begin to look at off-grid more from, renewable sources, such that we can have, a completely different way of structuring deals. People spoke about tenors of financing, for example. The appreciation of the lifespan, potentially useful life of renewable energy equipment, for instance, I'm sure Femi will speak to that very shortly, is enabling us from where we sit to take a completely different outlook, in terms of the sort of length of time that we will be willing to commit capital, to potential off-grid projects, such that it doesn't become a burden both on end users and of course project sponsors and ultimate financiers. I would like to stop my thought around that when we're speaking about limitations. Why it seems that there isn't sufficient participation by local banks with regard to putting financing in off-grid projects. Thank you.
Thanks, Dele. To be quite honest, I think we can obviously say you to that point, really, because a lot of speakers today have just talked about the importance of having local currency financing available for projects in Nigeria. So, Dele, really, why do you think, or how do you think we can increase the availability of local financing for off-grid projects in Nigeria?
All right, thank you very much for that as well. A number of the items that I mentioned before would quite honestly relate to why mobilizing local financing may still be a challenge. But I will speak to something. In 2013, across the entire industry, why was it the case that it was sort of easier to get financing offshore for many of those deals than getting financing locally? There are a number of issues from depending on where we sit, but one key element has remained the cost of financing locally, cost of local finance, whether debt or equity. So if the local debt capital market, for example, it's not as deep as it's meant to be, if it's the structure and the type of liquidity that is available will not typically support long-term project finance transactions of this nature, it's going to be very hard to find people looking for local debt to support project finance of of the type that we're discussing today. So if we can move towards further developments of the local debt capital market, in which case we're able to pool resources, either through issuance of bonds, long-term bonds, project sponsors coming together to pool resources, such that, it's easier to mobilize debt capital at that level. I think it will go a long way. And of course, at that point, we probably will be able to have easier conversation around the cost of debt, which today, of course, with the movement that we have seen in currency and exchange rate, has completely wiped out the benefits that we saw in terms of the cost of raising capital, raising debt offshore versus raising debt locally. But at the end of the day, if you hold the currency situation constant, I think we need to deepen local debt capital market to be able to mobilize sufficient low cost and long-term debt financing for projects.
Thanks, David. There are a couple of points in the response that I will pick up on later with John, but let me just move swiftly to Femi Adeyemo. Femi, Energy is one of Nigeria's more established distributed renewable energy solutions providers. What were the key challenges you faced during the early stages of your entry into Nigeria or the Nigerian markets? And how did you go about finding solutions to those problems?
All right, good afternoon, Ejemen, and thank you for you and your team at Olaniwa Ajayi and Business Day for inviting me. And good afternoon, fellow panelists. You've asked me very good questions, but I must say that you've put together a very wonderful event. I've watched or I've attended the first set of panels, the first 4, and it's interesting to hear the different perspective of what is happening in the markets. So to your question, we've been around for about 8 years now. The company was incorporated in 2013. I moved back to Nigeria after working, of course, initially in Nigeria, then working abroad, but coming back when it was obvious to me that we have to be part of the solution to the energy crisis in Nigeria. And what were the challenges that we faced when we started? 2014, January, that's when we started the operation. Of course, I hear some panelists saying it's a lot easier now to attract capital to off-grid markets. Of course, that could not be said in 2014, 2015, not until maybe 17 that we began to see equity investment into the sector. So capital was really, really difficult when we were starting 2014. I will always give kudos to the Bank of Industry because they were the first institutions that more or less just bite the bullet when they provided the first commercial capital to Energy and GVE then in 2015. So finance definitely was a big problem, but I can't say now that finance is a problem. So I have a different set of problems now. Finance is no longer on the list. Second was technology. So when we were starting out, we had 2 options. The technologies that were available that could be seen as bankable were largely DC-based systems that could only power maybe 2 bulbs and maybe a DC television. And the reason why Energy was funded was because we have seen the huge gap in the commercial and industrial space. I mean, I was building telecom towers in Nigeria before I moved out, and I built across 3 continents. So moving back, it was clear that if Nigeria is going to achieve, get to where it's meant to get to, if we're going to be that giant of Africa that we're meant to be, we have to resolve energy crisis. So in 2014, there was no bankable products that we could use. What was available then was more or less picking products off the shelf from tier 1 inverter manufacturers, battery manufacturers, which had its own challenges because that you can't scale with that, because it might take 7 days for you to even put one system together and then deploy it to customer. So how many of those do you want to deploy? So technology was the problem. And how did we solve that? It became very obvious to us that we had to build our own technology. I had to just, of course, ensure that I build a team, and we were able to develop a technology that also then solve a lot of the problem I have heard mentioned today, the problem of affordability. Because we knew that if we had to go to Europe to buy products manufactured in China, and the markups and the margins have already been added in Europe, and then we're bringing it to Nigeria, it was obvious to us that the cost will be very high for customers. So we had to develop as much as possible the technology that could make the products bankable and affordable. So we did all of that. And the third biggest problem that we faced was the issue of the myth around solar as that technology that could only power or maybe charge your mobile phone. It became very clear to me in 2014 when I was reading a very popular daily, and someone very high in the ministry was, maybe like a 2-page interview, and it was very clear that, yeah, solar, that technology is good, but the problem is it can't power appliances like refrigerator. This was 2014, and I'm like, oh. So it was very clear to me that we had a big problem at hand. The customer education, we had to start from the scratch, So those are the challenges that we faced initially. And again, give it to Bank of Industry when they partnered with us, and there were a lot of free media and a lot of education, especially when we're powering those rural communities. Most of, the media houses were there, and seeing some of those communities using air conditioners, having uninterrupted power. And then we go back to Lagos. I could remember some GMs at Bank of Industry telling me that, hey, Femi, that community we were just coming from and they could have uninterrupted electricity. I want one in my house. Another person called the following day, one in my house. And that's how we started, right? And before we know it, even the commercial businesses, SMEs, and then we began to power them. And of course, they said the rest is history. We've moved on now to start powering telecom towers, which was where the idea of starting the company came from initially.
Thanks a lot for that, Femi. So the key points you identified, so financing, technology, and myth of what solar power solutions can deliver. And I want, just in relation to technology, the point about technology, and this is maybe the geeky side of me, curious. What's your assessment of how much Nigerian developers are driving innovation in the off-grid solar electrification space? And this is just a general question. And then, but more importantly, one of our participants has also asked about battery technology and the availability of battery technology in Nigeria, especially for smaller scale businesses and dependable battery technology in Nigeria. And I think it's also back to the point about affordability and whether that's really available for MSMEs in Nigeria.
All right, I'll take the second question first, which was battery, because battery technology, of course, while we were starting, we couldn't touch lithium. Because again, affordability, lithium prices were like 3x or even 4x the price for lead acid. And we were deploying high quality lead acid batteries. But as at late 2017, when we started due diligence with our Series A investors, it was very clear to us that we had to move from lead acid batteries to lithium ion batteries. And of course, based on structuring and ability to be able to provide long-term financing. It was clear to us then that if we're going to be providing the systems that we have today, we need to be able to do it on a long-term basis. So now we deploy lithium ion technologies. And of course, there are a lot of other developers that are doing that in Nigeria. The technology, Unfortunately, I cannot beat my chest to say that we can manufacture or we are manufacturing lithium battery today in Nigeria. But I do hope that the enabling environment to make that happen can be provided. I remember growing up, I visited, I think it was primary school excursion, Exide Batteries Factory in Ibadan. I actually have a vested interest to start manufacturing lithium in Nigeria, but is there an enabling environment to make that happen? If I bring in the cells today, the duty I will pay on the cells is even more, at par or maybe even more expensive than if I bring in the entire lithium module, right? So those are some of the things that we need to deal with. But the second question around innovation, I can tell you that a lot of innovation is happening locally. I can say of energy. For instance, anything we can manufacture locally, we manufacture today. You might have seen our blue box. The box itself is manufactured 100% in Lagos. The technology, the Internet of Things technology that allow us to be able to remotely monitor, remotely control, and remotely shut down if customers are defaulting. We built all of that 100% locally and built by Nigerians, all of them under 30. So that's the kind of innovation on the hardware and on the software side that is happening locally. And I believe we can do more by government providing enabling environment and us entrepreneurs having to deal less with, countries like the North American countries that are taking our guys away.
Thanks, Femi. And thank you. You've provided a great segue to my next question, which is for John. And to be quite honest, I would like to hear, Femi, any of your views on this point as well. So we've all, I think FA talked about it, Femi has talked about it, the need for a strong enabling environment for investment in off-grid electrification. So John, what strategic fiscal incentives and policies do you believe the federal government can deploy to unlock further private sector investment in Nigeria's off-grid space?
Well, in terms of initiatives, I'm a bit hesitant on how to go about this. One, it's because Nigeria is really a policy-rich environment, and there's so many initiatives, and it's almost like we're trying to bootstrap our way to efficiency through lots of regulatory action, and they've not really, the outcome have just not been as desired. We've done the eligible customer policy, we've done the embedded generation, now we're doing the SOP franchise agreement policy. Hopefully this one will have legs, particularly given what Connexa is doing with Kaduna and the whole market working, looking at that and trying to see how that would unfold. Will be very instructive on how we're going to proceed, because you're really, to what I said earlier, it provides that basis for integration of off-grid sources together with on-grid. But to answer the question directly, I think the issues that we've been talking about all day, part one of it is that the power sector really, these issues are symptomatic of the broader economy. If we want to improve the investment attractiveness of the electricity market in Nigeria, that means that the entire economy has to be conducive for investments. They say, there's a saying that capital it's fleet-footed and would go to locations with the best prospects for return. So as long as there's some level of certainty regarding predictability of revenue or line of sight to cash and recovery of returns, capital will go where the opportunities are. But so I'm not sure, given that with the way that the off-grid sector has been growing, largely driven by private sector efforts, that we really am loath to ask for more instead of more regulation or more initiatives, because we need to also take a look at the ones that we've already put out and why they've not worked, and try to maybe identify those issues, resolve the root cause, and maybe then the potentials we saw, the outcome that we desired will now begin to manifest. But having said that, though, I think one thing that the government can do is a gradual deregulation of the market. Because I think the way the one-size-fits-all policy that defines the Nigerian electricity supply industry is really constraining the off-grid sector. Is not allowing the off-grid sector to scale up. Because for a company that provides power as a service to a commercial straw client, if they need to scale up, they will be confronted with a number of technical and regulatory issues that will make it impossible for them to really scale up and serve multiple customers, particularly in a geographical area. I mean, part of that is the failure of the market operators to collaborate with each other. You would think when the eligible customer policy, for example, came out, I saw it as an opportunity for unlocking stranded generation and enabling a collaboration between the GenCos and the DISCos to service maximum demand customers. And those customers who are huge electricity consumers, who are the cream of the crop, so to say, and whose operations have a huge impact on the economy because they provide jobs, and jobs are very important to what we're looking to do here. So, but that didn't manifest. So maybe the failure is the inability of the market operators to collaborate with each other. But I think part of that is also embodied in the way the regulation is not necessarily allowing that to happen. And institutionally, there are obstacles that are making it difficult for such collaborations to be able to crystallize. So I think taking a look at that and in specific areas of the market or specific rules, trying to de-emphasize or step down particular rules in certain areas of the market. I'm not proposing an entire deregulation of the NESI, but there are certain markets and certain areas of the value chain that I believe have foundations that are supportive of a fully competitive market. Lagos, for example, I mean, there's so much, if you think about it in terms of generation capacity that is available and customers who can provide that offtake as well. I mean, it's massive. So I don't think a state like Lagos should be on the same rules with some other states who do not have such commercial attributes as Lagos. So deregulation is very key. And deregulation invariably leads to decentralization because, it opens up the market for other players to come in and collaborate. It makes it possible for people now who have built up a captive portfolio of captive power generation assets to now begin to find ways to, and in most cases, people usually tend to get a generation capacity that's beyond what they need. So we'll have all this idle capacity littered all over the place. But then it enables them to aggregate that capacity and be able to put it on the grid and then be able to move it. And the grid can then play that role of balancing demand and supply across their network, particularly in a market like Lagos. I understand this may not be the case for every other state in Nigeria. And as was said earlier, it even enables state governments to play a more active role in their electricity markets and being able to provide additional support that may be needed from a local standpoint to try and catalyze investments in their local electricity market. So for me, I think taking a look at what areas of the market, what rules of the market that needs to be de-emphasized as it relates to certain parts of the country and also certain parts of the value chain, particularly the downstream and the distribution end, and putting in, if they have to put in new regulations, putting in regulations that encourages decentralization, which I believe in turn brings in more players into the fold, increases supply, and then when there's a preponderance of supply, it ultimately places a downward pressure on cost, which at the end of the day, it's very key because it solves that affordability issue. And with more players in the mix, you now have the dynamics of market forces prevailing much more than regulatory action, which then encourages innovation and creativity in finding ways to meet customer demand. Because when things are now being driven by the dynamics of market forces, as you've seen in the off-grid space, they come up with all different types of, whether it's pricing models, whether it's delivery models, to make sure that it's affordable, that there's a business, to make sure that it's a profitable venture. So I think if the government needs to do anything at all, is to deregulate and decentralize the grid or the operations of certain parts of the market that allow more players to come into the fold.
Okay, thanks a lot for that, John. We're slowly running out of time, but I think I'll just swing back to Femi and Dele, and I have a two-part question. Femi, can you just identify, what would you consider the essential or unique challenges associated with deploying off-grid solutions for commercial and industrial customers when compared to residential customers?
So when compared to residential, I think there are no unique challenges. Of course, affordability costing has to be right for both. But I think that on the financing side, on the regulation, and John writes, he said all the right words around the regulation. And if we had also touched on that before on net metering, right? So I think if we're able to put all of those in place, then the robust energy market that, all of the conversation that we've had around robust energy market, given where renewable is, there's a lot of capital across the world that is available for renewable, for off-grid solution. And I think that given all of the issues that we've discussed since 10:30 till now, I believe renewable as that solution, and with the right collaboration, I believe that most of these problems can be resolved, especially with collaboration from the distribution side. Based on, I align 100% with what the last speaker said, and injecting renewable into that as much as possible. I can tell you that commercial and industrial are a lot easier to deploy in Nigeria versus residential, because you are able to structure it better. Even financiers are able, okay, you have an off-taker, so it's easier versus our other business model on the residential side, which is a lot more difficult to finance versus commercial and industrial.
Thank you, Femi. And just to wrap up, my final question will be for FA. FA, the limited availability of data on potential customers and their financial capacity is often flagged as a key challenge in assessing the bankability of off-grid projects, especially projects intended for residential customers. So I'm taking a swing to the left of our theme. What role can technology and data play in improving the customer due diligence process?
Thanks, Ejema. I think obviously we all know that data can play a huge role. And it can play a huge role at a lot of different stages. When you think about even right from the project development stage, you can use geospatial data very early on to identify and to assess customer demographic profiles. You can also then use customer data collected during operations to build more predictive models, on behavioral patterns and develop credit profiles. There are a lot of providers that are expanding into the market and are leveraging customer data with their credit scoring platform. I think these platforms can really help developers better assess the repayment patterns within specific geographic areas or across, specific demographic profiles. Some examples are Migo, Karma, Pingme, and many fintechs continue to grow and expand into the country and on the continent with these offerings. I think there's a huge opportunity to partner with these providers to facilitate the due diligence process and particularly unlock consumer financing, right? Because that's the next stage that we need to get to, as this sector evolves. And this is not just, a renewable energy industry issue. It's an issue across the entire credit economy. So I think there's a huge opportunity to partner with fintechs or firms that are that have these sort of credit scoring platforms to leverage data that developers provide. I know many other companies and off-grid companies, probably Energy, are building in their own predictive analytics platforms into their business model to help them better assess potential customers and ease that due diligence process and alleviate investor concerns around the end user. So I think there's a huge opportunity there, and it's largely untapped.
Thanks, Ife. We've sadly run out of time. I had a few questions I wanted to send Dele's way, but I thought I would just give him the opportunity to round up. If you have any further thoughts on how we can ensure that off-grid project developers get the financing they need to scale, it'd be great if you could share them.
Thank you very much for the opportunity, Jamie. I think I'll take it from the way we're approaching it in Sterling. Starting with how we took a strategic view of the entire space, right? So we sat back a few years ago and we realized that not only will off-grid power provision be the solution, to sort of breaking down the macro problem, but that off-grid has to be essentially or mostly renewable. So in terms of the transition and in terms of the energy. So that strategic perspective is very important. And leveling on top of that is the fact that financiers and indeed everyone has got to develop, specialist knowledge in order to be able to approach this problem holistically. And Femi spoke beautifully about what his company Energy has been able to do and what they continue to do. In furtherance to that is the fact that we've then gone forward to create a customized financing framework that actually is a departure from our traditional commercial lending framework that enables us to support businesses within the renewable energy space, cutting across the entire value chain, providing consumer asset financing, sometimes even for up to 5 years, right? And providing financing to companies like Energy and supporting them on different other platforms, and providing financing to companies who are able to get credible off-takers for commercial and industrial installations. All of these things are important for us to be able to scale. We're not able to do it all alone, and we actually continue to preach collaboration. A lot of the panelists today have spoken about the need for collaboration, alliances, partnerships. We work with the, with the REA. We're an institutional member of REAN, which is the Renewable Energy Association of Nigeria. So all of those different elements coming together, we wish that there would be a lot more commercial banks and local financial providers who are able to join hands and, so that we can actually solve this problem. A lot of things that we can talk about, but of course, for lack of time, I think I'd like to just hold my thought there. Thank you very much.
Thank you so much, Dele. Femi, John, Efe, thank you so much for sharing your unique insights and perspectives with us today. I'll now hand over to Mr. Igbolu for closing remarks.
Muted. Thank you so very much, Madam, and great work you have done moderating this very last panel. It's usually very challenging having to moderate a panel this late, but Benjamin, you have done fantastic. You've done a fantastic job, and I thank you so much. I'd also like to join you in thanking the panelists for bearing with us and for ensuring that although they were on the last panel, that their contributions certainly were not the least of all the panels. We appreciate very much the collaboration and partnership from the firm of Olanio Ajayi, and I thank Olemi very well for the leadership role that he has played in ensuring that we're here today. I'd like to thank our sponsors, All On, EN Consulting, Infra Credit, FBN Quest, Genesis, Kaduna Electric, and Kano Electricity Distribution Company. Thank you once again to all our panelists, our moderators and speakers, and of course, to our audience, we thank you. We expect when we gather again next year for the 2022 Future of Power Summit, that it will be a bigger, more exciting show we will be putting on. So let me close by saying that we have done a lot of talking today. I hope that the right ears have been listening. We hope that those who have responsibility for executing some of the ideas that have been canvassed here today, whether they be those in charge of policy formulation or those involved with regulation, that in the year ahead, we will be seeing some improvement. I'm particularly excited by the work being done on the renewable energy front. And we have had some of those who are directly pushing the envelope in that sector speak here today. Once again, ladies and gentlemen, thank you very much. I wish you the very best. At Business Day, we will continue our robust coverage of the energy sector, of the power sector, shining light on where we can do better, and of course, applauding those who are moving the needle. You all take care and God bless you. Thank you once again, and bye-bye.
Delight was actually started to tell innovative, exciting, and positive food stories out of Lagos, Nigeria.
Being the foremost luxurious goods company in the entire West Africa is a big deal.
Will you have every opportunity? No. But you see, the opportunities you lose on account of your value system, that's your opportunity cost for what you believe, and is the price you must be willing to pay.
Thank you very much and bless you.
Delight was actually started to tell innovative, exciting, and positive food stories out of Lagos, Nigeria.
Being the foremost luxurious goods company in the entire West Africa is a big deal.